It is 9 a.m. on Monday, November 15th. This is Yahoo Finance Live. I'm Julie Hyman with Brian Sozzi. Let's take a look at where stocks stand this morning. As we're coming off of a bit of a rocky week last week, indications for a higher open this morning. S&P futures pointing to a gain of about 1/3% at the open, and that's pretty much what we're seeing across the board here. The inflation challenge from Treasury Secretary Janet Yellen to Brian Sozzi at the grocery store. Americans are grappling with rising prices. We will discuss all of those angles. The worker conundrum. 4.4 million Americans quit their jobs in September. Job site ZipRecruiter has a record number of companies with postings, but finding employees to fill those jobs is tough. We're going to talk to ZipRecruiter CEO Ian Siegel. And the Elon Musk puzzle. Tesla's chief troll officer takes his Twitter snarkiness to Senator Bernie Sanders. This after Tesla shares fell 15% last week, and he also teased perhaps selling more of his own shares. But we do start with the inflation picture here this morning. Treasury Secretary Janet Yellen making the rounds this weekend along with some of her lieutenants, talking about what is causing inflation. The primary cause, she says, is COVID. That's what she said on Face the Nation.
If we want to get inflation down, I think continuing to make progress against the pandemic is the most important thing we can do. I think it's important to realize that the cause of this inflation is the pandemic. It all but shut down our economy. It boosted unemployment to almost 15%, and we've been opening up in fits and starts, and the pandemic is really responsible in its impact for the inflation that we're seeing.
So this is the tack the administration seems to be taking here, with increasing concerns on the part of everyday Americans, economists, market participants about rising inflation. The administration says this is an unusual situation here with COVID, with supply shocks. Even as Republicans try to sort of make it a political issue on the other side, saying the administration's spending plans, former spending plans and bills, have been at least partially responsible. Wherever way you slice it, Brian Sozzi, it's evident the prices are going up on the consumer level, and that this is continuing to pressure Americans' spending and potentially pressure it going forward. Certainly it's hitting confidence.
Yeah, no, we had that consumer confidence report out last week, and the tone around that with respect to inflation was quite alarming. And I wrote more about inflation in the Morning Brief newsletter this morning. It's on the Yahoo homepage. I encourage everyone to check it out. But really now starting to hear the first murmurs on the street of faster than expected interest rate hikes next year. And in the brief, I highlighted what Goldman Sachs said over the weekend. They are now expecting 2 interest rate hikes. One starting in July next year, the other one coming in November, as a result of inflation that they concede is a lot higher than they expected. I heard that similar tone as well, a new note out of Jefferies too, suggesting that rate hikes may now need to happen a lot quicker than the market expects because of this inflation. But Julia, I saw what you did there. You mentioned the word slice, and I was in the supermarket this past weekend, tweeted out a photo of this giant turkey. You said it was a giant turkey. You slacked that to me. And there it is. It was $72.30. And what I didn't realize until I went back and looked at the photo, the turkey behind it was $78. Now, I have not bought a Thanksgiving turkey in my life before, full and fair disclosure. But to me, this seems very inflationary for a turkey that, even though some would say this is a Ferrari of turkeys, Bell and Evans, not the typical Butterball, no offense to Butterball. But still, I mean, that is a big price tag and no doubt inflationary.
Brian, okay, I buy your inflation argument. This is the wrong example. This is absolutely the wrong example. And I'll tell you why. That Bell and Evans turkey is $3.99 a pound. Anyone who is a real person shopping at the grocery store, you look at the per share, for lack of a better word, you look at the unit price of something. You don't look at the total price of something to measure inflation. That is an 18-pound turkey, dude. You're not buying that turkey for yourself. Unless you're having 20 people around your Thanksgiving table, you are not buying an 18-pound turkey. And I don't know what Bell & Evans per pound price was last year or the year before that, but $3.99 is not insane for a Bell & Evans turkey. That being said, yes, obviously there is inflation out there on a number of different items, and all of the sort of measures of looking at the typical Thanksgiving basket, right, from cranberries to stuffing to turkey, have shown that we are seeing those unit prices on the rise. To me, yes, this is that's $72 for turkey is a big number, but it's a big turkey. In any case, however, to take a step back, when we talk about this inflation argument, again, the question is, how do you attack this issue, right? Do you attack it through raising interest rates? As you said, Goldman Sachs now calling for more this year. Michael Darda of MKM, who we're going to have on later in the show, also is saying that the Fed is getting behind the curve here. But it comes back to our ongoing discussion about supply and demand. We know there's a supply shock here. We know there are ongoing supply chain issues. The question is the demand that is also out there and the money supply that is also out there. The Fed raising rates and sort of addressing that side of the equation, is that going to actually tackle the inflation problem in an accurate way? And I should also mention that the views on the Fed are far from unanimous. Morgan Stanley out this morning with a note, strategist Andrew Sheets penning that note this morning and saying inflation is actually peaking right now and it's going to improve. And that team is not calling for interest rate increases until 2023. So even though they say to avoid U.S. stocks in 2022, their views on inflation and interest rates do not necessarily square with what we're hearing from some other banks.
I think this will be one of those topics you and I just don't see eye to eye on, Julian. That's okay. I look at the total price, and when I see a turkey that may end up costing me $85 after taxes or whatever it might be, that's a big purchase. But look, I mean, it is tomato sauce too. We just talked to the CEO of Sovos Brands, came on a week ago. I mean, they're taking the prices from $9.99 a jar to close to $10 a jar. I mean, this is happening. This is happening in real time. But what I will say this, Julie, it is interesting to see the markets hold up here despite these inflationary readings. And you have to wonder, I think investors are trying to think, well, what is one way we can beat inflation? It's probably staying invested in this market because we have seen a pretty good third quarter earnings season. And then secondarily, what stocks should be playing in an inflationary environment? It's probably dividend stocks. And we've seen a good bid under those as well.
One more thing I want to mention is what's going on with the energy prices as part of this whole equation, right? Because certainly we have seen gasoline prices go up. And that's something, too, that's very visible to people. You see the prices right there on the gasoline station. And gas prices have been ticking up this year. Here is a 10-year chart of gasoline prices. So we are seeing them tick up. They are not where they were 10 years ago. They were higher at that point in time, just again to put a little perspective on all of this. But it is something that is also very much affects people's day-to-day lives. We have heard that Senator Chuck Schumer is calling for releases to the Strategic Petroleum Reserve in order to increase supply in the United States and help alleviate some of these gas prices. So obviously you can see there's been a big increase over the last year, even if the 10-year chart of retail gasoline prices looks a little more reasonable. But there too, certainly, Saz, maybe more people are driving electric and hybrid these days, but certainly enough people are filling their tanks still that is a challenging number for them.
Yeah, I mean, to fill up your car might be, I know in some areas by me in New York, I mean, it's pushing 450 a gallon for the high test. But, you fill up that gas tank, you fill it up with 2 or 3 of those Bell & Evans turkeys. I mean, that's about a $200 trip right there.
What's your MPG on the T-Bird? I'm really curious. I can't imagine it's very high.
I think we're clocking in about 15 miles a gallon.
Nice.
Yeah.
Nice. All right. We also are watching other things in Washington, of course, besides the inflation debate, right? And that is, of course, infrastructure is happening as well. It actually was, I guess, Infrastructure Week last week. And now we're expecting the president to be signing the infrastructure bill today. Our Jessica Smith is in Washington. So talk to us about that ceremony and how it's playing in Washington, even as the Democrats are now trying to get a spending bill going again.
Yeah, Julie, the president wanted to have this bipartisan ceremony once lawmakers got back to Washington. They were gone last week. So now that they're back in D.C., he wants to have this ceremony with members of Congress who were critical in getting this bill across the finish line. You'll remember 19 Republicans in the Senate voted for this infrastructure bill, including Minority Leader Mitch McConnell, though he is not expected to be at the ceremony today. There are expected to be governors, business leaders, mayors, and others there, all as President Biden tries to take a bit of a victory lap here on this infrastructure bill. The White House did announce yesterday that former New Orleans Mayor Mitch Landrieu will coordinate the implementation of the infrastructure law. The White House said they've been working to get programs ready to go ahead of this signing, but it could be a couple months before the projects actually get started. And as you mentioned, this is just one piece of President Biden's economic agenda. He is also trying to get that social spending package across the finish line. The House is expected to vote on the Build Back Better plan at some point this week. You'll remember moderates had been waiting on that full CBO score before they voted for the package. We are expecting that could come. We could get an update today. That score could come sometime over the next week. We are still waiting on those details. The Senate needs that too in order to take this bill up. This week, the Senate is working to make sure all the provisions in the bill are in line with the reconciliation rules. And Majority Leader Chuck Schumer did say over the weekend that this week the Senate is going to take up their annual defense spending bill. So that would likely push the Build Back Better plan into early December because we have Thanksgiving coming up. And of course, we have a lot of things going on in early December, from government funding to debt ceiling and potentially this Build Back Better plan. So going to be a busy few weeks here in Washington as they try to complete the rest of President Biden's agenda. But today, a victory lap on the bipartisan infrastructure bill with this ceremony at 3 o'clock. Guys.
Yeah, and a pretty busy day on tap for President Biden, of course. Jess, important meeting for him this evening.
Yeah, this evening he is meeting virtually with Chinese President Xi Jinping. The call has been in the works for quite a while. His administration has been having conversations with their Chinese counterparts throughout his presidency, really building up to this meeting. President Biden has talked about how he prefers to meet people in person. He has long talked about his relationship with the Chinese president. He has worked with him extensively before, but today, the plan is to kind of set the rules of the road, set the terms of competition with China. The White House is kind of lowering expectations for specific deliverables, but we expect them to talk about areas of competition, areas where the United States disagrees with China. Of course, human rights abuses is going to be one of the issues that is raised. And then they also plan on talking about areas where they could cooperate, like climate change. Again, that meeting starts at 7:45 this evening, so we'll keep you updated on what comes of that.
Thanks, Jess. Appreciate it. And talking about infrastructure, we are going to be having a discussion with Transportation Secretary Pete Buttigieg. That's coming up today at 10:15 a.m. Brian and I are going to talk to him about not only infrastructure, but a lot of other topics as well, including what's been going on with the supply chain. You don't want to miss that conversation. But coming up next, another important conversation, and Brian kind of teased it here. How do you trade all of this inflation stuff? What's going on in the market right now, and what are market participants talking about? UBS's Stuart Kaiser will be here to discuss that next.
How to trade inflation is one of the biggest conversations on Wall Street trading desks at the moment. Let's bring in UBS Head of Equity Derivatives Research, Stuart Kaiser, for more on this. Stuart, good to see you as always. I think you gave me the best trade in the break. I mean, to buy one of these inflationary turkeys, stick it in my freezer, and maybe sell it 2 weeks from now. But look, if one does not want to buy turkeys, how should you be trading these hot inflation prints that we continue to get?
Hey, good morning, Brian. I think it's a great question. I think it's directionally you have two choices. I think if you believe the markets are going to kind of power through higher inflation over the medium term, then I think you want to be long things like the commodity sectors within U.S. equity markets, potentially small cap equities, or some exposure to potential metals and mining and things of that nature. I think if you're more worried that inflation could trip up the rally, then you're looking at downside trades. And I think most investors we've spoken to are really focused on the tech sector for that, whether that's Nasdaq, semis, large cap S&P tech and things of that nature. So I think it really depends. If you're trying to trade tactically around the short-term risks, I think most people have sort of gravitated towards tech. And if you're just generally bullish, then I just think you want exposure to two parts of the market that tend to benefit from that higher inflation. And again, that would be sort of commodities, capital goods, small cap, and more cyclical parts of the market, I guess.
Stuart, the sort of transitory argument has faded into the background a little bit as inflation has been more persistent. But how's the market treating it right now? Is the market, because I have seen some commentary that inflation is at or near peak. Are we seeing any of that reflected in the trades that you're watching?
It's a great question. Our UBS view is that you're not going to have inflation peak until probably late in the first quarter of next year. So that you still have a period of time here where inflation will probably continue to pressure the markets. Our inflation strategists are actually above consensus for prints, into year end. So we do think there, over the short term, are some kind of risk to inflation continuing to surprise for the to the upside. And I think what you've seen there is you've seen the market start to add some hikes into 2022 because they're worried the Fed may kind of come under pressure from that. And then on the equity side, again, I think we saw a period of tech put buying. More recently, though, we've just seen a tremendous amount of activity in upside in the energy sector and even in emerging markets, which doesn't seem like it'd be a good inflation trade, but I think it has sort of cyclicality and kind of a growth exposure that people have been attracted to. But I think the two most popular trades we've seen to the upside would be small cap and energy, and hedging sort of more tactically would be in tech. But I don't think this is going to go away. It's probably late in the first quarter of next year with inflation in the high sixes or low sevens, and that should continue to pressure the market. So I think this is a conversation that's going to be on our plate for a while, actually.
Yeah, Stuart, I'm starting to see a lot more folks chatter about on rate hikes by summer of next year, which means the Fed would signal that some part in the first half of next year. Do you think that signal, and it's likely coming, is that correction worthy for the markets?
It's a great question. The Fed has sort of created this window for themselves, right? They've said we're not going to, finish tapering until June, and in the interim, we're going to evaluate inflation here, and then decide what we need to do from there. I think your question revolves around when would the Fed discuss it, or maybe more importantly, when would the data and the market kind of begin to pressure the Fed to make that decision and have that discussion. Whether it's correction worthy, I think, potentially, if inflation were to get to a level where it looked like the Fed needed to, react more strongly and more quickly, i.e. the Fed was behind the curve, I think that could definitely, cause a pullback. The fact is we haven't really seen that this year, though. When inflation was released in May, we had kind of a 1-day pullback. We obviously had, a bit of a hiccup in September, the market down about 5% when the Fed started to talk about tapering and things of that nature. So I think there's precedent that you could get, a 3 to 5% pullback. Anything more than that, I think you'd have to be in a situation where you were genuinely concerned, the Fed was behind the curve and was going to have to do some catch-up hikes. And again, that's not our base case, but I think that's the type of situation you'd need for that kind of market action.
And Stuart, again, I know you're more of an equity options guy than a bond market options guy, but are you seeing any kind of pricing in that there could be a change in leadership at the Fed? Do you think that the market is adequately sort of pricing in that possibility?
We've only had, I'd say, a minimal amount of conversations about that with clients. I think there's a couple articles out this morning that President Biden is evaluating Lael Brainerd as well as Joe Biden. As well as Jerome Powell. So I think that's out there. I haven't seen anything, any specific trades or specific moves in kind of bond options that would be directly linked to that. I think people are much more focused on the pace of rate hikes as well as the pace of inflation. And I think both of those candidates, which seem to be the two primary candidates, seem to have a generally consistent view that you should take your time and kind of be measured in terms of how the rate hike cycle might approach itself. So I think if you had candidates that were vastly different in terms of how they were thinking about this, maybe then the market would have to price something. But I think by and large, the view is that in terms of monetary policy, those two potential candidates are similar enough where you haven't really seen it get priced out, at least what we followed.
That CPI report, Stuart, late last week, I think caught a lot of folks by surprise. It pressured the markets. This week we'll get a retail sales report. How are your clients positioned trade-wise into this?
Yeah, it's interesting. We were way above consensus for that inflation print, and I think consensus kind of moved in our direction, into the inflation print, but the numbers were still surprising. So, I think that's definitely the case. We do expect a pretty strong retail sales report. You also have a fair amount of consumer staples and consumer discretionary stocks reporting between now and Black Friday. And I think, look, the focus here is going to be on discussions around wage inflation and input cost inflation. If you rewind the clock back to the second quarter earnings period, a number of consumer staple stocks discussed that, and their stocks made very large moves on earnings. So I think what folks are trying to do is identify stocks that might be under pressure from some form of pricing power, and either hedge or at least be a little careful about those stocks around earnings season. So I think generally speaking, the view is retail sales should be pretty solid. But at least as we get into that sort of what we would call the last wave of earnings season, I think the real focal point here is, do those companies discuss, wage inflation, input cost inflation, or the potential for supply chain to impact their holiday spend season? So I think those will be the three major topics that investors are going to be debating over the next kind of run up until Thanksgiving.
Stuart, just quickly, small caps. Want to save a word for small caps here, which I know you mentioned in some of your notes to us. As we think about going into year-end and next year, if we're going to continue in this relatively high inflation environment, maybe moderating growth environment, is small cap something that makes sense for people?
It is a spot we like, quite a lot relative to inflation. Small cap should tolerate a higher rate of inflation than tech or kind of large cap stocks. So we think that makes a lot of sense. I think the little tripping point we've had here the last few weeks is the shape of the yield curve. We've seen the Treasury curve kind of flatten out quite a bit over the last few weeks. And that flattening of the yield curve actually tends to be a little bit of a headwind for small cap and cyclical stocks. So ideally what we'd like to see is, if you are a bullish small cap, is growth and inflation remain fairly strong, but the yield curve kind of steepen out a little bit. So you have two aspects here. I think you've got an inflation piece and you've got a rates piece. And based on our outlooks, both of those should stack up pretty well for small cap. And we do like being long small cap as sort of a, either an inflation exposure or an inflation hedge, depending on how you're positioned. So yeah, we're pretty positive that part of the market.
Great insights as always. Stuart Kaiser, UBS Head of Equity Derivatives Research. Good to see you. Have a great rest of the week. All right, coming up, meat producer Tyson is out with better than expected earnings as inflation plumps up its profits. And WeWork has just reported its first earnings report as a public company, showing an improvement in occupancy, but another large loss. More analysis on both of these big names straight ahead.
A deal in the food business. You know, that's got Brian Sozzi pumped this morning. It just broke. Restaurant Brands is buying Firehouse Subs, $1 billion deal here. Soz, talk to how does this fit into Restaurant Brands? Is this the biggest acquisition they've made? Just put this in context as much as you can. I know it just came out.
Yeah, no, a lot of thoughts. This is the first big deal by our new Restaurant Brand CEO, Jose Sil. He's been there for a little bit, but still, this is his first, I would say, big power move here. $1 billion all-cash transaction for Restaurant Brand, buying Firehouse Subs, which has 1,200 restaurants, and system-wide sales for this year are expected to approach, according to the release, $1.1 billion. So a big chain that will join Tim Hortons, Burger King, and of course Popeyes as well. And really now you're getting, I think, a real true direct competitor to what Arby's is doing. Arby's bought Buffalo Wild Wings a couple of years ago. Arby's also bought Jimmy John's for $2.1 billion. They're also a sub chain. They bought that in 2019. So you're really seeing, I think, these two companies now trading blows here.
Interesting. All right. Well, we'll have to see. The Restaurant Brands, interestingly, the stock not reacting much this morning, just up about 0.9%. Although actually it may have closed for pre-market trading before this deal came out. And there we have a little bit of movement there. So we'll be watching that after the bell rings as well. And speaking of the bell ringing, that's happening in about 45 seconds from now that we will see the cash open this morning. We are seeing futures indicate a bit of a higher open here, not a huge one, as investors continue to watch the inflation picture, awaiting the signing of the infrastructure bill today, as well as we talked about at the top of the show, President Biden virtually meeting with President Xi of China. That is set to happen this evening. So a lot sort of happening on the macro stage this morning, even if we have earnings kind of quiet down here heading into this week. All right, and U.S. Steel ringing the opening bell this morning. USS, still though the ticker X on U.S. Steel, but ringing the bell this morning. And I said earnings quieting down this week, but it will be a heavier week for retail earnings. That's going to take over in terms of prominence this week. But first, we do have a few earnings reports to talk about today. Tyson Foods is where I want to start it. Tyson, an interesting one here, because as we talk about the inflation environment, this is one that really has been front and center for a couple of reasons. Obviously, its input costs have been going up. It's been raising prices, and it has been desperately searching for workers and raising wages as a result of that. I'm seeing earnings here that beat estimates. Sales beating estimates is here as well. Soz, what really stands out to me here, I was looking at the different proteins, right? Beef, pork, chicken, prepared foods. In every one of those categories, the volume is down and the average prices are rising. So they are obviously making up for lower sell-through by raising those prices. Their beef average prices, you're going to love this. This is right in your wheelhouse. Beef average prices up 32.7%. Pork average prices 38%. Chicken average prices 18.7%. They don't have turkey listed on here, alas, but you get the idea.
Well, Julie, they don't own Bell and Evans? I thought they were. I was looking for the turkey line in this report. No, it is interesting. And to your point, that is a great observation here. You are seeing those volumes down, citing labor challenges there, ongoing labor challenges. I should say Tyson has been dealing with these challenges really since the pandemic started. But on beef, their beef operating profit margins for that segment, 22.9% versus 10.9%. Last year. So you're seeing the benefits, even on lower volume, they're able to push through price increases and offset a lot of the inflation they are seeing and expand those margins, at least in the beef segment. Chicken was down year over year.
All right, let's move from animal protein to plant protein and talk Oatly. This company having a very different experience here. The company's earnings missing estimates, I should say revenue, it looks like missing estimates here, posting a smaller loss than estimated, but cutting the revenue forecast. So a lot of disappointment for folks who like to put this stuff in their coffee, I suppose, Brian. But it seems like that there are a couple of issues here at Oatly. There's production issues. And it seems like there are some COVID-related production issues as well. What do you make of this report?
Yeah, our producer Val is one of them. She has a whole freezer of this Oatly stuff just sitting in there waiting for her coffee. You know she does. But look, I think one of the reasons why you're seeing the stock under a lot of pressure here, all of your points are well taken, Julie, but if you go down and look at what they said about their guidance, they're calling out something in Europe that we haven't heard from Oatly before, noting that revenue might be starting to be impacted by higher competition. Now, I go down the oat milk aisles. You know, we were joking about Val having a whole freezer of this stuff. I mean, I enjoy oat milk. There is a lot more competition down the aisles. And up to this point, I would say Oatly has been able to fend off a lot of new entrants into the space. But I think their guidance here may have spooked a lot of investors that for the first time, Oatly is really starting to come up against it. A lot of these new competitors, which in some cases are undercutting them on prices.
And also recall, this is a company that has drawn some short seller interest, right? And some of those short sellers calling out some of these production issues, perhaps anticipating them. So I don't know if there's the view here that maybe this quarter validates some of those concerns, but definitely seeing an outsized decline in those shares here today. And then another sort of a mover I'm watching this morning, certainly a story I'm watching this morning, is Tesla. The stock fell 15% last week. That was its worst week since March of 2020. And Elon Musk tweeting at Bernie Sanders over the weekend, because this guy just can't resist himself. So Bernie Sanders had tweeted about taxes here, saying we must demand that the extremely wealthy pay their fair share, period. Didn't tag Elon Musk, although obviously Musk is very wealthy. And Elon Musk fires back, I keep forgetting that you're still alive. That I just don't even know what to say about that. But like, yeah, I don't even know. But we
it
also
crosses the
know.
line, Julie. It crosses the line. I think he just broke I think he broke a Twitter rule here. I think this was a little over the edge, even for Elon.
He's gone there before. So it's not necessarily surprising. He also mentioned that he would be probably selling some more of his shares, or he might be selling more of his shares. He sold $7 billion worth of his shares last week. You know what I was reminded about, Brian Sozzi? Remember when Musk tweeted about his stock being too high? Do you recall that?
I do. I do. It was a big
moment.
moment.
May 1st. That was May 1st, 2020. Do you know what the stock has done since then?
Talk to me.
It's up almost 700%. Mm-hmm. So if it was too high then, like maybe Elon's happy to see the stock price go down. If he thought it was too high then.
Is he happy about that Lucid award?
Well, that's something else, right? Yeah, Lucid being awarded the 2022 Motor Trend Car of the Year, and most people can't even buy the thing yet, right? I mean, have they shipped the Lucids yet?
It runs. It looks cool. They're shipping some, but it's not. I mean, this is not mass market stuff yet.
No, this is a luxury vehicle. Those Lucid shares, that's quite a contrast, isn't it? It's up 2.5%. So, you know, Musk may be not too pleased about that news this morning. That Motor Trend Car of the Year, definitely a status symbol, right? And can be a selling tool for some of these cars, Saz.
Mm-hmm. Yeah, it's not unlike really the Yahoo Finance Company of the Year. You know, we move markets as well, Julie.
Indeed. All right, we are going to take a break. Before we do, I want to remind you of one more company that was out this morning. That is WeWork. Its first report as a public company, and Saz had the chance to talk to the CEO. We're going to get details on that just a bit later on. But that company, we don't really have estimates out yet for that company, but you see their revenue of $661 million. Do we have a look at how those shares are trading yet, folks? WeWork shares, there they are. Oh, look at that. They're up 2.5% as well. So, Saz, we're going to get some details from you a little bit later on. Coming up next, though, we're going to hear from Jared Blickery on the floor of the New York Stock Exchange. Not just a check on markets, but some very interesting data as we look at earnings season. We'll be right back with Jared.
Let's head over to the New York Stock Exchange and check in with Yahoo Finance's Jared Blickery. Jared.
Yeah, let's check out the Wi-Fi Interactive. First, I'm looking at the bond market. We are in the 5-year T-note yield. We are hovering by the recent highs, which are themselves multi-month highs, so we want to keep an eye on that. 10-year T-note yield a little bit farther down relative to the 5-year. You can see that's at 1.58% right now. And finally, the 30-year is up just a fraction of a base point to 1.96%. Now, we are in the seasonally bullish time of year. Now, we know November, December, and a few months into January are, but specifically within the month of November, this is kicking off today what I'd say a period where we typically trough and we head higher. So bullish seasonality factors working in here. We also have options expiration, sometimes throws a kink into things, but this is probably the last normal month that we'll have in the year, December being a little bit of an aberration since the back half is usually pretty quiet. But you take a look at what's happening inside the markets today. Let's see if we can get the NASDAQ 100 here. If that'll work, there we go. And we can see that Microsoft just about flat, Apple up over 1%, Amazon as well, Tesla, which we've been talking about, Elon Musk still selling that stock, that's down about 2.5%. Worth looking at a multi-month chart on Tesla right here. Let's see if we can bring this up. And we got some participation. You can still see it's up 33%, but well off of its highs. And you can see on a trailing 7-day basis, still down 18%. I don't think the top is in for Tesla, but I do agree his comments over the weekend were a little bit off color with regard to Bernie Sanders there. Kind of agree with you, Sazi. Looking at the sector action, we got mega caps in the forefront. Communication services, which houses Alphabet and Facebook, that's up 0.5%. Tech is up 0.4%. To the downside, we got materials, that's down 0.7%, along with energy and healthcare and real estate. So the value trade really not in tow today, guys.
Let's talk about commodities for a moment, because they continue to be in focus, both on the retail side and on the sort of trading base side. So what are we seeing in oil and some of the commodities here?
Glad you asked. Let's go back to the Wi-Fi Interactive. I'm going to pull up a 3-month chart of crude oil. Actually, let me dial this back down to 2 months. And you can see the trend over the last, say, 6 weeks here is really just sideways. And I think it's telling that we're back below $80 a barrel. I've seen some of the commodity push I guess the factors that were really pushing, especially energy prices higher in the commodity complex, I think that's abated a bit. If you take a look at the electricity costs in China, those are well off of their highs, and that's because China has stepped into the market and basically altered the prices. So I think that headwind is pretty much off the table now for commodities. Doesn't mean that we're not going to see higher prices. I think gold and silver have some room to run here, but crude oil bears watching. It keeps punching down below $80 and uses $80 a barrel as resistance. That could be an important signal that the demand for crude oil is not as great as it has been, as people thought. And the International Energy Agency recently came out, this was last week, lowered their demand forecast for not only the current year, but also the following year. So I think crude oil definitely worth watching here, especially around these prices, $80 a barrel.
We will indeed keep an eye on it. Jared Blickery, thanks so much. All right, with inflation a top theme here this morning, here's your Yahoo Finance stat of the day. Of the S&P 500 companies who reported third quarter earnings from September 15th to November 12th, 285 cited the term inflation during their earnings calls. That is well above the 5-year average of 137, according to FactSet. In fact, this is the highest overall number of S&P 500 companies citing inflation on earnings calls going back to at least 2010. All right, coming up, a record 4.4 million Americans quit their jobs in September as they either sought out higher wages or new lifestyles during the pandemic. ZipRecruiter's co-founder and CEO Ian Siegel joins us next on The Great Resignation. ZipRecruiter is finding itself in a sweet spot right now as the demand for labor to support the economic recovery remains intense. And it showed up in the company's latest earnings report. ZipRecruiter saw third quarter sales surge 107% from a year ago. The company also lifted its full year sales and profit outlooks. ZipRecruiter co-founder and CEO Ian Siegel joins us now. Ian, good to see you again. We've been talking all morning long about inflation, whether it's in commodities or worker wages. From your vantage point, where are you seeing some of the biggest hourly wage increases for workers?
Well, we're seeing wage increase really across the board. The biggest is in leisure and hospitality, where there's just a real struggle to bring people in who are going to work every day in a face-to-face role with the public.
And Ian, what we keep trying to sort of get our arms around what is going to get those people back, right? We've talked before about whether it is wages going up that is going to be the key. What are you seeing throughout the platform? What is most enticing to job seekers?
I mean, that is the fundamental question of the job market today. Previously, we had hypothesized that all of these workers were reluctant to return to work because they were scared of getting sick, or they didn't have childcare, or they were getting stimulus checks, or they didn't have to pay their mortgages. And literally every one of the reasons that we had been talking about is gone now. And yet not only are workers not returning, but they're quitting their jobs at a record rate on top of that, which is putting employers in a real conundrum. And the response from employers has been to effectively roll out the red carpet to these job seekers. They are pulling out every stop they can think of. They're raising wages. They're offering an increased number of jobs with benefits. They're offering flexible schedules. They're literally offering entry-level job seekers the opportunity to go to college and have it paid for. And yet the job seekers still aren't coming. And fundamentally, what we think we're wrestling with here is a question of a change in what people want from work, which is they want remote work. They've tried it during the pandemic, they really like it, and they're holding out until they can try to find it.
Yeah. Well, I mean, 4.4 million Americans quit their jobs in September. What are some of the top reasons they are quitting? Is it the mask mandate? Is it lifestyle changes? Is it a combination of all those things?
I mean, survey after survey after survey, whether it's on ZipRecruiter or on third-party sources, is all telling us the same thing. 55% of job seekers are looking for a job that allows them to work remotely. Again, during the pandemic, people discovered a new, more satisfying way to live. It's the #1 perk that employers are offering on ZipRecruiter. 2 years ago, less than 2% of jobs mentioned remote work. Now more than 10% of jobs mention remote work. Those companies that are offering remote opportunities are experiencing the most success in recruiting. However, only about 40% of the jobs in America can be done remotely, which presents a really interesting question about what's going to have to happen to wages or benefits or perks for those jobs that require face-to-face interaction on a daily basis with the public.
Ian, I don't know if you know the answer to this, but this is something I've been trying to wrap my head around. The government numbers, the Bureau of Labor Statistics numbers in the monthly jobs report now show, the last report showed, only 11.6% of workers were teleworking at some point in the prior month because of the coronavirus pandemic. That number seems so low, given what you and many other people are saying about remote work. Like, what? Is it a data problem? Is it that people are working in an office even though they don't want to be? What's going on here?
Well, a lot of people have been compelled to go back to the office, particularly over the last quarter. And I think that's a big part of the reason we're seeing this surge in resignations, because before it was a reluctance of job seekers who were unemployed to re-enter the job market. But now we're seeing millions of currently employed professionals quitting their job, good jobs, without having another job lined up, which really, and I feel like I've been using this word a lot over the last 2 years, is unprecedented in the job market. Part of where this is coming from, though, is that job seekers and the currently employed have a record nest egg saved up over the last 2 years. There was a tremendous reduction in their amount of consumer spending that was going on, so they find themselves flush and they have long runways from which to make choices about how they deliberately want to live the rest of their lives. It's going to be really interesting to see how this plays out over the next 12 months, because at some point, these people are going to need to pay rent, they're going to need to pay their mortgages, and they're going to have to return to the job market.
Yes, they are. And so that brings me to my next question. What does normalization look like? Not just for the job market, but for you guys, right? You've been on a hot streak, a lot of companies looking for jobs. As we see this all sort of smoothing out, how does that look for ZipRecruiter?
Well, the story of ZipRecruiter has been a tale of two sides of a job market. I mean, if you look at the employer side of our job market, we've had 3 record quarters in a row where the number of employers on our platform looking to recruit just keeps moving to new heights, yet the job seekers have not been returning. And that has created an imbalance, which we are fortunate from a market timing position, but we are also fortunate from a product innovation position, because in a market where there is intense competition for job seekers, having a service like ours where employers are literally shown a list of algorithmically selected candidates and they can directly recruit them even before they've applied is an advantage. In the future, I think we're going to see that we're all on a glide path back to a more normal economy and a more normal job market. It's going to take us probably another 12 months to get there. And once that balance happens, it's still going to be an opportune time for recruiting and for job seeking. But right now, I mean, truly, it is a golden age to be a job seeker. You have never seen employers fighting so hard for your attention.
Good way to put it. ZipRecruiter co-founder and CEO Ian Siegel, always good to see you. Have a great rest of the week. Coming up, I've been digging into WeWork's earnings report all morning long. We are back with a few hot takes on the numbers straight ahead.
WeWork is a public company, of course, now, and it just reported its first earnings as such. The shares trading a little bit higher. Brian Sozzi, your take this morning, you spoke to the head of the company about these numbers.
Yeah, quick phone chat with WeWork's new CEO, Sandeep Mathrani. He was really the mastermind that turned around General Growth Properties when he was CEO there. But look, this quarter was interesting. You're seeing the stock react favorably here. My first takeaway is that this could be the right reaction. Their occupancy levels improved sequentially. Physical memberships up sequentially as well. They're all access passes. That improved as well. They sold more of those. That is a good thing. And just my general sense, Julie, talking to Mathrani, is that the foundation appears to be set. The company has been really through the ringer the past two years. That's why they brought Sandeep in to essentially fix the company and bring structure, I should say, to WeWork. It sounds as though that structure is now in place. They've cut, I believe, over $1 billion in costs and expenses out of this business. So next year for them, if they can get these occupancy levels really continuing to trend higher as people go back to the office and look for space and do not want to sign long-term leases for property, you are now looking at a potential case where they might be able to hit profitability at some point next year. Whether that's sustainable, wildly unclear, but again, they might be able to hit that bogey at some point next year.
Saz, do we know how many people work at WeWork now? Not work at WeWorks, but work at the actual company? And like how many of those insiders who were there before, who I assume most of Adam Newman's people are gone?
I did not see that number in the earnings release, Julie, but I can tell you, just having covered WeWork throughout the past 2.5 years, I mean, there's been a lot of people internally that have left. They left before Newman and they left after Newman. I think Sandeep has put in a lot of key people into key roles to bring that foundation to a company that really desperately needed it. I mean, he is an experienced experienced real estate executive here, and I was very impressed when talking to him in a few minutes. I haven't talked to him in a few years, but very impressed what he's working on.
All right, well, we'll keep watching that company, see how it ends up doing. Coming up the next hour, still a lot to get through, including a conversation with Transportation Secretary Pete Buttigieg about the infrastructure plan and much more. Stay with us.
Welcome back to Yahoo Finance Live on this Monday morning. I'm Brian Sozzi, joined as always by Julie Hyman. Let's get a quick look at the markets a few minutes into today's trading session here. Seeing some green on the screen really across the board. Dow, S&P 500, and Nasdaq all in the green as we await a good bit of economic data this week, of course, headlined by the retail sales report. We're also awaiting news on the infrastructure plan. More on that in a second. President Joe Biden is set to sign into law that sweeping $1.2 trillion infrastructure plan today. We're live shortly with Transportation Secretary Pete Buttigieg to discuss the package and what it may mean to the U.S. economy. Tesla stock, the number 2 trending ticker on the Yahoo Finance platform, as traders brace for potentially more stock sales from CEO Elon Musk. Musk has unloaded about $6.9 billion in stock in the past week to satisfy his tax obligations. We should also note Musk also got into a Twitter spat with Bernie Sanders over the weekend. And gold prices are catching a bid as hot inflation reads continue to pile up. The inflation hedge has seen its price climb to 5-month highs to nearly $1,900 an ounce. The Spider Gold Shares ETF has gained 4.4% so far in November, outperforming the S&P 500's 1% advance. But let's stay on inflation and what it can mean to your investment portfolio. Michael Darda is MKM Partners chief economist and macro strategist and joins us now. Michael, always nice to see you. Putting this question to all strategists that come on the show today: how could one invest successfully in a land of really inflation that is not going anywhere anytime soon?
It's a great question, and thanks for having me on. So quite a bit of uncertainty and confusion out there at the moment. All of that said, we have a stock market that's been on an absolute tear despite high inflation. That's not always been the case historically, but it has this time around, and I think for a set of very specific reasons. One is that market interest rates are still extremely low on a historical basis, even though they're up year to date from where they were in January, essentially range bound, from the first quarter. Liquidity levels are high, and companies have a lot of pricing power, so profits have been very strong despite those high inflation readings. That doesn't necessarily mean the market is going to continue to soar on a go-forward basis. I think it's really going to come down to the future path of market interest rates and how the Fed maneuvers moving forward, because they will be moving into a tightening cycle probably before many forecasters assumed that they would.
Mike, it's Julie here. When would that be? Because it sounds like from your recent notes that you think the Fed's already behind the curve here. And I guess that also feeds into the discussion that we've continually been having as to if they're behind and they start to raise rates, how much will that actually help to curb inflation?
Right. So, really important topic. I do think the Fed is increasingly falling behind the curve. One way to think about that is the inflation adjusted policy rate. And we can, even forget some of the statistics that have been elevated with the headline and core CPI, and just look at market inflation expectations. At the 5-year horizon, we're up above 300 basis points now, pretty much a record level since that market goes back to the late 1990s. And so as inflation expectations have picked up, the inflation adjusted policy rate on a forward-looking basis is actually falling. And this is happening not with deteriorating macro fundamentals, but improving labor market prospects, a plunging unemployment rate, first-time jobless claims falling to a succession of post-pandemic lows. So by sitting still, the Federal Reserve is actually passively easing monetary policy. And keep in mind that the taper does not mean tightening. It doesn't mean asset sales. The Fed is still adding to its balance sheet every month and is expected to continue adding to its balance sheet through the middle of next year. So this is really an unprecedented accommodative monetary policy on the part of the Federal Reserve. And for that reason, I think an expectation that these inflationary pressures are just going to sort of disappear on their own, which seems to be what most of my competitors are saying, I'm afraid it's highly unlikely.
Well, if those pressures are unlikely to dissipate, Michael, it sounds like we could see a series of rate hikes next year, no?
No doubt about it. So if we look at futures markets, they are already pricing in several rate hikes starting next year, and then additional rate hikes moving into 2023. But what's interesting about this market pricing is those expectations have simply moved with inflation expectations moving higher and credit risk spreads moving lower. So there's really no actual tightening going on. A tightening means the Federal Reserve is getting in front of the neutral rate curve and as a consequence, slowing the economy more towards potential growth. That is not on the horizon anytime soon. So, we had this big debate about peak growth and peak inflation and peak profits, and, it got a little bit silly a few months back. But the key is if growth is running well above trend, well above the growth rate of potential, then we're going to have pressure on prices and costs, especially as the capacity side of the economy is constrained. And we can see that with the unemployment rate and a host of other indicators that are moving much more forcefully than they did in the last cycle.
So Mike, put it together for us and talk about what happens to stocks then if we start to see the Fed get more aggressive next year.
I think it probably means we're going to see a pickup in market volatility. It could also mean a reorientation into stocks that have lower equity market multiples, what we would think of as value, depending on how the dollar performs. That'll have implications for overseas markets versus the US. One thing it doesn't mean, at least initially, is that the economy will suddenly plunge into recession. I saw some quite bizarre commentary on Twitter recently, essentially making the argument that, the Fed shouldn't be hiking rates and tanking the economy because of supply side shocks. Who's talking about tanking the economy? What we're talking about here is the Fed moving because the neutral interest rate is moving up. And if they don't, then you have overheating and inflation, and that really complicates the Fed's adjustment process later on. So at least initially, as the Fed moves towards stopping the growth of the balance sheet and raising short-term interest rates, there's not going to be any kind of a recessionary risk. That'll come later if the Fed ends up tightening too much, or if they wait so long that they really have to play catch up. It's going to be harder to slow the vehicle at high rates of speed, if you will. And so I think that's what we need to focus on here.
Bizarre comments on Twitter. Imagine that. Mike, does your scenario change if Lael Brainerd becomes head of the Fed?
Maybe a little bit at the margin, but honestly, I don't think it would be a radical departure from the Powell-led Fed. They're both on the same page in terms of the Fed's average inflation targeting regime now. And so I think at the margin, the answer is yes, but it really is marginal. If we look at how markets reacted to that speculation last week when she went to the White House for a supposed interview, real rates dropped, inflation expectations moved up, but this had already been going on before that speculation. And so I think it's really a matter of degree, and it's probably pretty modest.
Michael Darda, MKM Partners, Chief Economist and Macro Strategist. We'll see you on Twitter. Have a great rest of the week. All right, coming up, President Joe Biden is set to sign into law his $1.2 trillion infrastructure plan today. We're live on the other side of the break with Transportation Secretary Pete Buttigieg to discuss the package. Stick around.
This is Yahoo Finance Live. President Biden set to sign the infrastructure bill today. An ambitious package has a lot of different things on the agenda aimed at improving broad swath of infrastructure in this country. Pete Buttigieg is joining us now, of course, Transportation Secretary of the United States. Secretary, thank you so much for being here. I want to start actually with a process question, because as I mentioned, this is a big package. It affects roads and bridges and public transportation. Just practically, how do you go about tackling this? How do you decide what to prioritize? How do you bid out the projects? How does all of this actually get done?
Right. So the moment the ink is dry from the president's pen later today, we're going to be getting to work making sure that the American people see the most possible impact from these dollars. That means making sure that they go to worthy projects, making sure there's imagination and creativity in how to apply them in ways that are going to benefit the country for the next 50 years and beyond. And of course, a high degree of accountability and responsibility, because these are a lot of taxpayer dollars. In practical terms, part of that means routing new dollars through old plumbing, so to speak. So we already have excellent, well-established programs and machinery, so to speak, from formulas to discretionary programs that lay out what we as a department are looking for when communities say, hey, I want to make a safety improvement to the streets in this city, or we have a need to make an improvement at this airport. We have mechanisms for doing that. Now we have much more to do it with. So for example, on a recent discretionary grant program where we have to select proposals from around the country, there were about $1 billion of funding to work with and about $10 billion of compelling applications. That's going to increase a great deal and allow us to flow more dollars through those existing programs. But we also have to stand up whole new programs, dozens of them, in order to meet new policy objectives set out by this infrastructure deal. And that's where our department is going to be gearing up, staffing up, and getting ready for the months and years ahead.
And Secretary, I think there's broad agreement that infrastructure needs to be fixed, right? As Americans, we encounter much of this every day. In the actual process of it, it can be frustrating for people when the road that you want to drive on is being repaired. So as this is ongoing, what's the sort of message that you want to get out to the American people about this process and whether it is going to be challenging for people?
Well, what I would say is when you see that something is coming offline to be improved, whether there's a lane closure while a road's being fixed or a bridge has to be out while it's going through a deep rehabilitation to make it safe for the future, or an airport terminal is not available because they're making it bigger and better, just remember that on the other side of that is going to be the world-class infrastructure that America needs and deserves. It's never fun going through those disruptions, but I'll tell you, a disruption because we're underway on a planned project project to improve something is so much better than a disruption because something fell apart because we didn't get to it in time. Not long ago, I was out at the Mississippi River in Memphis, where this bridge straddling Memphis and Arkansas went out of service abruptly on an emergency basis. And you could see a crack, almost a movie-style crack in a giant piece of steel holding that together. Those are the kinds of closures we never want to see again, which is why we're going to have more of the kinds of closures associated with a planned improvement to make things better, stronger, safer, cleaner for the long run.
Mr. Secretary, U.S. consumers are really feeling a good bit of inflation right now. Can you assure them that this package is not likely to add on to those inflationary pressures?
Yeah, I think a really important thing to recognize is that some of those price pressures come from the fact that our goods are moving across infrastructure that has been neglected for a long time. And that's part of the story of why we're seeing these supply chain issues. It's not the whole story, but it's definitely part of it. But this is also why we've got to succeed with the second part of the president's economic agenda. When you look at the cost of housing, the cost of childcare, the cost of prescription drugs, this bill will do something about each of those that Americans will feel directly and immediately. Really important and really timely in this season of price pressure and increased costs.
Do you see the supply chain bottlenecks ending anytime soon?
Well, we're definitely seeing some immediate impacts of the immediate steps that we've taken. But the most honest answer I can give you is that as long as the pandemic continues, there will be disruptions. We have intricately connected global networks. When a shoe factory shuts down in Vietnam because of a COVID outbreak, or when a single case leads to a section of a massive container terminal in China, for example, closing, or when there's an issue here affecting truck drivers 1,000 miles inland from a port, any one of those things could be something that you will see at a port on the West Coast or at a shopping mall near you. But what I will say is that we've seen private sector operators of these supply chains stepping up in remarkable ways to get goods to the shelves, to make sure that they're being creative, using our existing resources 24/7. It's making an impact, and we're going to continue driving that short and medium term change, while for the long term, we make sure we have better ports, better rails, better roads, so that our core infrastructure that all of those private sector processes play out on is more resilient for whatever challenge of the future could come, whether it's another pandemic, God forbid, whether it is the extreme weather that we're seeing more and more of in this era of climate change, or something we haven't even thought of. By definition, we will be more prepared for those challenges when we have more resilient infrastructure. And that's exactly what we're ready to deliver thanks to this historic bill.
Now, when you talk about the private sector and the talks that you've been having with them, I mean, how far do you think, from a federal government perspective and a policy perspective, do you feel limited to some extent? In other words, you can't raise wages or get truckers back on the road if they are not able to hire people, for example. So, I mean, what more do you think can be done right now that is not being done?
Yeah, realistically, we are talking about a lot of private actors here, right? I mean, think about what it takes to get a product to the shelf so you can buy it, right? It's the manufacturer, it's the shippers, it's the store. Nobody wants a government-owned and operated grocery store or retail shop, or for that matter, factory. But the government does have a role here. We've brought players together to identify steps to make better use of the capacity that we have, even on an issue like trucking, which again, as you've mentioned, is of course private sector and rightly so. We can take steps working with states to make it easier to issue those CDLs, commercial driver licenses, so more people can go into the field. And steps like that are, we think, making a difference. Our ports envoy, John Porcari, has been working with some of the players at our ports to do things like send sweeper ships around that pick up the empty containers that are getting in the way of the full ones. Those little steps add up, and we do see an important role for this administration, even while a lot of these issues are business issues that the markets in the medium to long run need to resolve.
I want to switch gears a little bit and talk about electric vehicles and autonomous driving for a moment, which has been a very hot topic on our end from the market perspective, certainly, and also as part of this infrastructure package in terms of beefing up the national charging network. When we think about supply chains as well, and just the whole evolution of electric vehicles, you know, I know you're somebody who sort of is a big thinker, right? where do you think we are 5 years from now, 10 years from now, in terms of how important that sector of the economy is going to be?
It's going to be more and more important each passing year. Look, it's very clear that the future of the automotive sector is electric. The real things that are in question, I think, are three things. One, does it happen fast enough to meet our climate goals? Two, does it happen with American workers and American companies on American soil as much as possible and create as much opportunity as we can here at home? And third, is it available to everybody? And if you think about it, the Americans who stand to gain the most by going electric, saving all that gas money, are often low-income Americans who have a hard time getting that sticker price put together for one of those electric vehicles that could save them so much if they could afford it. That's why the Build Back Better agenda, the piece still working its way through Congress, includes discounts of up to $12,500 to help a family acquire one of those vehicles, while the bill we just passed gives us the funds to build up that charging network so that nobody has to think twice about whether they can get to where they need to be. We see this accelerating. We see this really defining the industry in so many ways. Again, the momentum is already there, but those issues of affordability and having it happen here in America, that doesn't happen on its own. That's why it's a policy priority too.
Mr. Secretary, I think we can both agree we are headed to an electric car future, no doubt about it. But for right now, Tesla is the dominant player here. Do you think, just given the crashes we have seen with regards to their autonomous technology, are those cars safe to be on the road? And then secondarily, are you surprised that they have not issued a recall on this full self-driving technology?
Well, let me say this. Anytime that we have a report of a safety issue, that's taken very seriously at the federal level and by the NHTSA, the Highway Traffic Safety Administration within my department. And that's true in terms of requesting and requiring information from automakers. And also we have a means to get information from individuals, drivers who have had issues. We have got to make sure that these technologies, as they roll out, are safe. And we have to have clear communication with drivers that no matter how sophisticated or smart your car is, any car that you're acquiring on a market today in the US requires that you be behind the wheel and paying attention. Now, there's tremendous upside potential with autonomous driving and with driver assistance. Look, we just got some tough numbers in terms of roadway deaths in this country. More than 30,000 people a year losing their lives. So the status quo is clearly unacceptable. To put it bluntly, human drivers don't have the best track record, but it's not automatic, so to speak, that computer systems are going to do better unless we have the right kind of regulation and the absolute highest expectations. That's what our department's going to be focused on, and we're going to hold companies to a very high standard.
And Mr. Secretary, on that front, do you think that Tesla has been doing, obviously, as you said, the law is that a human driver has to be there. Do you think Tesla has done a good enough job communicating the abilities of its existing system and that people still really need to be paying attention?
I do think it's very important to get that out, that you need to be paying attention with your hands on the wheel. These are driver assistance technologies, not driver replacement technologies. That may change someday, but it hasn't yet. And it's really crucial, certainly for manufacturers to be transparent about that, but also for drivers to understand that. And we're going to continue as a safety agency, making sure that any issues with that technology that we're now requiring be reported in on a new basis, that those are flagged right away, reviewed, and if necessary, we will step in on a regulatory basis to assure everyone's safety.
And finally, Mr. Secretary, if I may, we've been paying attention to some tweets lately, whether it's Joe Lonsdale commenting on your paternity leave or Elon Musk himself firing back at Senator Sanders. And obviously, as a public servant, you have to have a thick skin, but you're also in many cases working with these folks in various capacities on various measures. How do you kind of get that done when there is at times this publicly acrimonious rhetoric?
Well, generally not over Twitter. I'll tell you in my experience, the more you can be directly connected with somebody. Look, in the heat of the moment, with that little screen in front of you, people say all kinds of things. But I also believe that we have a moment right now that calls for shared purpose in this country. And that's the tone that comes all the way from the top in this administration. That's obviously something the president believes in, not to wave away the many deep and serious divisions in this country, but to work through them to deliver. I think the best way to build trust is to deliver results. And that's one of the reasons I'm so looking forward to the president signing the infrastructure deal today. And then folks like me across this administration getting to work, making real things happen. When you deliver results, I think that builds the kind of trust that you can then build on to do more and better things in the future.
Transportation Secretary Pete Buttigieg, thanks for your time this morning. Appreciate it.
Thank you. Good being with you.
We are going to take a quick break. When we come back, we were just talking about the growth of EVs. Of course, Rivian, one example, that stock has been on fire since going public. But of course, gains have not been limited to new issues in electric vehicles. We're going to talk about the IPO market more broadly coming up next. It's been a hot market for IPOs. Of course, Exhibit A last week was Rivian's massive IPO, and the stock just keeps on going up. Let's talk about the IPO outlook now with EquityZen's Phil Hazlitt. He joins us right now. Phil, you know, we obviously have seen this demand. Is there anything that you think is going to slow it down? Higher rates, for example, any other speed bumps coming up?
Yeah, I think there's a number of factors that could lead to kind of a slowdown in the IPO market. And you're starting to kind of see it in some of these earnings reports where supply chain issues, consumer trends, inflation are all starting to kind of hit the bottom line for companies. And I think that's going to start to maybe slow down the IPO window, in addition to just some normal seasonal timing where we see a slowdown here towards the end of the year before kind of a pick back up in Q1 of 2022.
So what companies are you excited about that might be coming to market soon?
Yeah, we're keeping an eye on companies that maybe have seen some acceleration of growth because of a COVID trend that maybe want to monetize on that or bring it to the public markets and kind of validate their business model by giving it some more eyes. So, a company we think about in that space is a company called ServiceTitan, which provides software to contractors kind of across the home builder space. That's a company that's raised close to $1 billion in pre-IPO funding that we might kind of see hit the market in 2022. So we'd expect to see some other companies that kind of have that profile that are really excited to kind of, again, show their story, validate it to the market, maybe get some liquidity as well.
Has there been sort of any rhyme or reason between the companies that have been hot and those that have been less so? I mean, it's not like every company that's come public this year has done amazingly the first day. Do you see any patterns?
Sure. I think there's some companies that just really wanted to tap the public markets, and again, maybe had a COVID story that they thought wasn't going to be repeatable and decided to take things public, or were just a little bit premature in their business model and decided to take things out. I think Oatly is a kind of an example of a company that went public, earlier this year, had a really great trajectory behind it. It's got an ESG story. It's got a big market share story, and they've run into consumer changes and trends. They've run into supply chain issues. It doesn't help that oats are up 150% year over year as an input for costs. And if you saw maybe a more established company in that sector, like a Pepsi or something, they would probably be a little more forthright with their investors about what they're expecting to see come through the road. So we're just kind of seeing some companies going through some growing pains. Beyond Meat's kind of another example a few years later, taking some impact as well.
Do you think, Phil, to that point, do you think Rivian soon will start to display some of those growing pains? I mean, they're barely producing any cars. Over the past 2.5 years, they've lost more than $2 billion, yet the stock, just ripped higher out of the gate. I think it's up about 63% since its IPO price.
Yeah, I would have said at the IPO price, Rivian was priced to perfection. And now I would say that Rivian is now priced beyond perfection. This is a company that has not really sold many cars at all on the road, is expecting to sell, call it a couple 100,000 to 500,000 cars in 2025. A lot of things are going to have to go incredibly well for Rivian to be able to do that, to grow into this valuation. And that takes into account the fact that there's also growing competition from legacy car makers that are kind of taking a bite out of Tesla's market share. You've got Lucid Motors. It's a really competitive space. So it's really hard to make sense of a company at $113 billion valuation that's going to do about $1 million of revenue this year. It's kind of, it blows my mind. It kind of seems like maybe this is one of those key market points in the market where people start to take a step back and scratch their heads a little bit.
So Phil, as we mentioned, your platform is for pre-IPO companies, and I'm curious what trends you've been seeing in that space as well. And in general, have you been seeing increasing interest there? If so, what do you think is driving all of that?
Yeah, so at Equities End, we've been really fortunate. We've seen our business basically triple in size over the last 12 months. We've seen investor demand go through the roof. We've seen shareholders continue to come. One of the leading indicators for Equities End is that as more and more capital gets raised by these companies while they're private, so from venture capitalists and growth equity investors, that just means that the market cap of these private companies is also growing, which means that there are more and more people looking for liquidity and more investors looking to access it. So we've kind of seen a rising tide lift all boats. We've seen successful IPOs. We've seen SPACs also take companies out. So it's really kind of been a perfect storm for us. We're just trying to kind of keep up with it. I would expect that, as you see valuations continue to get higher and higher as far as revenue multiples go, investors might start to say, are things getting a little bit overpriced here? But in the current environment, we've been able to match a lot of buyers and sellers in our space.
Yeah, it's sort of hard to imagine a year from now that some of this won't get flushed out and washed out of the system, right?
Yeah. I think what's very interesting for me is that within the private market space, there's far less visibility into how companies are doing and transparency. So when companies inevitably come public, we can kind of see that they actually are not growing the rate that they said they were, or that they're losing a lot more money than people expected. So what we don't have right now in 2020 and 2021's investment environment is that all these companies that raise private capital, it's kind of hard to know really how they've been performing as much. 2022, if you start to see some more companies come public, I think the rubber is going to meet the road a little bit. But it doesn't seem sustainable that, an environment where we're concerned about inflation and supply chain breakdowns, that all these companies can really be successful. There's just so much cash chasing after, a certain set of companies.
Yes, thirsty cash, I like to call it. Phil, good to see you. Phil Hazlitt, Equities End co-founder and Chief Revenue Officer. Thanks for being here. Appreciate it. Coming up next, why aren't people working? Our Brian Chung got a clue from a new Goldman Sachs note. It's all about anti-work. The Trump Hotel brand will be departing Washington, D.C. after the company sold the rights to its historic Pennsylvania Avenue location for $375 million. According to the Wall Street Journal, Miami-based investment firm CGI Merchant Group is in contract to acquire that lease. The property will be managed by Hilton and will be branded by Hilton's Waldorf Astoria Group. That historic building sits just a few blocks from the White House and is leased from the U.S. government. Before it was a hotel, the location served as the U.S. Post Office Department headquarters, and during the Trump presidency, it was sometimes criticized for conflicts of interest. Japan's economy contracted in the last quarter as COVID-19 and supply chain disruptions slowed down the global economic recovery. The country's economy shrank by 0.8% in the third quarter. That was more deeply than expected as global supply disruptions hit exports and business spending plans. This in addition to the rise in COVID-19 cases this summer in Japan, and that led to emergency soft lockdown measures in Tokyo and other regions. And a Southwest Airlines employee in Texas was hospitalized after she was hit in the head by a passenger while boarding a New York City-bound flight. After boarding the plane, a female passenger got in a verbal confrontation with an employee and was asked to leave the plane. But as the passenger was deboarding, she confronted the employee again and then hit her. Dallas police arrested the passenger and charged her with aggravated assault. This comes as the FAA announced on November 9th there have been more than 5,000 incidents of unruly passengers on flights this year. And Brian Sazi, that might mean it's a tough sell for the airlines to hire flight attendants, which seems to point to a larger theme in the workforce right now.
Yeah, you do not want to get attacked at any point on your job, and of course that applies to the airline sector as well. But those challenging labor market conditions may reflect what Goldman Sachs is calling a shift toward anti-work. Yahoo Finance's Brian Chung has been digging into this one and joins us now. Brian, good to see you working. Clearly, you are not leading this anti-work movement, but what is Goldman Sachs talking about here?
Yeah, well, really interesting labor dynamics here when you consider that since the beginning of the pandemic, about 5 million people have exited the labor force. Now, a large chunk of that is just because of those over 55 retiring early or just naturally retiring, which means that there's kind of a 1.7 million, let's call it, a group of people that we need to look at in terms of trying to get them back into the labor force because they might be willing to do so. But there's this movement that Goldman Sachs pointed to in a note last week for anti-work, which could present some longer run challenges to increasing labor force participation. I want to show you this chart from Goldman Sachs, which illustrates how anti-work apparently has been catching more attention on Reddit than even the "Are Wall Street Bets" thread of that GameStop mania fame of earlier this year. In terms of comments, actually, over the last few weeks, this anti-work thread has been more popular than the Wall Street Bets thread. Now, what's inside of this Reddit thread? Mostly anecdotes of people, much like that flight attendant story that Julie was just talking about, harassment from customers or clients or mistreatment by managers. And the common thread in that subreddit is really about the idea of trying to find better work, or in many cases, deciding to leave the labor force entirely. So Goldman Sachs, in a quote, saying, "We see some risk that some workers will elect to remain out of the labor force for longer, provided they can afford to do so." When you take a look at that JOLTS data, which we got last week, verifying that indeed we saw a record amount of quits in the month of September, 4.4 million people deciding to leave the labor force. That does spell indeed a very interesting labor market dynamic for these workers who could choose if they wanted to leave their jobs. Now, of course, whether or not this is a longer run trend remains to be an open question. When you take a look at labor force participation numbers, notice that we've been struggling to get above 62%, guys.
And we talked earlier to Ian Siegel of ZipRecruiter about all of these dynamics and the challenges that employers are having finding workers right now. He also talked about one of the reasons why.
55% of job seekers are looking for a job that allows them to work remotely. Again, during the pandemic, people discovered a new, more satisfying way to live. It's the #1 perk that employers are offering on ZipRecruiter. 2 years ago, less than 2% of jobs mentioned remote work. Now more than 10% of jobs mention remote work. Those companies that are offering remote opportunities are experiencing the most success in recruiting. However, only about 40% of the jobs in America can be done remotely, which presents a really interesting question about what's going to have to happen to wages or benefits or perks for those jobs that require face-to-face interaction on a daily basis with the public.
And so what he's talking about is effectively that something has to give here, right? Like you can't stay out of work forever, and employers need people. So, it seems like this is going to, like, you can't be anti-work permanently. So it seems like somehow this is going to eventually resolve itself, right?
Yeah. Well, the operative word in the Goldman Sachs note was that this will be a trend of anti-work if people can afford to do so. And
Right.
that's certainly not going to be the case for a lot of these low-wage workers who we know have been more disproportionately impacted by the pandemic-related layoffs and then the post-COVID recovery concerns that have kept them on the sidelines. So really this anti-work, and Goldman Sachs note didn't really get into the anti-work thesis is likely only going to apply to those kind of in the middle wage spectrum, or actually higher to middle wage spectrum, who can have that nest egg to rely on to not be able to work here. Now, of course, the type of longer run concerns here, it is all still playing out. And I think that the jury is still very much going to be out over the next few months or even years to figure out what the actual structural damage is to the labor market, not just from anti-work movements, but also, for example, for women, the impact of childcare and whether or not the need to be at home with kids who aren't going to school as often or have virtual setups, whether or not that's keeping them from going back into the labor force. So this is just kind of one facet that Goldman Sachs is pointing out. It's an interesting one, but the jury is out on the extent and the magnitude by which this anti-work movement, or Reddit at large, is impacting the labor market, of course.
Yeah, just one more quick comment on this, which is that having lived, although a long time ago, in Europe, this kind of attitude is much more prevalent there. However, the social safety net is much more broad and deep in Europe than it is here in the U.S. In other words, people can afford to not work for a much longer period of time. So I'm not sure that that model is transferable, but I guess we'll have to see.
Brian Chung, working hard since 1993. We'll check back with you later. Coming up, you've heard about how companies like Starbucks are embracing NFTs. But now non-fungible tokens are being used for luxury items and even real estate transactions. Crypto correspondent Jennifer Schonberger joins us next on all that.
You're perhaps not using crypto or Bitcoin to buy your pizza, but it is being used for an increasing number of items like NFTs, for example. But what about luxury transactions or large ticket transactions like real estate? That's something that Yahoo Finance's Jennifer Schonberger has been looking into, and that actually does seem to be happening.
Hey, good morning, Julie. Yeah, crypto is being used more and more for real estate transactions. In fact, the very first commercial real estate property has been put on the market in New York for Bitcoin. Magnum Real Estate Group is selling 3 retail condos, complete with a fully rented out retail bottom floor in Manhattan's Upper East Side for $29 million, but they're only accepting Bitcoin. And while it's the first commercial property listing for Bitcoin, we've seen real estate transactions in crypto on the residential side picking up the past few years. Bill Zelke, CMO of BitPay, a cryptocurrency payment processor that's processing the real estate transaction for Magnum, says that the payment processor has been handling crypto real estate transactions the past few years for international buyers, and more recently in the U.S. for ski homes in the Western U.S. and properties in New York. Before listing its commercial property, Magnum Real Estate did 3 residential deals for Bitcoin, including one on the Upper East Side for more than $15 million in Bitcoin. Ben Shaul, the managing partner of Magnum Real Estate, says he expects transactions in crypto to continue to grow.
I see the runway for transactions with crypto only increasing exponentially. The fact that Bitcoin is at record highs, obviously helps. But I think also investors are investors, and they've done very, very well owning Bitcoin, and now they're looking for cash flowing assets.
And as the price of Bitcoin has continued to skyrocket along with other cryptocurrencies, there is a correlation between those record highs and the demand for real estate from investors. So as Shaul mentioned, we should expect the crypto transaction part of the real estate market to continue to grow in the coming years. Julie?
But of course, whenever I hear about this stuff, the price moves so much. Like, how do you decide how much Bitcoin is going to be transacted? Like, when is what happens if you decide you're going to buy this apartment in Bitcoin and then the price moves big? Like, I don't know. How do you figure all that out?
Yeah, I mean, I guess it really does, like you said, it does depend on the price. But if you've amassed enough of a fortune and you feel like you want to cash out and you want to deploy that into another cash flow asset, whether it's an investment or it's, where you actually want to live, then you're able to transfer that. And by the way, it's very interesting because when you deal in Bitcoin or crypto, the settlement process is incrementally faster. It settles the next day instead of taking 30 to 90 days to try to settle this transaction. So I guess if you're in a hurry or you're an international buyer or investor, this certainly eases the payment process as well.
Maybe so. All right, we're going to count on you to keep us posted on this trend, this burgeoning trend. And in the meantime, we're going to take a quick break. When we come back, we are seeing markets now turn mixed here. The Nasdaq down slightly, but weed stocks are on the move. We're going to talk about that in a moment.
Welcome back to Yahoo Finance Live. We're keeping an eye on cannabis stocks, as Julie mentioned before we headed to break. According to Business Insider, Representative Nancy Mace, a freshman Republican from South Carolina, is set to introduce a bill that would federally decriminalize cannabis. We are seeing some mixed action here, Julie. What I thought when I saw this news cross our Slack channel moments ago, we would have seen a little more positive reactions, but we're seeing some more mixed reactions.
Well, it seems like, I don't know how much juice Nancy Mace has, so maybe that's part of it. There are still definitely, there is still substantial opposition within the Republican Party to doing a bill like this. So perhaps there's not just that confidence that something like this is going to end up getting through, even if the drumbeat is pushing towards decriminalization or legalization, or maybe it's the fact that it's just decriminalization and not outright legalization, perhaps, that is part of the lack of enthusiasm here. Who knows? But as you said, we're seeing a mixed picture on these stocks.
Yeah, and also too, all morning long, we continue to watch Gore's Guggenheim, Julie. That is that electric vehicle SPAC that is supposed to merge with electric vehicle Polestar maker in several months from now, but it looks like it just got wrapped up in the Rivian trade.
Yeah, there's a lot of there's enthusiasm to spare in that group, that's for sure. And Gore's Guggenheim's the top trending ticker on Yahoo Finance right now. So obviously a lot of people interested in that. We just talked to Phil Haslett before of Equities, and sounds like there's still a lot of enthusiasm out there for these guys.
I like what Phil said, though, Julie, on Rivian being priced for perfection before it came to market. Now it's really, really priced for perfection. I think Phil is on the mark there. You have to think that they're going to have struggles just like Tesla as they were trying to grow into their name as well. But do stick around. Much more ahead on Yahoo Finance Live. Markets, downgrades, upgrades, you name it. We'll be right back.
Welcome back to Yahoo Finance Live. I'm Jared Blickery, along with Emily McCormick. We're in for Akiko Fujita and Zach Guzman, who are on assignment. Let's get a quick check of the markets, where we see kind of a mixed market right here. Seeing the Dow up about 94 points, just shy of 100. S&P 500 just barely green, up about 0.1%. Nasdaq down slightly. The Russell 2000 not shown, down about 0.33%. Stocks jump as President Biden is set to ink the big infrastructure bill today ahead of a pivotal meeting with President Xi Jinping. How stocks are reacting to the historic measures. Plus, Tesla slips after Elon Musk hints he's not done selling and gets brazen with Bernie on Twitter. Ross Gerber of Gerber Kawasaki stops by to talk all things Tesla. And the earnings parade marches on with the consumer in focus this week. WeWork is jumping after a better than feared $800 million loss, and Tyson Foods getting a pop off of surging meat prices. Guess who's paying for that? But we want to bring in Yahoo Finance's Jessica Smith to give us all the details of the Rebuilding America plan. And Jess, what are some of the details of this package, and what can we expect at 3 p.m. today? Biden kind of taking a bit of a victory lap here. Well, it looks like we're going to have to take this back. And Emily, let's do this, Emily. Let's bring in our guest, Naveen Nayak, Center for American Progress Action Fund President and Executive Director. Naveen, what should we expect from this infrastructure bill signing today? How pivotal is it?
I mean, I think it's actually a really, really big day for the country overall. Certainly a big day for the president and this administration politically, but we haven't made these kinds of investments in our economy for, in some cases, decades, in some cases, ever. We're seeing the largest investments in public transit. We're seeing a huge investment in broadband to actually ensure that every American has access to affordable, high-speed internet. So I think that, to be honest, like these are the sorts of investments that both business, labor, nonprofit sector has been pushing for decades. And I think it's exactly the kind of thing that President Biden sort of promised, right? He promised when he ran that he would make Washington work again, that he would find common ground with Republicans. And that's really what he's able to do with this bill. So I think it's a pretty encouraging step forward for the economy and the country overall.
Naveen, this is Emily McCormick here. I'm wondering, once the ink is dry on this legislation this afternoon, how soon should the American public be ready to start seeing some of these changes and some of these spending actually get implemented into the economy?
Yeah, I mean, I think some of these things are longer term investments. These aren't going to be sort of the shot in the arm that a lot of Americans saw with the American Rescue Plan, literally getting vaccines in people's arms, but also checks in bank accounts. But I think we're going to, I think the administration appreciates the urgency of starting to move this money out the door. They announced yesterday that former Mayor Mitch Landrieu will be overseeing these investments and making sure that we're being efficient and thoughtful and expeditious. So, a lot of these things have been on hold for a decade or longer. So I don't think they're going to waste any time. But I don't know that, people's airports are going to be fixed overnight, obviously, or that we're going to see the challenges with our infrastructure writ large, but I think you'll see the process start. And I think there's a real story here about America investing in ourselves. And that's something we haven't really done for a long time.
I just want to shift gears a little bit here. President Biden is set to meet with President Xi Jinping virtually later this evening after the signing ceremony, and really talking about a little bit of animosity between the two countries. The administration calling the Xi Jinping regime intense competition, and but both sides are trying to prevent conflict here. So what should we expect from this meeting?
I mean, I think there's a wide range of issues, obviously, that are going to be on the table. I think over the last couple of weeks, it was encouraging from the perspective, at least climate, that the two countries were able to set aside differences, and a real win for the planet, and certainly for the Biden administration to be able to work directly with China to make progress on that front. And unfortunately, I'm not sure that we're going to see the same sort of ability to collaborate on a whole host of other issues, obviously from human rights issues to other pressing economic challenges. So I think it's encouraging that there is a conversation moving forward. I don't know that there's the same level of optimism for some of the challenges being able to be resolved in one conversation.
Right. And Naveen, going back to the infrastructure bill, of course, one of the things that the Biden administration has been talking about is that this spending is actually going to alleviate some of the inflationary pressures we've been seeing in the economy because of supply bottlenecks that have in part been because of port congestion and other infrastructure concerns here. What do you think about this argument? And do you see this additional $550 billion in spending contributing further to some of these inflationary pressures?
I think there's not a lot of concern about this bill or even the Build Back Better bill, which Congress is still considering adding to inflation. I think a lot of economists have agreed that if anything, over the long haul, these are going to be really important for reducing inflation for the reasons you mentioned specifically, which are solving some of the bottlenecks in our transportation, in our ports, in our airports, the infrastructure problems we know. And I think in the short term also, both of these bills are paid for. And I think unlike the American Rescue Plan, which injected 1.9 trillion in roughly a year and wasn't paid for, I think we're seeing these investments intentionally be longer term, over 10 years, and be fully paid for. And so I don't think we have to worry about the sort of concerns around inflation. And if anything, and I think this is really important to the American people, these bills are really about trying to reduce a lot of the cost challenges that Americans face every day, and particularly with the Build Back Better Act. We're talking about reducing really painful expenses for Americans, whether that's childcare, energy costs, prescription drug costs. And so in the long run, these are going to be a huge benefit for the American people.
And then with the Build Back Better Act, on the timing front, I'm just wondering, the infrastructure bill, that gets signed today, but we're getting towards the end of the year. And I'm just wondering, because President Biden, his approval ratings are, I believe right now, the lowest of his administration, of his term so far, but these are very popular bills. I'm just wondering, is it possible that they've lost some momentum? And what is the possible timeline for getting the Build Back Better Act passed?
That's a great question. I think the first step this week that's going to be really critical is that the House is set to have a vote on it, and I think it's crucial that Democrats in the House are able to move the bill forward. And then I think we've got the last few weeks of the year to make sure that the Senate passes this. But so I think that the likelihood is still really high. And I think for the Biden administration, it's not just about their approval ratings, but they are laying out a really different vision for how you build a strong economy in this country, right? We've spent 40 years building the economy dramatically, mostly at the expense of working people, by providing tax cuts to the wealthy, by cutting regulations. Build Back Better Act and the infrastructure bill are a new vision for the economy that are about investing in working people by actually ensuring that people can afford a middle-class life, whether that's by lowering costs or by ensuring that their wages are going up. And I think for that reason, in the end, Democrats will find the votes to get both of these bills done. And I think that is going to be a real boon to Biden's politics as well, and for Democrats moving forward.
Naveen, we appreciate your insights and your time for stopping by. Naveen Nayak, Center for American Progress Action Fund President and Executive Director. Emily, it is time for some earnings, and first up on my plate, I got WeWork, and I'm looking at the Wi-Fi Interactive. This is a chart. It's a 1-month chart, so it goes back to its its first trading date, and not looking the best here. I mean, down 20%, pretty much more off of those highs. What's inside the earnings report, though?
Well, Jared, if we take a look at how the stock is trading today, of course, we are getting a little bit of an uptick here, although, as you mentioned, still down over the course of the past month or so since its SPAC merger to go public in October. But taking a look broadly at the third quarter here for WeWork, losses narrowed compared to last year, but we did see revenue fall on a year-over-year basis, albeit while improving on a sequential basis compared to the second quarter. So looking at some of these numbers specifically here, revenue was down by 18.5% on a year-over-year basis to reach $661 million. Again, though, this did increase from the $593 million we saw in the second quarter. And WeWork also called out that revenue in September specifically was at $230 million to mark a fifth consecutive month of revenue growth and its highest monthly revenue recorded in 2021. So, Jared, of course, it's really a tough time to be in the office leasing space, given the continued trend towards working from home and the remote work environment here. But WeWork at least showing some improving trends compared to what we saw at the same time last year, and of course, even before that in 2019 when the company had its first failed attempt to go public here. Then one other stock that I want to highlight, switching gears a little bit here as well, Jared, in terms of some post-earnings results, a different story here for Oatly, seeing the stock taking a major turn lower this morning here. That stock is off more than 18%, and that's after the company missed on third quarter revenue and cut its full year forecast here. Now, this is also a very recently public company. It just had its IPO in May, and it posted revenue of $171.1 million for the third quarter, whereas the estimate was for $185.7 million. And then in terms of that forecast, Oatly now sees revenue coming in at above $635 million for the full year. Previously, it saw revenue up above $690 million. And this company has definitely been one that's been dealing with supply chain issues, both domestically as well as abroad. Of course, commodity costs and these input costs have been rising for Oatly as well. We saw a nearly 150% increase in oat prices in late October itself here, Jared. So really seeing a lot of pressure on the price side and the cost side for Oatly that had been impacting results. But I know you have your eye as well on a couple of companies that are making some major moves today, Jared. What are those?
Yeah, I'm looking at Tyson Foods, and of course, the country's biggest meat processor, especially when it comes to poultry, in focus for investors here. And guess what? Not a surprise, but prices are in focus, especially with regard to the labor market. So they're having a difficult time not only finding workers, but also I guess, cheap supplies here. So they are, in fact, passing on these prices to the consumer. And I have a note here from Bloomberg saying that sales volume of beef, pork, and chicken, they each dropped sharply during the fiscal fourth quarter, with the decline partially tied to one fewer week in the quarter compared to 2020. So we got that. But demand remains strong, even as higher costs, including labor and freight, raised meat prices. So kind of getting it on all fronts there. I do have a quote from the CEO, Donnie King, saying, "We delivered a record performance in our beef segment and experienced share gains in our retail core business lines." And just looking at the performance of the stock here, as you can see on your screen, up 30% year to date. And we've seen a number of staples come back recently. People still need things to buy and eat, and they're paying the elevated prices. So another stock I'm also taking a look at today is Warner Music Group. And this is a stock that I think it was making headlines a few months ago when Bill Ackman was trying to use his SPAC to make an investment. But nevertheless, this is a stock that's up 56% over the trailing year, down 5% today. I do have some I have some street comments. Here's Vital Knowledge saying the headline numbers are okay, although investors have come to expect upside when WMG reports, adding that digital revenue growth that decelerated sharply to 19% from the 29% in the previous quarter. So I think, Emily, this is kind of one of the stories that at this stage in the recovery, you have a Pinterest. They report they're down 20-25%. Here's Warner Music Group, disappointing, not to the same degree, but a lot of these high-flying stocks, I think, we really just have to keep our eye on. So I want to shift gears now because CrowdStrike is also on my radar. And let's see if we can get that stock up as well on my trending tickers list. And this is a stock that was downgraded by Morgan Stanley. They're rating it, actually initiating coverage at an underweight. And here's CrowdStrike on the Wi-Fi Interactive. You can see up 90% over the trailing year. So a little bit of wind being taken out of its sails right now. But this is one of those high growth, high moving stocks. The analyst's writing now. After several years of quick growth, CrowdStrike faces more competitive next-gen endpoint detection and response alternatives that are narrowing the functionality gap and offering lower price points. This makes sustaining the current pace of share gains more difficult and brings uncertainty on the pace of top-line deceleration through 2022. Emily.
Well, Jared, we've been talking a lot about inflation for good reason. We saw that last week's consumer price index showed the biggest annual rise in consumer prices in more than 30 years. But Minneapolis Federal Reserve President Neil Kashkari said the Fed should be careful not to overreact to inflation. We'll discuss on the other side of this break. Inflation continues to be top of mind for many investors, and last week's consumer price index jumped by the most in over 30 years in October compared to the same month last year. But at least one regional Fed president is saying the Federal Reserve should not overreact to elevated inflation. We're bringing in Yahoo Finance Fed correspondent Brian Chung for more. And Brian, yesterday, Minneapolis Fed President Neil Kashkari, who we should note is not a voting member of this year's FOMC, did seem to double down on this notion that current levels of inflation will be transitory. What else did Kashkari have to say, and how prevalent is his view among members of the FOMC?
Well, in terms of policy, what Kashkari was saying was that the Federal Reserve shouldn't move to tighten just because you got one hot print on the consumer price index, as you mentioned, that reading that we got on a year-over-year basis, clocking in the fastest that we've seen in about 3 decades. But in an interview with CBS, I believe it was, he said that his view is to, quote, not overreact to some of these temporary factors, even though the pain is real. And this is a talking point that we've heard the Fed chairman Jerome Powell himself use as well, with the Federal Reserve insisting earlier in the year that inflationary pressures were going to be high and maybe eye-poppingly high, but that they would eventually abate. Obviously, now we're many months, almost a year into high inflation readings. That's testing the resolve of Federal Reserve officials to insist that these types of things are transitory. Now, Kashkari added that he feels like these high inflation prints will likely last through the next few months. And in fact, other Fed officials have said we should expect to see hot inflationary prints through even the beginning of next year. But of course, the transitory view, at least for now, still remains the prevailing thesis for the Federal Reserve, which has insisted it can continue to keep interest rates at near zero, at least through the beginning or the middle of next year.
And Brian, we're also awaiting official word from President Joe Biden over who will be his pick for the next Federal Reserve chair. What do we know so far about how that decision is shaping up?
Well, based off of the chatter that we've heard so far, it really is a horse race, at least for the Fed chair spot, the top spot at the central bank, between two people. That's incumbent Fed Chairman Jay Powell and then existing Fed Governor Lael Brainerd. Now, both of them did reportedly visit the White House, but we have to remember it's November 15th now. We are way behind schedule when it comes to previous Fed chair announcements. Here's a little bit of history for you. If you rewind to the Bush administration, they had announced their pick of Ben Bernanke as soon as the later part of October. Actually, in 2009, Obama, when he nominated Bernanke for a second term, did it as early as the end of August. And then October was when Obama picked Janet Yellen. And then the Trump administration announced that Powell was going to be their pick in early November of 2017, which by standards at that time seemed to be pretty late. Obviously, the Biden administration now making a name for itself as being even later than that. I want to also emphasize we haven't even heard any sort of teasing from the White House about an announcement coming at any point in time. Recall that the Trump administration actually released a trailer for their Fed chair nomination announcement. The president, of course, at the time, using Twitter to tease his Fed chair announcement a few days before that November 2nd announcement. We're not getting anything from the Biden administration in terms of timing. But again, headed towards the Thanksgiving break for Congress, who the Senate would have to approve any pick that they have. So it seems like they don't have much time to get an announcement out there.
Yes, Brian, almost weird to contemplate that it's been over a year that we haven't had the pageantry of the Trump administration and their press releases. But I want to take a step back here, Brian, because we got another minute or so. And in your perusal and your interviews with these various Fed officials, are you seeing any kind of change in language? I know that at the FOMC, when they drop their announcement, their decision, you can perform a red line version and see what they're thinking there. But I'm just wondering, in this context of the speeches and everything else, is there some kind of trend that you can identify?
Maybe a little bit. I mean, for right now, as I kind of emphasized with the remarks about Minneapolis Fed President Neil Kashkari, they're still leaning on the T word, transitory, and that's codified in the FOMC policy statement. It's the official statement of the voting member committee that they feel that these inflationary pressures will at some point abate. But there's an admission, and a pretty clear admission among all these Fed officials, that the transitory argument is definitely being tested at a level of stress that they had not anticipated when they first started using the T word in the spring of this year. And what you're starting to see is people still use the T word, but kind of slowly hedge their bets here. Consider, for example, Atlanta Fed President Raphael Bostic, who talked about the idea of, at the Federal Reserve Bank of Atlanta, which he heads, putting $1 into a jar every time someone uses the T word, just to be mindful of the proper application of that word. Now, of course, this doesn't mean that they're necessarily balking on their use of the T word, but if these inflationary pressures do start to last through the beginning of next year, do you start to see some of these hawks fall out of using the T word and say, look, I think this is going to be permanent. We have to be more aggressive with our policy and removing this accommodation. That will be a very interesting thing to watch as we get into the early months of next year.
Yeah, I got to tell you, Brian, when we get back in the office, I'm going to set up a few different jars, and it's not going to be for transitory or anything bad. We're going to have a little fun there. Yahoo Finance's Brian Chung, thanks for stopping by, as always. Coming up after the break, Oatly, ouch, down another 20% here. We're going to talk about it with a Cowen analyst.
Oat milk maker Oatly delivered a disappointing third quarter report and full year guidance earlier this morning as virus-related restrictions and supply chain issues weighed on results. The stock is down nearly 20% this morning following that report. We're welcoming into the stream Cowen senior analyst Brian Holland for more. And Brian, thank you so much for being here this morning. Investors definitely not liking what they're seeing from Oatly's results, judging by the price action here. What was your takeaway from this report?
Yeah, so I think definitely disappointing, but also transitory. I think what the market's responding to is obviously the Q3 miss. Although I would argue that folks were anticipating that. We were getting reads on that from other oat milk producers, as well as Starbucks leaning on secondary sources of supply, as they intimated a few weeks ago. But I think you compound that with the lower revised guide, which folks maybe weren't expecting at this magnitude. And I think that's what's weighing on the stock here today.
Well, and just going through your the report here, I'm seeing the notes. Basically, so the results driven by higher logistics, increased container rates, unfavorable channel mix shift, and short-term challenges related to scaling capacity at the Ogden facility. It just seems like everything's getting more expensive. And if it is a transitory, as you're talking about, where's the inflection point? Is it the current quarter? We have to wait a few?
Well, so a couple of things. One, the issues that you outlined are on the cost side. I think the market is more sensitive at this point to the revenue aspects of this. But so on the revenue aspects of this, a couple of things. One, we're going to reset here after this quarter. Obviously, they guided down. You would expect estimates across consensus to come down here over the next 12 months. So I think resetting expectations is going to help here in the near term. I think obviously the capacity dynamic, that's something that's ongoing. So I think with each passing quarter that they can demonstrate that they are able to add capacity as promised, would certainly help the stock. On the cost side, I think the cost side is going to be with us here for the next 6 to 12 months, and that's not just an Oatly issue, that's across the industry. For Oatly, really the problem here is, this is a perfect storm. Coming public and executing a global capacity expansion initiative concurrently across several markets in this current macro, obviously pretty unfortunate timing for that, as increasingly difficult to execute.
And Brian, just going through these results here, one other thing I noticed was in terms of channel, we saw food service actually grow compared to last year as a share of revenue, while retail shrank a little bit. As we continue to move through this pandemic environment, this global supply chain environment, where do you see most of the growth for this company coming from? Is it going to be from retail, or is it going to be from that food service channel?
Yeah, I think it's going to come from the retail channel ultimately. Food service will generate trial as it has. Obviously, it's working off of a smaller base. But again, Oatly's biggest limiting factor to growth right now is its ability to generate and push out supply, given the capacity constraints. If you look at the retail metrics, the velocity is extremely strong. Their velocity is extremely strong, which is the strongest level of demand when you look at that retail data. So I think as they can put more product into the stores, the volume will follow, and that's ultimately what will drive the growth. Food service is certainly encouraging. I think it's an early indicator of how wide spread and how strong demand is right now, especially given the traffic issues within food service amidst the Delta variant.
I'm wondering what you think about the current loss of momentum, how challenging that's going to be to recover from. Kind of gives competitors who are able to execute in this environment a leg up, and we see this across all kinds of industries. Is Oatly still going to be competitive?
Yeah, I think so. If you look at it, it's a great point. If you look at the data right now, as of, for instance, the scanner data that we look at here bi-monthly, in the latest 4-week period, Chobani and Danone both took share. But important to note that half of the volume that they sold came on promotion. So they're clearly taking advantage, as you alluded to Oatly's inability to put product on shelf. That's the one side of it. That's the near-term dynamic. I think if you take a step back, like I said, velocity for Oatly, much stronger than everybody else. That's on very little promotion. So as they're able to put product in store, they'll be able to promote more, they'll be more competitive. But the velocity is really the strong indicator that consumers favor their product And so as they can get more product into the store, they're going to move it. As sort of an interesting way to look at this, their dollar share of the category is 2x their share of shelf, how much product they have versus all the oat milk SKUs that sit on shelf. That typically demands more shelf space. So basically, Oatly is leaving revenue on the table with their inability to supply. As that improves, and again, these are the transitory issues. You'd much rather be in this situation right now where this is a supply issue rather than a demand issue.
And we'll have to see how this all shakes out. Ross Gerber, thank you for stopping by. Excuse me. So I'm getting ahead of myself here. Brian Holland, Cowen senior analyst. After the break, we're going to talk Tesla with Ross Gerber. And guess what? The market cap now sinking below that $1 trillion mark after this. Welcome back to Yahoo Finance Live. Tesla no longer in the comma club. The market value, the market cap falling below $1 trillion. Once again, stock down 4% today, off 20% from its record high only a few weeks ago, but don't call it a bear market. And we want to talk to Ross Gerber now of Gerber Kawasaki Wealth and Investment Management. He is the CEO there. Ross, good to talk with you today. How much of this decline that we've seen has to do with Elon Musk? I believe he's reportedly sold about $6.9 billion with more on the way.
Yeah, I mean, it's 100% Elon. You know, certainly the stock was very high priced and priced for perfection, and having the CEO dumping potentially 20 billion of stock puts a lot of supply out on the market, and we're seeing the market react as such. Not to mention he's done it in sort of a sloppy manner, you know, or a unique manner that is typical of Elon, which creates disruption, but it also creates opportunity for long-term shareholders. So we're kind of happy about it.
Ross, this is Emily here. Continuing on that point, we knew that Elon Musk was going to have to sell stock at some point to cover income taxes for exercising options that would otherwise be expiring next August. So why do you think there was all this volatility with the stock in response to that Twitter poll last week, in response to some of the other Twitter commentary he's been making recently, when this was in many ways a known outcome in the coming months?
Well, I think there's a bigger issue. You know, nothing with Elon is ever on the surface. There's a deeper issue that myself and Elon are concerned about, which is socialism in this country and the attacking of entrepreneurs, and sort of painting everybody with this brush that we're not paying our fair share. You know, I pay a 53% tax rate, so I find it incredibly insulting to have Biden saying I'm not paying my fair share. Now, in Elon's case, because he doesn't earn any income, there was a lot of criticism that he wasn't paying his fair share. So I think he's showing the effect on the capital markets. If there was something like a tax on capital, it would be devastating to the stock market to have founders across every business in America having to sell stock to pay Bernie Sanders' tax. So there's a bigger thing that Elon's showing, is that it's cost investors $200 billion for Elon to pay a few $1 billion in taxes. And it's an absurd system of taxation that we have today. And it's absurd for the Democrats to be attacking the most successful people in our society. If they're going to attack rich people, they should attack all these trustafarian kids and the kids who inherit all this money and never work a day. That, I think, is a reasonable attack, you know. But Elon, I mean, this is the innovator of our time, and he's frustrated. I get it.
Yeah, Ross, I think I have tremendous respect for Elon. I'm just wondering if he went a little bit too far over the edge with some of his ad hominems against Bernie Sanders. And, you know, it kind of gets back to what you were talking about before. You have this kind of hothead CEO, but then it provides investment opportunities. Does that mean that you like those dips when they happen so you can buy the stock?
Well, you know, I don't like getting the barrage of emails and messages from my clients who go into, oh, Elon's back at this again. And I said, no, he never stopped. You know, when you invest with Elon Musk, you're investing with Elon Musk. And if you're not comfortable with who he is, you shouldn't be an investor. He's made us a fortune, you know, literally fortunes. I think it's a volatile stock because you're investing with Elon, and I call it Elon risk. But it creates opportunities for people who can see through and see the point of what he's really trying to say. And so the fact that I felt like the stock was getting away from me and there was no way I could actually buy the stock at $12.50, now I see it at less than 1,000. If I'm an investor, I'm pretty happy I get this opportunity at Tesla again, because they're about to have an amazing run in 2022. So the company's doing great.
Ross, you talked about this amazing run coming in 2022. Can you expand a little bit more on what you see as being the catalyst here for this company in the next year?
So what we're having right now is making me super happy. Is the tipping point for EVs has happened. And we've seen it with the Rivian IPO. We've seen it with Lucid's now delivering cars and how the stock has done. And now with Polestar up $3 today, as people figured out this is a great electric car maker here with Polestar GGPI. So when you look at what Tesla's done, is they've advanced sustainable transportation, which is their mission. And now the demand for EVs, even Ford's demand for the Mach-E is off the charts. And so like when you look at the demand for electric vehicles, while oil prices have soared and consumers are just getting gouged and complaining about inflation, which is all at the pump. And I'm like, you have a solution for inflation. It's an EV. So every Tesla is sold. And now we have the rental businesses going in and buying EVs. And what I've seen from the rental companies I've talked to is they're looking at buying every EV they can. And so we've got this confluence of demand and really a limited supply of vehicles. And Tesla is the king of this transition. So as they ramp production with the Gigafactory in Texas coming online next year, the demand for their vehicles is off the charts, and they're getting bigger and bigger margins as they increase prices.
So as this demand that you're seeing there for Teslas, you're not concerned that this deal with Hertz that hasn't been signed yet for 100,000 cars might just be a fleet deal that came a little bit too early. Elon Musk has maintained that it is totally a supply problem, not a demand one. I'm just wondering what you see kind of reading between the lines.
No. So there is no deal with Hertz, and there's not going to be a deal with Hertz. Hertz is just buying Tesla cars online. They have a team doing it now. They have cars that you can rent. They're running commercials on YouTube and full page ads in the paper advertising you can rent a Tesla. So they're buying cars. Now you can go on right now and try to buy a low end Model 3, and you just can't. They're sold out till next year sometime. So what we're seeing now is on the low end Teslas, they're all being bought by Hertz. And so you have to buy a long range model if you want to take delivery of a car. We're also seeing delivery of the Model X now, which we haven't seen all year. So with X and the Model S refresh now being delivered, plus higher margins on all their cars, plus all the advances they have with full self-driving, and the Gigafactory opening in Texas, I mean, how is Tesla not one of the most exciting companies in the world?
Well, I think that's why we talk about it multiple times per day. We're going to have to leave it there. But Ross, thank you for stopping by here. Ross Gerber, Gerber Kawasaki Wealth and Investment Management CEO. Coming up after the break, we got a conversation with Airbnb CEO. That's right, Brian Chesky, after this. Welcome back. A work and travel revolution is upon us, one that has fundamentally changed how people work and live amid the pandemic, at least according to Airbnb co-founder and CEO Brian Chesky, who recently spoke with Yahoo Finance. Well, let's take a listen.
Now that you can work via Zoom from home, CEOs are realizing they can get a lot of work done. There's lower cost. They can hire a more diverse talent pool, and employees like working from home. In fact, many of them are saying if they have to go back to an office 5 days a week, they're going to quit and go to a different job. So I think remote work is here to stay. If we believe Zoom is here to stay, then we must believe, I think, remote work's here to stay. If we believe remote work's here to stay, then I think what we're saying is that for tens of millions of people, maybe hundreds of millions of people, they're not as tethered to one location. So now they can travel nearly anywhere, nearly any time. And when they do travel, they can stay longer. And we are seeing this in our data. Mondays and Tuesdays are our fastest growing days of the week for families. When they can, they're extending their trips. We're seeing that people are going not just to the big hotspots. They've booked 100,000 destinations since the pandemic began on Airbnb, including 6,000 places for the first time ever. But the most important trend is this third trend. When people are traveling, they're staying longer. 1/5 of our business by room nights booked are monthly stays. That's not even travel. And that will probably continue to grow. So what it means is people aren't just traveling on Airbnb, they're now living on Airbnb. And this is because this newfound flexibility that's come from the pandemic. Again, if you believe Zoom's here to stay, if you believe remote work's here to stay, then I think you believe this flexibility is here to stay. And I think that will create one of the biggest changes of travel since the invention of the internet or the invention of the airplane. That to me is a revolution.
So, Brian, I think we all think that remote work is here to stay. The question is to what extent, right? I've been watching the teleworking numbers from the government really closely. And in October, only 11.6% of people, full-time workers in the US, were teleworking at some point during that prior month because of the pandemic. And that's down from something like more like a quarter of all workers. And so this is a number that has been trending downward. So I guess, how big do you think this trend is going to be? And at some point, aren't most people going to go back to an office?
No way. There's no way I think people are mostly going back to an office. Let's break these down. The largest companies in the world, PricewaterhouseCoopers, Amazon, Procter & Gamble, Ford, are just four that come to the top of my head, have announced permanent flexible policies for a large percent of their employees. Most CEOs have not forgotten the lesson of all the money they're going to save from the lack of real estate they need. And the fact is that if a company is only hiring people within 30 miles of their office, they're at a disadvantage of people can hire from anywhere. That's number one. Survey after survey, we've conducted surveys I've seen show that if people are forced to go back to the office 5 days a week, they're going to resign. I think it's part of the great resignation that we're seeing, is a great reevaluation of work. I don't believe that we're going to live in a world where everyone's nomadic and no one's ever gathering in person in real life. I sure hope not. That would be actually quite dystopian. It would be like us living in the movie WALL-E. But I don't think that we're all going back to an office 5 days a week. I don't even think we're all going back to an office 4 days a week. And all you have to believe is people aren't going back to the office 4 or 5 days a week to truly believe that everything is going to change. The last thing I'll just say is this moment right now is the worst technology will ever be in our lifetime. Wait till satellite internet is completely ubiquitous and everyone has high-speed internet. That camera technology improves, bandwidth constraints, screen technology improves. We have to project forward. I think we're living in a revolution of work. And so that's what I think. I'm going to go on record saying that. We can revisit this in a number of years, but I'm going to go in on the idea that flexibility is here to stay. But that doesn't mean everyone's nomadic. It's just they're not going back to 2019.
Gotcha. Well, I guess if we're going like WALL-E, maybe the next phase of technology will take us to Airbnbs in space. I don't know where all of those threads go. I'm just curious for you personally, how this is all playing out. I mean, obviously you're at home or in what looks like a home-like setting behind you.
I'm in my home.
Have you been traveling and working? Have you been going back to the office at all?
I've not been going. I've not gone back to the office. I think I went like once to do like a small little offsite, but I've not been back to the office and worked in 2 years or a year and a half. So let me break down. I'm in my San Francisco house. Last year, I spent a bunch of time living in New York. I intend to start to live I want to walk the talk and live anywhere. And so I'm probably going to go away and live somewhere else for the month of December, maybe even January, because I don't have to be in San Francisco. And as it gets cold, I think Mark Twain is the one who said the coldest winter I ever spent was a summer in San Francisco. So I might go somewhere else for a little bit of time as well. As far as going back to an office, I do hope we are going to all regather, but we're not going to go back 5 days a week or 4 days a week, probably not even 3 days a week. We're still figuring it out. We're not requiring people to come back to the office till next September, but even when we do, we're going to have to put out what our exact policy is. The trend I'm seeing is, you notice everyone said, oh, we're all come back to the office. Then it was hybrid. Now hybrid is becoming hybrid remote first with a lot of exceptions. Now manager discretion. Amazon said managers have discretion. I think you're going to see a world that's just going to keep trending to be more and more flexible. But I'll just say one last thing. Human connection in the real world matters. There are limits to what one can do digitally. And I do think this digitization of the world, though exciting, efficient, fast, has got a huge risk. Because then that's like the movie WALL-E. If we're all staring to screens, I don't think anyone's ever changed someone's mind in the YouTube comments section. I don't think offices should be only digital. I do think there's a reason why real human connection exists. But real human connection doesn't need to be in an office 3, 4, or 5 days a week. I think there's going to be other solutions that will be more sustainable to how people want to live in the future.
Brian, well, if you are traveling around this holiday season, is your place up for rental? Can I stay at it?
I would like to put my place up, and now that we have air cover, top to bottom protection, free for every host, I have a good reason to do it. So come on over.
What is air cover, Brian? Take us through that.
Great question.
I know
yeah, thank you. Thank you. I had to do my like kind of shameless like pitchman plug for a second because I had to get a little corporate for a second. But let me just say, this is a really important thing. We're seeing a record number of people wanting to become hosts. It makes sense why a lot of people are quitting their jobs, they're reevaluating their life, and they're realizing supplemental income is a really nice thing that gives you more optionality. But as we survey people and ask, why aren't you hosting? The biggest reason we got was people were afraid that something was going to happen to their house. And though incidents are incredibly rare, we wanted to try to take this risk off the table. So we now provide $1 million of personal liability insurance if a guest gets hurt. We provide $1 million of damage protection. We cover deep cleaning protection, pet damage protection. So we're trying to provide as much protection as possible. We call it air cover because we give you air cover. It's totally free, every single reservation, and we're the only ones that offer it. So I think this is going to help create a lot more hosts in the world.
Brian, totally free for hosts. Not free for you guys. What's the cost associated with air cover for you all? You did that big investment in marketing, and that's something that kind of comes and goes. Something like this doesn't come and go. Like once you spend this, you're always going to be spending it.
That's right. But the interesting point is this is an expense we've had for 10 years because 10 years ago we created the industry first Airbnb guarantee, which was a $50,000 guarantee. That became a $1 million guarantee. We've been paying for this for years. What air cover is built on top of this investment we made for the last 10 years. We've rebuilt the program top to bottom. It is incremental investment, but the vast majority of the cost we've already bared, and it's already in our P&L.
Brian, this comes at a good time, I imagine, as we have seen the travel ban lifted. What are you seeing in bookings right now? And then what are you seeing as we look toward next year?
Yeah, great question. So really interesting. When the pandemic hit, we lost 80% of our business in 8 weeks. And I think if you remember any headlines from April, a variety of headlines were like, is this the end of Airbnb? Will Airbnb exist? These were articles. We had a big rebound. The reason why was because people were traveling longer, they were staying nearby, and they were booking entire homes. That covered the gap of people that weren't crossing borders and they weren't traveling to cities. We are now, before borders had fully reopened in Q3, above 2019 levels. On October 15th, President Joe Biden announced that the U.S. borders would be reopened to international tourists starting November 8th, which was 2 days ago. That week, we saw a 44% increase in bookings on our platform for people coming to the United States. If that stat's any indication, I expect that all the benefit we've had from the pandemic will stay because flexibility is here and people are going to keep living in Airbnb. But we're going to now add cross-border travel in the mix. And I think that's going to be a huge boom to travel. That's my prediction.
That was Airbnb CEO Brian Chesky on the future of work and travel. And coming up, we'll get a check of today's markets with Yahoo Finance's Inez Ferre. But before we go to break, step up your investment strategy with a free 14-day trial for Yahoo Finance Plus. Get expert research reports, actionable investment ideas, advanced portfolio tools, and more in a sleek ad-light experience. Check it out today at yahoofinance.com/plus. Welcome back. Let's get a check of today's market action with Yahoo Finance's Inez Ferre. And Inez, it looks like stocks have lost some steam after opening higher. What are you watching as we head into afternoon trading?
Yeah, that's right. We have seen the S&P slip into red territory. We're looking at the Dow that's just barely hanging on to the green. That's because of Boeing. But just looking at the overall sector action and where we're at there, we're seeing utilities and consumer discretionary are under consumer discretionary is under pressure, materials under pressure, but you've got utilities and staples and communication services, which are still in green territory. Then also taking a look at the cannabis space. I was watching this space in the green today. This is after a report that Republicans may introduce a bill to legalize cannabis. And then just looking at the EV space, we're looking at Tesla down more than 4%, but also look at Lucid. Lucid is up more than 1%. This company will be reporting quarterly results after the bell today. Revenue is expected to come in at $1.25 million, very minimal as this company is still seen as a startup. Adjusted loss per share is expected to come in at 18 cents. And there are only 3 analysts which are covering this stock. There's 2 buys, 1 sell, and the target price average is $33 a share. But take a look, it's trading at $44 a share. Just goes to show you, emphasize the amount of money that's been flowing into the EV space. I also want to mention that Lucid Air was named 2022 Motor Trend Magazine's Car of the Year. Significant because it's a new product.
All right, Yahoo Finance's Inez Ferre, thank you so much for breaking that down for us. Coming up, we've got much more on the markets and a discussion with Stifel Nicolaus analyst Stanley Elliott on what the more than $1 trillion infrastructure bill means for stocks. That's on the other side of this short break. Welcome to Yahoo Finance Live this Monday, November 15th. I'm Emily McCormick with Jared Blickery, Zach Guzman, and Akiko Fujita are out on assignment. It's just after noon Eastern and stocks are trading mixed. Investors are awaiting some key economic data out later this week, including the Commerce Department's retail sales report, as well as earnings results from major retailers, including Walmart, Target, Home Depot, and Lowe's. Here are some other headlines we're watching for you this afternoon. Holiday sales are already on track to jump compared to last year. But how are inflation, supply chain issues, and out of stocks going to impact the holiday shopping season? We'll bring on Steve Sadov, MasterCard Senior Advisor and former Saks Chairman and CEO, to discuss. And the first Bitcoin update in 4 years has taken place just days after the cryptocurrency prices skyrocketed to new record highs. We'll discuss what the Bitcoin Taproot update means for investor privacy and for crypto price action with Yahoo Finance's David Hollerith later this hour. But first, we begin with a discussion of the U.S. infrastructure package. President Joe Biden is set to sign the about $1.2 trillion bill later this afternoon, which will include tens of billions of dollars each toward the country's electric grid, broadband, port infrastructure, and electric vehicles, among many other initiatives. And for more on this, we're bringing on Stifel Nicklaus analyst Stanley Elliott to discuss. Stanley, thank you so much for joining us this afternoon. We've been talking for the past couple of months about how the infrastructure deal will be impacting stocks in the industrials, materials, and electric vehicle industries. Do you see further upside for these areas of the market as this legislation gets signed and as the spending makes its way into the economy?
Yeah, listen, thank you very much for having me. And no doubt, I mean, what we're looking at here with this infrastructure bill is about $550 billion of incremental spending above and beyond what we would see as a normal run rate. So if you think about that, this is the largest increase that highways, streets, roads, bridges will have seen from the federal government in probably about 6 decades.
And I'm looking at the Wi-Fi Interactive here at some of the stock movements that we've seen in the infrastructure group here over the last month. This is a trailing 1 month, and a few names stick out here that I noticed crossed off on your list as well. Here we have Martin Marietta Materials. That's up nearly 50% year to date. Also, Summit Materials, that stock has more than doubled over the last year. Is it too late for some of these plays? Should people be waiting in right now, wait for the dip?
Now, I think that the opportunity here still looks quite attractive, right? Visibility is key for these names. These are stocks that typically do well in an inflationary environment, do have pricing power. So when we look into 2022, the non-res market, we think, will end up recurring and returning. But then when you start to think about 2023 and beyond, the amount of monies that are going to come in from this bill, we've got a run rate from the federal spending bill around $48 billion. And that's going to end up jumping to, say, $67, $68 billion per year just from the federal side, on top of what's been a very healthy state environment. So you're looking at a 40% sort of an increase on a run rate basis once these monies start to come together.
And I'm wondering, too, as investors try to ascertain, which of these players are going to be the biggest beneficiary directly from this increased government spending, what should investors be looking for? Is it companies that have large portions of their revenue coming from domestic sources? Or what are the other key points that investors should be homing in on to figure out who could be the long-term winners from some of this increased investment?
We think anything that has a utilization component, like a United Rentals, Will Scott Mobile Mini, those should end up boosting as well. Material names like Martin Marietta, Vulcan Materials, Summit, even Eagle Materials. What you're seeing is some of the industry groups are thinking that this bill alone will add low single-digit volume increases, both for aggregate demand as well as for cement. We've talked about the visibility being good for pricing, so we expect pricing strength to continue over the next several years. So all in all, anything that would go into developing these projects, we see should get a good lift from all of this. You put all this in perspective, I guess one more data point here is that the $550 billion, that's about a 7% increase from what you see on the September census data on the construction numbers, which is about 1.6 trillion. So we should have some nice runway here as we go forward.
And we've been talking about a lot of stocks here that are in the traditional, what we would consider the traditional infrastructure sector, talking about materials in particular. But also, I'm wondering, you take a look at, for instance, some of the clean energy stocks, the fuel providers for EV, they got a huge boost because there's $7.5 billion allocated for them in this. I'm just wondering, this touches so many different aspects. I'm wondering, what's the end game here? How should investors really be playing this if they want to be diversified?
Yeah, where we've done most of our focus has been on the machinery names and on the materials that go into those, and those are the names that we continue to see generally benefiting the most. In fact, that regardless of what sort of infrastructure you're talking about, whether it's the charging stations, or the roads themselves, they're all going to require materials. They're all going to require some component to help labor get involved and move forward. So we see that as a more of a broader range of way to play these names.
And as we look ahead, of course, the Build Back Better plan, that broader social and climate policy plan, still being debated in Congress right now. What sorts of policies are you ultimately expecting to come out of that? And how do you expect that additional potential investment here to be impacting some of these names as well?
Yeah, that's a little bit of a further reach than anything that we're seeing here within kind of this recent bill here today. So I hate to speculate. We hear mixed things about what could end up happening with that on Congress. But, as we're sitting here today, the bill that should be signed into law later this afternoon, we think will be good for a number of stocks within our coverage group. And we still see this as very early and what we think could be a refresh or an extension of a multi-year cycle.
All right, we'll leave it there for now. Stifel Nicklaus analyst Stanley Elliott, thank you so much for joining us. Well, we want to keep on the topic of the infrastructure bill, what's happening in Washington, D.C., and how all of this impacts markets with our next guest. George Mateo is Keep Private Bank Chief Investment Officer, and he joins us now. George, thank you so much for joining us this morning, or this afternoon rather. And I did want to ask just a little bit about today's market action here. We are seeing stocks trading a bit choppily. We're awaiting some new economic data and earnings reports. Seeing a little bit of movement here, though, in Treasury markets. That 10-year yield is moving quite a bit higher this afternoon. What do you see as being the big driver of the market action today and over the past couple of weeks?
Yeah, thanks for having me, first of all. It's nice to be with you. I think that the market's kind of going through a bit of a transition right now. We've kind of had this really rapid recovery off the bottom from essentially last spring or so, and we've had an epic decline, and we've kind of seen that kind of result in some epic policy measures taking place. Monetary policy was swift and massive. Fiscal policy has also been swift, and it continues, just as based on your prior guess. It looks like it's going to be signed into law today, and that really is a tailwind that could last many years, frankly. And then thirdly, the healthcare response has also been just remarkable. And now we're going through this period of time where we're kind of digesting some of that. Policymakers' actions probably created some distortions, frankly. One distortion we can point to the fact that during the pandemic, roughly 6% of American households lost jobs, but yet 86% of American households actually received some type of stimulus. So we're kind of working our way through that process right now. Some of these distortions are causing some concerns about inflation. Once they normalize, we think that the economy can actually still be quite resilient and really produce some really strong growth into next year and perhaps into 2023 as well.
And George, I want to get your take on what's been happening in the bond market and what that might be signaling about the Fed, because we've seen some big moves in yields to the upside, to the downside, and now to the upside again. I'm looking at the 5-year at the highest since, I believe, February or March of last year, of 2020. So, is the market trying to calculate, okay, the Fed is going to have a lower terminal interest rate that would be on the short side when we see the longer yield coming down, or is it in fact, are the market participants pricing in a sustained period of inflation where the Fed really doesn't act that aggressively?
I think what's interesting with respect to the Fed and inflation is that monetary policy and actually the economy are probably operating at two different speeds right now. So the economy is actually coming out of a really strong recovery, and we're still processing through some of those inflationary pressures that you mentioned. But at the same time, monetary policy hasn't caught up yet. So I think the bond market is repricing a bit of that catch up, if you will, and does expect that rates will probably have to come higher next year. But then next year is somewhat of an unknown in the sense that maybe in the second half of next year, as some of these inflationary pressures come off the boil, the Fed might actually have to be in a period of pausing. So I think we're in a really interesting transition right now with the Fed actually being a bit behind. We have to be very careful about policy error, that the Fed doesn't overdo it and overreact, because a lot of these inflationary pressures are really quite nuanced right now. We can actually point to 3 different types of inflation that we probably should be monitoring. One of which is cyclical forces. These are things that are caused by the base effects that should normalize early next year. Somewhat is still dependent upon the path of COVID, and that's still uncertain. Secondly, supply chain forces should also normalize, but probably toward the end of the back end of next year, rather. And then structural forces, and there we're somewhat in a kind of tug of war right now. Wages, for example, as you probably pointed out, have been actually moving higher, and that actually can kind of cause some pressures of inflation to rise. But at the same time, technology and globalization are still forces that are quite strong that actually keeps a lid on inflation. So those 3 forces are things we have to combat, and we suggest that volatility might be here to stay over the next couple months or so as we process some of these forces with respect to inflation.
So, George, you mentioned a potential policy mistake here by the Fed. So is the bigger risk right now that the Fed doesn't move quickly enough on raising interest rates, or that they move too quickly and too robustly in terms of trying to bring in inflation that may already be proving to be transitory?
Yeah, the Fed is in a tough spot because of that. And I think there is going to be some volatility around that between now and, say, the early part of next year. At the same time, there's some uncertainty actually who might be actually leading the Fed. We have to probably get some announcement from that on that front this week. But I think over time that some of these pressures will correct, and I think they will ease a little bit, and the Fed can actually be a bit patient. One thing they've been paying a lot of attention to is the employment sector, which has recovered quite a bit, but there's still roughly 4 to 5 million people who are out of work right now. And that's likely to keep rates lower for longer. So I think the Fed can actually buy its time a little bit, but they're going to have a pretty strong spine to actually navigate the next couple months or so as inflation pressures stay somewhat elevated.
I want to read from one of your notes to us earlier today that you sent over and just get your take on something here. We like high quality cyclicals. We're being super selective in mega cap. We have a slight preference for value versus growth, but wouldn't get overexposed to value. So is the value trade just overdone, or do you see a definite timeline, a window for this trade?
No, I don't think it's overdone. And in fact, again, we still think that there's some legs in the cyclical story that your previous guest talked about as well, that actually gives us some confidence that value might actually run a little bit longer. But again, as things normalize with respect to inflation, perhaps in the back half of next year, growth stocks might actually resume some of its momentum and actually propel the market higher in the second half of next year. So we're not really big fans of actually overweighting or really having a big overweight in any one sector or style right now. But I do think you want to be very selective of the market overall. We also think it's not a time to be complacent because there are some risks for a policy area that we talked about. But at the same time, it's not a reason to be pessimist either. Profits are booming right now. We think they can actually stay strong. Economic growth next year should actually be above trend on the back of some further monetary and fiscal stimulus. So for those reasons, and above all else, we would actually advocate for selectivity as opposed to being pessimistic about the state of the economy right now and the state of interest rates going forward.
All right, we'll leave it there for now. George Mateo is Key Private Bank Chief Investment Officer, and we thank you for being here. Before we head to break, we want to give an update on one of our top trending tickers today, and that's Boeing. Now, those shares are outperforming in the Dow off of a couple of upbeat headlines. Now, the aircraft maker's head of commercial airplanes, Stan Deal, told Bloomberg in an interview that he was, quote, hopeful that China would soon resume orders of the 737 MAX soon, following more than 2 years of grounding. Boeing also said it booked a number of orders following the 2021 Dubai Air Show, including for 2 777 freighters with Emirates. It also signed a firm order with IceLease for 11 737-800 Boeing converted freighters. Those shares are climbing about more than 5%, let's call it 5.5% this afternoon. Jared?
Yeah, and break even over those past 3 months. After the break, we're going to get a check of crude oil. Check out WTI trading below $80 per barrel. We got Scott Bauer of Prosper Trading Academy stopping by. welcome back. WTI crude oil trading under $80 once again. This is on expectations of higher supply while demand forecasts are being lowered as well. And then Biden, is he going to tap that strategic petroleum reserve? Well, let's talk about it with Scott Bauer, CEO of Prosper Trading Academy, who we welcome into the stream. Scott, always good to sit down with you here. I've followed this saga throughout the years. And anytime there's a release from the Strategic Petroleum Reserve or SPR, it seems to be fleeting. Why would it be different this time?
It wouldn't be. It absolutely wouldn't be. It would be a very short-term fix, if you will. But when we've done that in the past, when that has happened, it has taken the edge off, if you will, of the marketplace. But you know what? For longer term, Jared, things do have to change. Supply has to come back to the marketplace here. The good sign is for right now is oil rigs, the amount of rigs that get counted out there, that is rising. It actually rose by 6 last week. It's the highest level that we've seen in about a year and a half. So that means maybe that there will be some more drilling out there. But you're right, it is fleeting. And hopefully, though, it does take the edge off and buys us time. That's really, what it's supposed to do is buy us time so that the landscape, the supply and demand pressures change a bit.
Scott, this is Emily here. One of the things that you mentioned in a note to us before the show here was that you see crude oil actually hitting $85 a barrel. We do have barrels trading below $80 right now. What do you think gets us to that 85 level?
So I think what I actually sent was that I saw it hitting 75 before it would hit 85. Because of a lot of headwinds right now coming into the space. Now, I do think we can hit 85 if Biden comes out and says, no, we are not going to tap the reserve. And if the COVID cases that are really spiking again in Europe, which hopefully don't come this way here, if they start to ebb sooner rather than later. But what I really do see is hitting 75 before we were to hit 85.
So Scott, take us through this. Is 75 your lowest downward projection target for crude oil? And I'm wondering because we've seen the demand projections from OPEC Plus, the IEA, that's the International Energy Agency. Those have been revised downward for this year as well as next year. And then crude cracking $80, kind of an important psychological level. I'm just wondering what this might be saying about the marketplace's demand expectations for the next year.
Well, so first off, the demand expectations, OPEC just downgraded that for the fourth quarter by 330,000 barrels a day. That's fairly significant. But again, that is due to rising COVID cases. That is really what is weighing on demand right now. And again, hopefully that goes away sooner rather than later. In terms of what's going to happen next year, demand, I believe, is going to be pretty high. It's a matter of what is supply going to be. So last year when we were going through, the initial shock to the system from COVID, the pandemic, from the shutdowns everywhere, it was all about demand destruction. Now it's flipped, and now it's about supply constraints. So that price will ease as more supply comes to the marketplace, which hopefully that's going to happen. OPEC is kind of running a very hard line right now. So I don't know that that's going to happen there. Maybe we get more production here in the U.S. But, I personally see in the short run here, lots of headwinds. I know, everybody is myself included, unbelievably, upset that we've got to pay $4 or $5 a gallon at the gas pump. I think that's going to ease here going into the next couple months, though. I really do.
And then perhaps taking a step back here and thinking about the long-term secular trend, we've been seeing, of course, this push towards ESG investing. Of course, the infrastructure package included a number of provisions, specifically investing in electric vehicles and electric vehicle infrastructure. How do you see all of this impacting the longer-term demand and price action story for crude oil prices, both for WTI and for Brent?
Longer term is hard to determine, right? As a trader, my mindset is very short term, meaning like literally days, weeks, maybe months. Within the next year or so, I don't think the EV space really impacts what happens to the price of oil. I think you've got to look at
3, 5, 10 years down the road here. And I think that's where you could see a significant drop in the price of crude. To me, what is impacting crude the most here in the US is that the shale drillers have not gone back to work yet. The reason that they have not, increased their capacity and gotten back to the levels that they were pre-COVID is because they're really concerned about stock prices. They're concerned about their shareholders, and they don't want to go out on a limb again and get caught with these expenses if demand starts to pull back again. Once that happens, in my opinion, if we can get those shale drillers back there and back up to the capacity and the supply that we saw pre-COVID, again, I think that will ease the price a lot as well.
Scott, before we go, I want to take a look at the U.S. dollar index. I have a chart on the Wi-Fi Interactive. This is over the last 3 months, but I'm going to put this out to 10 years because I see potentially a much bigger formation here. I mean, dollar is very much a non-trending asset, at least the way it is in this basket, but we're in the middle. We just broke up to a new yearly high or thereabouts.
Yep.
This has lots of implications for commodities, doesn't it?
It sure does. Stronger dollars, typically put a lid on commodity prices, but that hasn't been the case, obviously, over the last couple of months or so. As we've seen the dollar rally, we've seen commodity prices rally as well. But Jared, you make a great point. Breaking out to basically new highs in the dollar here. Once we got above that 93.5 level or so, that was the breakout. If that 93.5 level now becomes support, where it was resistance here, that dollar is going to stay at least on the trajectory to the upside, which hopefully that does, help put a curb on commodity prices as well.
All right, we'll leave it there for now. Scott Bauer is Prosper Trading Academy CEO, and thank you so much for joining us. Holiday sales are already on track to jump compared to last year, but how are inflation, supply chain issues, and out of stocks going to be impacting the holiday shopping season? We'll speak with Steve Sadove, MasterCard Senior Advisor and former Saks Chairman and CEO, to discuss. This year's holiday shopping season is setting up to be a busy one. MasterCard Spending Pulse data expects U.S. retail sales during Thanksgiving week alone will grow by 10% over last year and by 12.2% compared to the same week in 2019 as consumers' pent-up demand continues into the start of the holidays. For more, we're welcoming into the stream Steve Sadove, MasterCard Senior Advisor and former Saks Chairman and CEO. Steve, thank you so much for joining us this afternoon. When you take a look at the data in this report, what categories of products are you seeing as having the highest demand during this Thanksgiving week, as well as the broader holiday shopping season?
Well, great being on with you, Emily. You know, this is a very strong holiday season. As you said, we're talking about 10% growth during the Thanksgiving week. We're looking at a 7.5% growth for the whole holiday season. Some of the categories that are looking terrifically strong are apparel, luxury, jewelry. Restaurants are doing well. People are getting back out. It's the recovery of the economy trade that is doing really well. People were in their homes for so many months. So now apparel, they want to go and try and get something new. They want to go to a restaurant. They want to treat themselves to something like a piece of jewelry or luxury. So the consumer is healthy, and this is across the high end as well as the lower end of the market. So it really is a very good economy. And it's interesting, it's a little bit about the brick and mortar doing well again, but the e-commerce also doing well. We saw the e-commerce business grow 50% during the pandemic, from about 12% of commerce to 18% of commerce. So we're seeing growth in the recovery of brick and mortar, but we're still seeing a 7% growth out of the digital business.
And are you still expecting Black Friday to be a thing? And let me just say, I point out a trend that I think it's so merciful that retailers are closing on Thanksgiving, and it's actually becoming about Black Friday once again. But is this just an arbitrary piece of or date with the rise of digital communication and shopping? Is it still relevant?
Oh, I think it's still relevant. It's clearly not as important as it used to be many years ago, but it's a signal. It's an emotional signal about the holiday season. And we're expecting to see Black Friday somewhere in the range of 20% growth versus year ago, which is an indicator of the consumers getting back into the stores. And your comment about stores closing on Thanksgiving Day is really important. I remember when I was running Saks, that was during the time when everybody felt they had to start opening early and on Thanksgiving Day. And now you're back to an environment where people are able to spend more time with their families. But on Black Friday, you're starting to see doorbusters again. The discounts aren't as deep as they were in the past. My guess is you're seeing 5 to 10 percentage points less discounting going on in the environment, partly because inventories are in line and partly because of supply chain issues. You're seeing a lot of key items selling early. People are getting out there and getting the items quickly because they know that they're going to be running out of stock. But Black Friday is an emotional, this is the kickoff to the season in a sense, although the season really has started so much earlier. I look at it in mid-October. A year ago, you saw the Amazon Prime Day in early, call it the 11th of October. I'm now looking at middle of October. That's why the MasterCard Spending Pulse forecast for the holiday season really does start in that or mid-October type of a time frame. But I still look to Black Friday as being emotionally significant.
And Steve, to your point about the discounts perhaps not being as deep this year, is this retail sales growth, this 10% growth that you're talking about on a year-over-year basis, going to come from actual higher volumes of units sold? Or is a lot of this increase actually coming from higher prices and inflation?
Oh, I think you're seeing a combination of both. Clearly, there's an inflationary impact. Last month, we saw 6% inflation. Some portion of the 10% growth is going to be inflationary, but the bulk of it is real growth and a recovery of the consumer. We've been seeing mid to high single digit growth ex auto and gas over the last number of months. And so that's indicative of real growth in the consumer. Some of it at the lower end is you've had the government support programs. At the higher end, you've had a very strong, healthy stock market that's driving some of the demand. But this is real demand. Clearly, pricing and those companies and brands that have consumer price power are taking pricing, but their costs are up substantially as well. But I would say that this is probably going to be a good season for the retailers, driven largely by volume increases, but pricing a piece of the action.
And I'm digging through your report here, looking at some of the numbers for sales growth, and even versus not just last year, but versus 2019, some of these numbers are pretty eye-popping. I'm looking at e-commerce; those are up 50% over the last 2 years. Apparel up 56% over the last year. Over the last 2 years, still up 21%. Luxury, excluding jewelry, up 92% over the last year. So, paint a picture for us. What is this telling you about the American consumer?
Oh, I think it's telling us that the consumer is very healthy. And you're right, it's sometimes not as good to look at just the year ago numbers, but you want to look at the 2 year ago number. And across categories, whether it's that luxury number at growing 17% versus 2 years ago, restaurants are up in the 20s versus 2 years ago. So these are really telling us that the consumer has money in their pocket, they're saving, they're spending. And they're spending across a wide range of categories. Electronics are doing well. Jewelry is doing very well. I think the one that in some ways surprised me the most is department stores. Think about department stores over many years were on a secular decline. In the last periods of time, this year, we're seeing growth versus 2019. So whether it's any of the major, you've had consolidation in that industry, but the department stores are growing very nicely. I think the interesting thing for categories like that is consumers want to get out, they're getting back into the stores, and now it's up to the stores to deliver the experience that the consumer is going to like so that they're going to want to keep going back, because there's this pent-up demand, and now they have to have the service, they have to have the products, they have to have the offering that's going to want to make them stick with it. So you have this one-time opportunity in this recovery economy for stores to show that they've changed, they've differentiated themselves, they have unique products for the consumer to keep wanting to come back.
And Steve, it sounds like you think that the demand is there on the consumer side, but are the companies going to be able to keep up with this demand? Could that 10% increase have been even higher if some of these supply chain disruptions and inventory concerns weren't there this year?
I think that's a fair question, and I think the answer is probably yes. What you'll see is a lot of substitution going on. So if you can't find that item that you want, you're probably going to substitute a different piece of apparel, let's say, or some other categories. So I do think that the supply chain issues are going to dampen to some degree, very modestly. I think overall, the fundamental growth that you're seeing driving this kind of, call it 10% growth during the Thanksgiving week and 7.5% growth over the holiday season is real, and that it's in that kind of range despite the supply chain issues. But I think supply chain, we should not underestimate that supply chain is a major disruptor to the ecosystem. Labor is an issue as well.
Yeah, so really eye-popping numbers there. So thanks for stopping by and sharing that. Steve Sadov, MasterCard Senior Advisor and former Saks Chairman and CEO. Coming up after the break, Bitcoin got an upgrade over the weekend. David Hollerith stops by to talk about it. Welcome back. Bitcoin never sleeps, they say. In fact, the cryptocurrency got a facelift over the weekend. At 12:15 a.m. Eastern on Sunday, the upgrade, called Taproot, was activated. This was broadly anticipated, and it opens up options for developers with new tools for boosting privacy, scalability, and security. Yahoo Finance's David Hollerith has all the details. And David, as I said, this was broadly anticipated and kind of easy to get into the weeds here, but it does mean something for the cryptocurrency.
Yeah, hey Jared. So Taproot was activated on Sunday, so yesterday. This had been proposed as far back as June, and actually, Bitcoin developers have been talking about sort of applying like Taproot-like upgrades since the early 2010s. So this is not something new, but it's very long awaited. And as you said, what it gives for the Bitcoin code base. So this is the blockchain. So we're thinking capital B Bitcoin as opposed to lowercase b, which is more so the asset. So what we can expect from this is more scalability on Bitcoin, increased privacy and security, and then sort of add to all that with this extra functionality that is coming into the code base. A lot of people and developers are sort of talking about the opportunity for smart contracts to be applied on Bitcoin. Now, previously, Bitcoin has mainly been used just for the currency and as a payments network. So this sort of is another way to look at Bitcoin, So whether or not that takes hold and whether or not that actually happens, we have to sort of wait more and see how developers will use these tools.
And David, to that point, what does this mean for Bitcoin and for Ethereum in the future, now that it sounds like the tech behind Bitcoin could execute smart contracts much in the same way that Ethereum already does?
Yeah, so I think that we want to be careful about jumping on the bandwagon of saying that this means that Bitcoin will compete with Ethereum and other sort of smart contract focused platforms. We really don't know how this is going to be used. I mean, people typically really like Bitcoin for how it's used now in a very simple manner. Changes to the network are very slow by comparison to other blockchains. And that's usually for a good reason, to ensure that things aren't screwed up. This is a couple $1 trillion blockchain that has tons of assets and it's grown so much. So I think we want to sort of like do a wait and see with this to see how developers will end up using the tools.
Yeah, a couple $1 trillion, and pretty soon you're talking about real money. David, we got time for another one. I'm just wondering if there's anything on your radar with respect to cryptocurrencies, any updates, any major upgrades. What are people in the crypto industry and market participants, what are they waiting for next?
Yeah, it's a good question. It depends on where you look. I think right now, a lot of people have been looking at Ethereum. They're talking about DeFi and NFTs. And also the high gas fees, which that's sort of what Ethereum is sort of grappling with right now, is their transaction speed. So they've also fairly recently, over the summer, they've sort of implemented another sort of scalability solution. So these are kind of constantly baked in. And ironically, it's actually improved Ethereum's price a lot. But so people are looking at Ethereum for NFTs and DeFi. And then obviously there's the whole metaverse conversation that's sort of baked into that. So a lot of people are thinking about it that way. And then, with Solana and all these other newer blockchain projects, we sort of have the same thing. It's like a sort of a different look at transaction speed and whether or not that might be what people want to use to interact in this way. So it's there's a lot of stuff going on, but I would say this week definitely look to see what price movements are going to do, because typically as we get to the holiday season, the cryptocurrency market, when it is in a bull run, it does tend to accelerate.
All right, well, we'll see how that shapes up in the coming weeks. Yahoo Finance's David Hollerith, thank you so much for breaking that all down for us. Coming up, we've got a check of today's markets. Looks like we have some mixed picture going on here across the three major equity averages. Keep it right here on Yahoo Finance Live. Welcome back. We're watching stocks trade mixed this afternoon. The Nasdaq is leading the way lower, off about 0.3%, and the S&P 500 and Dow are hugging the flat line. Now, Jared, you're standing by on the Yahoo Finance interactive screen. What do you have your eye on?
Well, I thought I'd take a step back and kind of paint a big picture view of the market right now. We are heading in. It is November 15th. This is the time of the month seasonally when stocks tend to lift off and drift into the end of the year. They call that at the very end the Santa Claus, I was going to call it wall of worry, but it's just the Santa Claus effect here. The Dow, you can see, only off about 1.5% from its record highs. The Nasdaq off about, well, I'm going to call that 1% from its record highs. And then the S&P 500 similarly situated. Now, when you get to the bond market, that's where we really see the market kind of picking up here. We've seen a lot of activity over the last few weeks. We were just talking about this with a number of guests, but the 5-year basically at some pretty important levels here. And let me put a 3-year chart of this, and you can see we haven't been here since the beginning of March 2020, and that would be the very beginning of the pandemic. Now, with the 10-year T-note yield, kind of a similar picture. Haven't taken out these highs from earlier in the year just yet, but the 30-year also elevated, up 4 basis points today. And we got to take stock of the dollar. We were talking about it with Scott Bauer just a few minutes ago. This is a 3-year chart. Important to point out that we have a liftoff right around this very important level. This would be the neckline. You could call this a double bottom. You could also call it a quasi head and shoulders top. No matter how you slice and dice it, probably have further room to the upside here. It doesn't mean that we're necessarily going to go get there overnight, because the dollar does tend to do a lot of back and filling, but nevertheless something to keep an eye on as well. Now, inside the market here, we have a mixed picture with respect to the mega caps. Tesla down 4%, Facebook up 2%, Nvidia down 2.5%. So some of the big leaders there showing some volatility. Let's take a look at a Facebook chart, and this will be going back to the beginning of the year. Here's a year-to-date look. Still up 27%. A lot of times when Facebook goes through these stomach-churning bouts of correction, people say it's dead money, but so far picking up a little bit, at least today.
Well, Jared, I know one stock in particular you also have your eye on is Dollar Tree. Now, we're seeing that stock up nearly 14% this afternoon, and it sounds like activist investors may be getting into this stock.
That's right. The story just crossed my eyeballs, so I'm going to summarize it here. You can see on the Wi-Fi Interactive stock really climbing. Most of this movement coming today up 14%, up about 19% year to date. And here's what Bloomberg Intelligence is writing about this particular ploy here. Activist investor Mantle Ridge could help push Dollar Tree to accelerate margin-enhancing strategies, we believe, including potential changes at the Family Dollar chain to aid profitable sales growth. This could happen via greater focus on pricing, on product mix, as well as through increased penetration of private label products. And let me just put a longer-term view of Dollar Tree. Of the dollar stores, this has been one of the more depressed ones. You can see very much range-bound over the past 5 years, except breaking out only very recently, Emily.
All right, Yahoo Finance's Jared Blickery, thanks for breaking that down for us. And coming up, we'll have a discussion about our AirPods out. We'll discuss why corded headphones are making a comeback and what that means for Apple. Keep it right here on Yahoo Finance Live.
Welcome back. If you just shelled out $550 for those AirPods Max, guess what? Turn around, take them back to the retailer of choice here, because AirPods might be out and wired might be back in. This takes us to today's hot takes. And Emily, I know you got some opinions about this.
Yeah, absolutely, Jared. So this goes back to an article in the Wall Street Journal where the outlet was talking about the fact that especially young adults are really now trying to wear corded headphones again, that they are making a comeback, that there is now this contrarian revolution back to this older tech now that AirPods have become so prevalent and so widespread. It looks like they're perhaps not as cool with the cool crowd anymore. I have to say, Jared, I did just get a pair of the entry-level AirPods myself. I'm now a firm believer in them, so I will continue to use them, although we do have to keep in mind here that there are, of course, some practical benefits to using the corded headphones. You don't necessarily have to shell out more than $500 for the AirPod Pros or $179 for the new entry-level AirPods that Apple had just introduced here. But I do think this is going to be interesting heading into the holiday season, seeing whether people are crossing AirPods off their wish lists now and how that impacts Apple's revenue coming from wearables. Now, we know for Apple's most recent fourth quarter here, the company brought in about $8.8 billion in its wearables, home, and accessory segment. That, of course, doesn't just include the AirPods, but it does also include the Apple Watches and other devices here. But that is a pretty sizable fraction of the overall $83.4 billion in net sales the company brought in during that quarter. So I think that this will be something to definitely keep an eye on here and seeing how this trend actually shapes up and how it impacts sales, Jared.
Those sales are some pretty eye-popping numbers that you're talking about there. And kudos to Apple. I have a lot of respect for them as a company. I know there's a lot of thought that goes into their products. I just don't happen to like a lot of them. I think the iPhone, probably their flagship product here, probably the greatest phone on the market. But I never liked those AirPods. The way they dangled there. So this is 5 years of Schadenfreude in the making here. I'm not sad to see AirPods go away, and they're not going to go away, of course, but I think they were a little bit overhyped. And to your point, I think we were talking about this during the break, so it wasn't your point, Emily, but once you use Bud earphones, it's almost impossible to go back. Shameless plug here, I make no money from this, but this is my favorite pair right here. And guess what? No dangle. You put it right in like that. And almost hard to see that they're in your ear. So I don't know what you use, Emily, but if it's anything like my experience, I don't like going back to wired when I have to.
Right, Jared. I actually do have my AirPods in right now. I will say it is a little bit annoying having to actually connect via Bluetooth every single time I switch between devices, whether that's my laptop or my iPhone here. But I think a lot of it just comes down to consumer choice. And, I think you were talking about the iPhone, of course, that does continue to be the biggest moneymaker here for Apple. We'll see how that ends up being for the holiday season. We know on the supply side, they have been struggling a little bit with chips and other components as they try to meet that consumer demand for their latest iPhone new generation that had just been launched as well here. But always interesting to see the incremental updates on the Apple products and how the diehards are always really eager to pick them up. So I'm sure they'll do fine with their Apple AirPods as well, even if there is a cohort of people perhaps moving a little bit away and back towards the corded headphones.
Yeah, and Emily, we're going to have to leave it there. Our first foray of anchoring together. Beautiful 2 hours that we have here, but guess what? We got a lot cooked up for you after the break. Stay tuned.
Pomp and circumstance. After months of wrangling and party infighting, President Biden will sign his historic bipartisan infrastructure bill at the White House later this afternoon. But will it deliver the jolt of momentum the economy needs, and which sectors stand to benefit the most? Despite consumers feeling the pinch across the country from rising prices, used car sales continue to rev up. We speak with the co-founder of Shift on record growth and the potential roadblocks that lie ahead. Plus, we speak with a company that's collaborating with Pfizer and BioNTech. It's using cutting-edge technology to provide COVID vaccine access to some of the hardest to reach places on the planet. Good afternoon, everyone. I am Karina Mitchell, along with my lovely co-anchor, Alexis Christoforous. Good to see you, Alexis. And it is shaping up to be an historic day at the White House with this infrastructure bill. But markets not playing along. None of this pomp and circumstance there. In fact, materials, one of the biggest sector losers, feeling the inflationary pressure.
Yeah, Karina, earlier we had all three major indexes higher. Now you can see just the Dow in the green, holding on there with a gain of 26 points, but the broader market has turned lower. The S&P is down to the Nasdaq off nearly 50 points right now. Earlier the investors got a lift after some better than expected economic data coming out of China. We saw both retail sales and industrial production unexpectedly rise in October versus a year ago. I want to take a look at some of the sectors because you mentioned utilities. They're having a great day. And in fact, they're the biggest winners overall today. Also in the green, we've got energy, consumer staples, and communication services. But on the downside, again, those inflationary pressures working against certain sectors, technology among them, and also discretionary, consumer discretionary, healthcare and materials also lower today. Let's take a quick look at the bond market because we see yields there are rallying. We've got the yield on the 10-year Treasury now sitting at 1.62%, a gain of more than 2%, and the yield on the 30-year now sitting at 2%. Also, it's a big week for retail, Karina. We're going to get earnings reports from Walmart, Target, Home Depot, Lowe's. We're also going to get those retail sales figures for October later in the week, and we're going to see what the impact of all these higher prices is having on consumer spending. Want to check in with Inez Ferre, though, for a look at today's market action. What do you have your eye on today, Inez?
Well, Alexis, you were mentioning earlier the sectors that were in the green, the ones that were lagging. I want to take a look at the Dow because the Dow out of the major averages still in green territory. In part, that's because of Boeing. Take a look at our Wi-Fi interactive board. We've got Boeing up 5%. Really, we haven't seen this type of price action in a while for Boeing. There are reports that China may be close to recertifying the 737 MAX jet. Also at the Dubai Air Show, Boeing gave some timelines and outline for its next variants of the 737 MAX. Boeing's first delivery of the 737 MAX 10 is expected in 2023. So that may be why you're seeing this movement to the upside. Year to date, the stock is up 8%. We're also watching the EV space over on the NASDAQ 100. You can see Tesla, one of the biggest laggards here, down 4%. Tesla dipping below $1 trillion market cap. Elon Musk tweeted that he could sell more shares. This was in response to a Bernie Sanders tweet. And the market cap is right now sitting at just above $900 billion. Year to date, though, the stock is still up 40%. But certainly over the last couple of weeks, the stock has been in a decline. And then just taking a look over at Lucid, we're watching this stock up 1%. Lucid will be reporting its quarterly results today after the close. And I just want to mention the cannabis sector because we're watching some of these cannabis stocks in the green. This was after a report that Republicans will be introducing a bill to legalize cannabis. This would be led by Representative Nancy Mace, and the bill would federally decriminalize cannabis. Alexis, Karina?
All right. Inez Ferre, thank you so much for that report. We want to stay on the markets and this massive infrastructure bill and bring in our next guest. Ross Bramwell is principal at Homerick Berg. Sir, thank you so much for being here. This is the most prolific investment in our country's infrastructure in decades. EV, roads, railroad, clean water, broadband. What are the sectors that you see lifting off on this bill passing?
Well, I think a lot of it is you would want to stick with, as you mentioned, where the biggest bucket of dollars is going to be spent, and the largest there is on the rails or on the roads, the highways, and on the bridges. So a lot of the construction material companies, I think rails is the next largest, right? So those two is where you're going to have a lot of dollars spent. But it's interesting as you kind of talk about how the markets are reacting. A lot of these names have run up in the last couple of weeks. And they've been up, over the last month, they've probably been up, mid double digits, where the broader market's been only up, mid single digits. So this could have been a case where, hey, they're kind of buying the rumor and then sell the news. And that's why we've seen a little bit of softness, because if you look at the bill, it is expansive, right? It's a large dollar amount, as you said, one of the largest ever. But it's interesting as you get down into the details, a lot of this money, a lot of these projects may not be started for 2, 3, or 4 years. A lot of the dollars actually don't ramp up until 2024. And you kind of peak out in the really heavy years on the spending in 2025 and 2026. So you're kind of getting a short-term bump. But really, I think as you're looking at, hey, what's going to impact these companies' earnings over the next 12 months, infrastructure may not have as much impact in the short term as many would hope.
So then what is an investor to do, Ross, if a lot of this money is really going to be felt for everyday Americans, perhaps years down the road? Where is the opportunity in the short term for investors?
Yeah, I think a lot of it is, the infrastructure bill probably isn't, one of my top 3 factors of what's driving the market right now. I still think corporate earnings, I think inflation and the Fed are probably still, greater forces that are moving the markets, and really more of a positive tailwind, especially when you coming to the Fed. Interest rates, I still believe, are going to be, lower for longer, maybe much lower. They're starting to, move up a little bit here lately, but again, I think that's just a sign indicating a more positive, environment for the company. And when it comes with inflation, if looking back, since the Great Depression, if you kind of look at all the factors and kind of the sectors, what does well in an inflationary environment, small cap value has actually outbeat it over every decade, has outpaced inflation. Small cap growth as well, but it missed in 1 or 2 decades. So I think if you're looking for, hey, inflation, it's going to be more persistent. It is no longer just transitory. I don't think it's going to derail the economy, but it's definitely not transitory. I think small cap value may be something to play over the next 2 or 3 quarters, because I think they're going to have the ability. That's where you're going to have some value, and they're going to be able to outpace inflation.
And sir, I want to bring your attention to this Washington Post ABC poll where 55% of Americans disagree with the way Biden has been handling the economy. Has the Fed handled inflation appropriately? And do you think there will be or needs to be a change at the top?
Well, from everything I'm seeing, it doesn't look like there is going to be a change at the top. Jerome Powell, he has staked his flag, in the ground, saying inflation is transitory. But it's interesting. I think his definition of transitory probably has changed over the last 9 months. I think at first when he was using the term transitory, he was saying, this is only going to last maybe 1 or 2 quarters, and then we'll get through it. We'll start seeing the pressures decrease. I think now when he's saying inflation is transitory, he's really saying inflation is not going to derail the economy. And whether that takes another 3, 6, or 9 months, we are going to stay accommodative. We're going to get to the other side of this. So I don't really see a change in policy happening at the top. I think it's most likely that Jerome Powell will stay in place. And honestly, if you look at it, what he's trying to do, he's breaking it into 2 pieces. He knows that he has to get through the tapering, and he probably wants to do that by the spring. That is really just reducing the bond purchases. Raising Fed rates and actually tightening is probably still the second half of next year, maybe even a year off. He has been more focused on employment than inflation. He has stated that many times. He wants to see the employment level come down. He does not think that this inflation is being driven by a labor shortage. He thinks it is more on the supply side. So over the next 3 to 6, 9 months, I think him staying accommodative, that really is going to be a positive drop for a backstop for the markets. Yes, I think we need to get through tapering. I think interest rates need to move up. I think the economy and stocks can handle interest rates moving up. But I don't really see a change in policy over the next 6 to 9 months.
You may not see a change in policy, but Ross, do you think there should be a change in policy? I mean, we had the Treasury Secretary, Pete Buttigieg, on Yahoo Finance earlier today talking about these supply chain disruptions, which are a big reason why we're seeing such a jump in prices. And he says they're probably going to stick around for a long time, these supply chain issues. If that's the case, and if inflation is not going to be transitory, should the Fed get a little more aggressive when it comes to the timing of raising interest rates?
I think it will. An interesting chart that I've been following, especially over the last few months, is looking at real personal incomes. And for the first time since the beginning of the pandemic, you've actually seen personal income, dip below pre-pandemic levels. If you look at all the unemployment assistance, all the money that was put into the system, people had extra money in their pockets, many people, than pre-pandemic looking on average. This is the first time that people are actually seeing negative income, in the last year and a half. So the question is, what does that do? That could actually force people back into the workforce, right? I'm making less money. I'm no longer getting the assistance. I'm having inflation. I have to get back to work. It also could hit demand a little bit. People may not be willing to spend. They maybe are going to, save a little bit more. So if you have some people coming back into the workforce, if you have a little bit less demand, maybe that can help the inflation picture. So I think, and I'm still watching it, over the next 3 to 6 months, I think we have some time to let this play out. I don't think we need an immediate change, because one thing that the markets, really couldn't handle is an abrupt change or in direction. Jerome Powell has been over communicating what his plan is, and I think the markets have handled it very well. If we were to make an immediate change, I think the markets, you'd see a lot more volatility. So I think Jerome Powell, I think it's kind of the right path. Let this play out over the next 3 to 6 months and then see where we are looking next spring.
And so I want to ask you, how optimistic are you that this bull market continues? Because we've seen from Q3 earnings have been pretty strong, and those that weathered supply chain issues came out on top. Those that didn't were punished. But what happens in Q4 and beyond? Do you see any dark clouds on the horizon? I know you say that any dip is a good buying opportunity.
Yeah, I think it is. At the beginning of the year, we were kind of looking at 5 metrics. They were all kind of flashing green at that point, right? It was the economic recovery, really due to the vaccination rollout. We're kind of past the Delta surge, so we're still looking for like a little bit of a reopening play there. The Fed is still very accommodative. Fiscal spending, we now have the infrastructure bill. It's not going to be an immediate bump, but it is more dollars going into the system. The consumer, the health of the consumer is still very strong. You still have over $1 trillion in money market accounts. Anytime there's a dip, people are looking to buy the market. And fifth is corporate earnings. Yes, we've had 6 straight, I think, quarters of double-digit, beating of expectations. They have moderated this quarter, right? That has come down. I think in the fourth quarter, it still moderates as well. But we are still on the path of higher corporate earnings, even in 2022, even if expectations come down a little bit. So I think corporate earnings, they really drive the markets over the longer term. I think that is going to be the story at the end of the day that the investors follow. But I think the risk there is historically, right now operating margins are pretty close to all-time highs, even though they've come off the peak a little bit. And the question is, can companies continue to defend their margins? So far, they've been able to do that. I think they'll be able to do that through Q4 and probably even into Q1. I think the question is, once you get to Q2, spring of next year, if we're still in this, 5.5, 6, 6.5, inflation, I think it's going to be much harder for companies to defend their margins. But for right now, over the next quarter, I think the story still is intact.
All right. Well, we will have to wait and see. Ross Bramwell, principal at Homrich Berg, thank you so much for your perspective today. And you can step up your own investment strategy with a free 14-day trial for Yahoo Finance Plus. Get expert research reports, actionable investment ideas, advanced portfolio tools, and more in a sleek ad-light experience. Check it out today at yahoofinance.com/plus. And we have much more coming up. We speak with co-founder of used car company Shift to see how it's driving business despite some hazards along the way. Stay with us.
With new cars in short supply because of the ongoing chip shortage, demand for used cars has skyrocketed, taking prices right along with it. And that has been very good news for Shift. The online used car marketplace saw a 200% jump in third quarter revenue. It's also raised its guidance for the year. And joining us now is Shift's co-founder and co-CEO, George Arison. George, good to see you again. Before we get into the nitty-gritty of the report, I just want to ask you about these record high used car prices, because the average price of a used car right now is a little over $28,000. That sounds a lot like a new car price to me. It's up nearly $8,000 in less than 2 years. Do you think that these used car prices have peaked, or are they going to continue to rise?
Yeah, they've gone up about 30% year over year, is kind of the rough estimate that we're seeing. So it's really unfortunate for a lot of customers, given the fact that they're having to pay way more money for the car and are, one of the big drivers of inflation. Unfortunately, we're not actually seeing anything that would suggest that the prices are going to stop peaking for now. We can't really obviously predict exactly what's going to happen, but we can track data and using that kind of make assumptions for our own business. And things we're seeing is, new car supply is still really short, and there are no signs suggesting that it's going to improve anytime soon. And then concurrently with that, used car supply is still pretty short and really hard to come by. Usually in the fall, prices tend to come down a little bit and demand tends to slow down as well. So for example, in September, you usually see that. This year, we didn't see that at all. Actually, in September, prices went up pretty significantly. Again, this is all public data that, anyone can access from companies like Cox and Manheim, et cetera. And so it's so far, prices continue to go up a lot.
And then how have you been able to weather that demand? Because there is so much desire for these cars, amid a challenging sort of environment when it comes to chip shortages and other managing inventory issues.
Totally. So Shift has two unique kind of features that make our business different from a lot of other folks. One is that we sell a really broad spectrum of inventory of cars. We have cars from nearly 0 years in age to all the way to 12 years, 0 miles to 120,000 miles. And so people can buy newer vehicles or really old vehicles, depending on what their needs are and how much they want to pay. That obviously makes it a lot easier if you're really concentrated in selling, 1, 2, 3, 4-year-old cars. There's less of those available versus if you look at the full spectrum. And then secondly, we buy our cars directly from consumer. Last quarter in Q3, over 90% of the cars that we sold to consumers came from other consumers. And those are actually the best cars to sell, but that makes it easier for us to acquire inventory. What we've seen is that at wholesale, so at auction sales, prices have gone up a lot more than they have with consumers. And so that's actually one of the things that's driving prices up so much. And so we are able to meet the consumer demand for consumer sales, which we think, is beneficial for customers. We've been, obviously, as you announced, our growth has been really tremendous this year and are really excited about what we've done. But most importantly, really happy that we've been able to serve so many customers this year, in terms of growing from where we were a year ago in this very challenging pricing environment.
George, I'm curious what kinds of used cars are in demand right now. I mean, we have gas prices also moving higher, and it doesn't look like they're going to be coming down anytime soon. I'm wondering if that is impacting the car choices that people are making.
Well, I think all cars are massively in demand, regardless of are they gas or electric. For Shift specifically, I mean, we've not released any new numbers about this, so I'm going to use old numbers. And to speak to that, a year and a half ago or so, we released some data which showed that on our platform, EVs and hybrids were very, very popular, far more so than in the market overall. Now, that's partly driven by our kind of where we sell cars. We're really concentrated on the West Coast. And so here you obviously have a much greater demand on EVs and hybrid vehicles. But I think, if you look at across the country, all cars are in demand and the shortages across all vehicles. So it's not really gas prices are not really impacting that. I think what you've seen is with the pandemic, people who otherwise might have taken public transportation are actually choosing to drive because they want to feel safer that way. And so that's, I think, one of the reasons why you've seen such a demand for used vehicles.
And so there is this high demand, and there are a lot of different companies out there. So what are you leveraging, and how are you leveraging to keep your market share, keep the competitive edge?
Well, yeah, I mean, what we've seen is our market share grow dramatically, right? We are going to volume-wise grow a lot this year, and revenue-wise, our new guidance now suggests over 3x growth in revenue year over year. So for us, like I mentioned, this really broad spectrum of inventory that we sell is a huge differentiator. And then additionally, for customers who want to buy from Shift, if they're in one of the markets where we operate, which is all the big West Coast markets plus most of the markets in Texas as well, we're actually able to bring you the car for a test drive. So you don't have to go anywhere. You shop online, find the car you want, book a test drive. The car then shows up in your driveway within 12 or 24 hours, whenever you'd like. You can then transact on an iPad and complete a transaction in the car or in your driveway. It's super simple. The entire financing process is in the consumer's hands. So the customer controls how they apply for financing, which loan they want to take, et cetera. There's not anywhere like you sit in the back office and be forced to buy a bunch of things, which makes it a really easy and awesome customer experience, right? So customers really like the simplicity of what we offer, and that's why they use us. But overall, what we've seen in the last 2 years is explosion in demand for e-commerce across all sectors, including cars. Automotive was only about 1% or less than 1% e-commerce prior to the pandemic. Next lowest number in all retail segments was groceries at about 9%. So what you're seeing is, a huge opportunity for auto to really catch up, and there's still a lot of room to grow, obviously, given how low we were. But I think people are much more, cognizant of the fact that they now can buy online and not have to go into a store to purchase a vehicle.
All right, George Arison, co-founder, co-CEO there of Shift. Thanks so much for being with us. And coming up on the other side of the break, we're going to be joined by the CEO of ZipRecruiter, Ian Siegel. We'll be back right after this. Welcome back. Well, a record 4.4 million Americans quit their jobs, according to the latest JOLTS report, and 10 million positions are still vacant. Ian Siegel, ZipRecruiter CEO and co-founder, spoke with us earlier to discuss the state of the labor market. Take a listen.
Well, we're seeing wage increase really across the board. The biggest is in leisure and hospitality, where there's just a real struggle to bring people in who are going to work every day in a face-to-face role with the public.
And Ian, what we keep trying to sort of get our arms around what is going to get those people back, right? We've talked before about whether it is wages going up that is going to be the key. What are you seeing throughout the platform? What is most enticing to job seekers?
I mean, that is the fundamental question of the job market today. Previously, we had hypothesized that all of these workers were reluctant to return to work because they were scared of getting sick, or they didn't have childcare, or they were getting stimulus checks, or they didn't have to pay their mortgages. And literally every one of the reasons that we had been talking about is gone now. And yet not only are workers not returning, but they're quitting their jobs at a record rate on top of that, which is putting employers in a real conundrum. And the response from employers has been to effectively roll out the red carpet to these job seekers. They are pulling out every stop they can think of. They're raising wages. They're offering an increased number of jobs with benefits. They're offering flexible schedules. They're literally offering entry-level job seekers the opportunity to go to college and have it paid for. And yet the job seekers still aren't coming. And fundamentally, what we think we're wrestling with here is a question of a change in what people want from work, which is they want remote work. They've tried it during the pandemic, they really like it, and they're holding out until they can try to find it.
Yeah. Well, I mean, 4.4 million Americans quit their jobs in September. What are some of the top reasons they are quitting? Is it the mask mandate? Is it lifestyle changes? Is it a combination of all those things?
I mean, survey after survey after survey, whether it's on ZipRecruiter or on third-party sources, is all telling us the same thing. 55% of job seekers are looking for a job that allows them to work remotely. Again, during the pandemic, people discovered a new, more satisfying way to live. It's the #1 perk that employers are offering on ZipRecruiter. 2 years ago, less than 2% of jobs mentioned remote work. Now more than 10% of jobs mention remote work. Those companies that are offering remote opportunities are experiencing the most success in recruiting. However, only about 40% of the jobs in America can be done remotely, which presents a really interesting question about what's going to happen to wages or benefits or perks for those jobs that require face-to-face interaction on a daily basis with the public.
Ian, I don't know if you know the answer to this, but this is something I've been trying to wrap my head around. The government numbers, the Bureau of Labor Statistics numbers in the monthly jobs report now show, the last report showed, only 11.6% of workers were teleworking at some point in the prior month because of the coronavirus pandemic. That number seems so low, given what you and many other people are saying about remote work. Like, what? Is it a data problem? Is it that people are working in an office even though they don't want to be? What's going on here?
Well, a lot of people have been compelled to go back to the office, particularly over the last quarter. And I think that's a big part of the reason we're seeing this surge in resignations, because before it was a reluctance of job seekers who were unemployed to re-enter the job market. But now we're seeing millions of currently employed professionals quitting their job, good jobs, without having another job lined up, which really, and I feel like I've been using this word a lot over the last 2 years, is unprecedented in the job market. Part of where this is coming from, though, is that job seekers and the currently employed have a record nest egg saved up over the last 2 years. There was a tremendous reduction in their amount of consumer spending that was going on, so they find themselves flush and they have long runways from which to make choices about how they deliberately want to live the rest of their lives. It's going to be really interesting to see how this plays out over the next 12 months, because at some point, these people are going to need to pay rent, they're going to need to pay their mortgages, and they're going to have to return to the job market.
Yes, they are. And so that brings me to my next question. What does normalization look like? Not just for the job market, but for you guys, right? You've been on a hot streak, a lot of companies looking for jobs. As we see this all sort of smoothing out, how does that look for ZipRecruiter?
Well, the story of ZipRecruiter has been a tale of two sides of a job market. I mean, if you look at the employer side of our job market, we've had 3 record quarters in a row where the number of employers on our platform looking to recruit just keeps moving to new heights, yet the job seekers have not been returning. And that has created an imbalance, which we are fortunate from a market timing position, but we are also fortunate from a product innovation position, because in a market where there is intense competition for job seekers, having a service like ours where employers are literally shown a list of algorithmically selected candidates and they can directly recruit them even before they've applied is an advantage. In the future, I think we're going to see that we're all on a glide path back to a more normal economy and a more normal job market. It's going to take us probably another 12 months to get there. And once that balance happens, it's still going to be an opportune time for recruiting and for job seeking. But right now, I mean, truly, it is a golden age to be a job seeker. You have never seen employers fighting so hard for your attention.
Welcome back. In less than 2 hours from now, President Biden will sign the landmark $1.2 trillion infrastructure bill into law at a ceremony at the White House lawn. It comes at a time when Biden is facing slumping poll numbers ahead of next year's midterm elections. At today's bill signing will be governors, mayors, members of Congress, and business leaders, including Barbara Humpton, president and CEO of Siemens USA, who joins us now from the White House. Barbara, it's good to see you again, and welcome back to Yahoo Finance.
Thanks, Alexis.
So, Barbara, I know that we keep saying this is a historic bill, but I'm wondering how transformative it really is. I mean, this is a watered-down bill. Initially, it was $2.3 trillion. It had to get knocked down to $1.2 trillion to find bipartisan support. How much do you think this bill is really going to accomplish? Does it go far enough?
Well, Alexis, we have waited for this bill for a long time, and honestly, we need everything that's in here. There's been a lot of discussion about the focus on the roads and bridges that need repair, but what I'm excited about is that this bill contains elements that are the future infrastructure that is really going to be important to help us transform this economy, especially as we come through the pandemic and the economy resurges.
And
And I wanted to ask you, congratulations on being there today. You've been involved in infrastructure. You've been waiting a long time, I'm sure, to see something like this come down the pipeline. What does this bill do for Siemens in the long run? And then how do companies making an ESG push remain competitive in this sort of environment with the issues and the initiatives contained in the legislation?
Yes, many know about us, but let me share that Siemens has been a national asset here in the U.S. for over 160 years. Our focus has been on industry and infrastructure. Infrastructure including both transportation, think about the future of trains, as well as built infrastructure, the connection of buildings, their controls, and now this new emerging area of the edge of the electric grid. So we are at a moment, this last 10 years has been about the creation of the Internet of People. We've seen how digitalization has transformed our lives. And what this bill has in it is the elements that lay the foundation for us to have people create the Internet of Things, really bringing our infrastructure online. So as we look across the portfolio of our nation's ports, as we look at the electric vehicle charging transformation that is now well underway but needs to accelerate, as we look at the future of transportation via trains and transit systems, Siemens is a perfect partner for all of that work. And we've been really pleased to be supporting legislators and love the fact that this had full bipartisan support as this moved its way through Congress. And we are delighted now today to be able to be here and see it signed into law.
Barbara, what about a timeline? I mean, we keep hearing about certain projects can probably get worked on right away, but others may take years, possibly decades. When it comes to your company and your employees, what projects will you be working on in the short term, if any?
Yeah, we already have a lot of things well underway. For instance, electric vehicle charging. We've already deployed over 75,000 chargers here in the U.S. But we all know that if we want to get over range anxiety, we need to have charging available to folks. And so we've made the commitment to bring the manufacturing of 1 million more electric vehicle chargers to the U.S. and manufacture those over the next 4 years. It's those kinds of things we're committed to do. We know that what will happen is as the funds from this bill work their way through to state and local decision makers, to the utilities, to the building owners who ultimately will be deploying that infrastructure, it's going to give the tailwinds that make the private investment move that much faster.
And Barbara, as you know, President Biden later on this evening will have a virtual summit with the Chinese counterpart, President Xi Jinping. How crucial is it that this happens now, this infrastructure deal vis-a-vis where China is? They're so much more advanced than we are on their infrastructure projects.
Yeah, both China and the U.S. have huge roles to play, particularly in this decade. I was honored to be in Glasgow last week and to hear Special Envoy Kerry talking about his bilateral conversations with the Chinese, and I was glad to see agreement coming out. These two countries, our two countries, have a responsibility to the rest of the globe to move quickly with the decarbonization of our infrastructure. So here we are, we in the United States, taking our steps. My counterpart at Siemens China, likewise, is working with Chinese industry and governmental officials, really leading the changes that we have in place for the decarbonization of industry and infrastructure.
And Barbara, you have such a diverse business there at Siemens USA. Talk to me a little bit about how inflation has been impacting your business and also the supply chain disruptions that we've been seeing. How have you been navigating through that?
Yeah, at Siemens, we are very fortunate to have gifted experts in supply chain management who've been using the tools available to them and reaching out to a much broader set of suppliers so that we would have a lot of flexibility as we moved our way through the impacts of the pandemic and then the current supply chain issues. The really good news for Siemens is that we're also a supplier into the world of manufacturing where there are so many of these shortages to be addressed. So, for instance, take the chip shortage. We're working closely, particularly here in the U.S., to help bring the manufacturing here. We've supported the CHIPS Act. We hope that bold investment will be made in semiconductors here in the United States and that will establish manufacturing again here that we so desperately need. So we're bringing our know-how to help unblock those supply chain issues and keep things moving forward.
All right, well, we're going to be watching that signing of this infrastructure bill into law. a little over an hour from now. Barbara Humpton, President and CEO of Siemens USA. Thanks so much for making time for us. And coming up next, the company that's helping to get COVID vaccines to some of the hardest to reach places in the world.
Welcome back. Well, as COVID infections start to resurge in parts of Europe, it is clear a global approach to vaccination is imperative. Here to discuss new drone technology to deliver vaccines to hard-to-reach places across Africa is Daniel Morpho, Senior Vice President of Africa Zipline, and Yahoo Finance's Anjali Kemlani. Daniel, how crucial is it to get this technology rolled out and in place right now as a public health approach, given we're seeing this rise in cases in places like Austria, where they are rolling out a very controversial lockdown for the unvaxxed?
Thank you very much. I think that with COVID, the most important thing is equitable access to vaccines. And if you take a spotlight on Africa and other hard-to-reach places, ensuring that everyone has access to the vaccines, irrespective of where they live, is going to be very paramount to ensuring that we can overcome this pandemic. So to be able to have the ability to be able to use a drone to deliver COVID vaccines to the hardest to reach places across the continent and beyond is truly a blessing to be able to do this. I believe that if as many people are as vaccinated, then we would have a real chance of returning to a normal life.
Daniel, I know that what you're doing really is a collaborative effort, and it's very important that governments within Africa assist you in your efforts to try to get these vaccines to these hard-to-reach places. How has that been going, and what have some of those challenges been for you?
So we've been working primarily with the government of Ghana. to be able to get COVID vaccines to the hard-to-reach places across the country. Since vaccines became available, Zipline has delivered approximately 10% of every vaccine jab that has been put into someone within Ghana. And for us, that's been an incredible collaborative effort between us, between the government of Ghana. I would say some of the challenges are, this had never been done, flying or moving vaccines using a drone. And so it was basically new frontier. And so we had to do a lot of research. We had to work with partners like Pfizer to be able to really bring confidence in the entire system and truly enable us to be able to get vaccines to the hardest to reach people.
Daniel, Anjali here. I know that you have already worked with some of the U.S. Companies, as well as have already really established yourself both in Ghana and in Rwanda. That's where Zipline really started. And so you basically had a leg up in this situation when it came to how to get vaccine doses to hard to reach places in Africa. I know there's also plans for Nigeria. Where else are you looking? Because it seems like the continent is particularly impacted by inequitable access to vaccines.
You're very right. Within Ghana itself, we are expanding our reach. We currently have 4 hubs, and we are expanding it to 8 within the next couple of months. As you rightly said, we are looking to start operations early of next year in Nigeria. But then we are really targeting other key markets across Africa. We are hoping that come next year, we should be in another couple of key markets across the continent. We are still in active discussions, so I'm unable to disclose, but I'm very confident that next year we'll see Zipline in a few more countries across Africa.
So talk to me about the scalability, because it seems like this is still something that's time intensive to build up and build out in these markets. So while you did have certain pockets that you were able to provide these doses to, it's kind of a limited partnership with Pfizer right now because you still have to build out.
So, for instance, as you rightly said, it takes time for the way that we deploy our solution to really come in. And it takes time because we are building a solution that is actually fully integrated into the healthcare system. So what we do are not pilots, they're fully operational, they're commercial. And so it's basically setting up infrastructure that is deeply integrated into the healthcare. So that takes a bit of time. However, what we have been doing is we've been doing this faster since we started in Rwanda. Our first distribution center set up in Rwanda took us over a year to actually to be able to bring up the first one. Today in Ghana, we're able to bring up a distribution center once we have all commitments in just a few months. And that is the trajectory that we are on. Our ideal state is in a matter of weeks, in the future, when someone requests for our services, we are able to fully deploy them. And we are working on many levels to ensure that that actually does happen as well.
And we need to throw everything we can at this to stay ahead of the pandemic. Daniel Morpho, Senior Vice President of Africa Zipline, thank you so much. And Yahoo Finance's Anjali Khemlani, thank you to you both. We have much more coming up after the break, because while we know the Fed will start tapering its massive stimulus support, we still don't know yet who will be leading that charge at the top of the central bank. More on that after a quick break.
President Biden is still weighing whether to keep Jerome Powell as chair of the Federal Reserve for a second term or elevate Fed Governor Lael Brainerd to the post. Our Fed correspondent Brian Chung has been following it all. He joins us now. When do you think we can expect an answer from Biden in terms of his nomination?
Well, we don't have any clues from the Biden administration yet. But Alexis, if you look at the calendar, they don't have much time to get this done. The current Fed Chairman Jerome Powell's term as the head of the central bank expires in the beginning of next year. And when you consider all of the vacations that Congress is going to have, the Senate won't have many legislative days to actually get a nomination through after the White House actually nominates someone. But if you take a look at the calendar of previous Fed chairs and the timing that it's taken for them to get nominated, consider that in the Bush administration, they announced that at the end of October. Actually, in 2009, when Obama appointed Ben Bernanke for a second term, they announced that as early as the end part of August. Now, of course, it is more traditional to be in the fall time. October 2013 was when Obama picked Janet Yellen to replace Bernanke, and then Donald Trump, to his credit, nominating Jerome Powell at the beginning of November. But even before that announcement, he had hinted, of course, on his Twitter account that an announcement was coming through a video trailer. We've gotten no such hint or no such clues from the Biden administration beyond some remarks from Janet Yellen, the Treasury Secretary, to CBS over the weekend, where she said she's going to leave it to the president to make a decision, but said, quote, there's people who are experienced and credible, and there are a range of candidates. So whether or not that suggests Powell could get renominated or would they defer to go with Fed Governor Lael Brainerd does remain an open question, but no announcement just yet, just that building anticipation for some sort of announcement soon.
And not just that top job, there are other seats that need to be filled. So waiting anxiously to hear what happens on that front. But I want to switch gears a little bit now and just touch base with you on a note that Goldman Sachs came out with saying that they may see a shift towards anti-work. What are we talking about there?
Well, this is going to be a serious question for whoever the next Fed chair is going to be, especially within the context of maximum employment. A lot of questions about whether or not the pandemic permanently changed the dynamics in the labor force. Now, a lot of the 5 million or so people that left the labor force since the pandemic started have been retirees, those older than 55. But there's an interesting trend among younger workers that Goldman Sachs noted in a piece last week that really concerns anti-work. If you take a look at the chart that we actually have drawn up here about our anti-work, it's a Reddit thread. Really, it's actually gained a lot of traction over the our Wall Street Bets thread. You can see the chart ahead of you in purple. Now, obviously, there's been a lot of attention to the Wall Street Bets Reddit thread since the beginning of the year in that GameStop mania. But see that anti-work has actually had more comments in terms of ranking over the last few weeks. And that's because of a growing feeling among a lot of these younger workers who are still sidelined from the labor force that they don't want to go back to work to an environment where they're mistreated or underpaid or overworked. A lot of burnout in that thread. And Goldman Sachs is saying, look, this could be something to watch within the context of longer term damage. They said, quote, we see some risk that some workers will elect to remain out of the labor force for longer, provided they can afford to do so. Now, they said the jury's still out over whether or not this dynamic is going to persist. Keep in mind that JOLTS data from last week does show that there are a record amount of quits happening, 4.4 million in the month of September. That's because of a lot of job openings, over 10 million in the month of September. So people have options out there. That likely won't be a permanent feature of this labor economy, but of course, worth watching, especially with all of the social media buzz.
And we know you're going to be watching it for us. Brian Chung, thanks so much. And stay with us. Much more of Yahoo Finance Live to come right after the break.
Welcome back to this hour of Yahoo Finance. I'm Karina Mitchell, along with my co-anchor, Alexis Christoforous, and we are just about an hour away from the president signing that historic infrastructure bill, but markets not really playing along right now. If we look at the major benchmarks, the Dow is up slightly by 14 points, the S&P negative, down by 2 points, and the Nasdaq also down by 53 points. And energy is one of the biggest winning sectors there. And for more on what the markets are doing, let's turn it over to Yahoo Finance's Inez Ferre.
And Karina, we've been taking a look at the Dow, which is in the green. We are looking at Boeing up more than 5%. This is really what's keeping the Dow in green territory right now. We haven't seen this type of movement in Boeing for a while. China may be close to recertifying the Boeing 737 MAX jet. And also at the Dubai Air Show, Boeing gave a little bit of an outline of its next variant for the 737 MAX and when you can expect that. Also taking a look at a couple of other components. We are also watching Walmart, which will be reporting its quarterly results this week. We also know that Home Depot will be reporting quarterly results, and investors will be paying attention to what these companies also say about inflation going forward. And then looking at the NASDAQ 100, we're watching Tesla down more than 4.5%. Tesla slipping below the $1 trillion market cap. Right now, that market cap is at around $900 billion. Elon Musk tweeted he could sell more shares. This was in a response to a Bernie Sanders tweet. And then looking also at the EV space, the rest of the EV space, we are watching Lucid today because Lucid will be reporting its quarterly results after the Bell revenue is expected to come in at $1.25 million nominal revenue, since this company is still considered a startup. Adjusted loss per share, that's expected to come in at 18 cents. The company just recently started the delivery of its Lucid Air vehicles. Only about 3 analysts cover this stock. It's got 2 buys, 1 sell, and the price target average of $33 a share. And you can see that shares are trading at above $44 each. So this kind of highlights the amount of money that has really flown into the electric vehicle space, that has poured into the electric vehicle space. Check out Rivian, which recently went public, up another 11% today. Alexis, Karina.
All right, thanks so much. Now, for the next half hour, we're going to take you to an event Yahoo Finance is putting on with the Bipartisan Policy Center in Washington. Our own Rick Newman is about to speak with the CBO director, Philip Swagel, to discuss the fate of President Biden's social spending bill. And a little later, Rick will be talking with Diane Swank at Grant Thornton about the economy. First, though, Bill Hoagland, a senior VP at the Bipartisan Policy Center, is kicking things off right now.
Pleasure to be here, and thanks to Bill Hoagland and BPC for having me on. So CBO just posted on our blog a note providing more information on the timing of our complete cost estimate for the Build Back Better Act. We've been putting out titles as we finish them, rather than waiting until we have the entire bills estimated. And so we've put out a number of them already. We'll have 2 more today. And then we're now sure that we'll have the entire bill, all the titles, done by the end of Friday. If we can get it done before then, of course we will. But certainly by the end of Friday, we'll have the entire estimate.
Just so the audience is aware, the timing matters a lot here, because Congress is not going to take any action on this, and it would happen first in the House until the CBO score is public. Since timing is so tight on this, can you say any chance whether it will be in the morning on Friday, 11 p.m. on Friday?
I honestly don't know. I think everyone understands we want this as soon as we can. So we're not trying to get something in at the end of Friday. It's a big bill. It's a complicated bill. There's big pieces that have interactions, and those are the titles that we're still working on that will come at the end. And so, some of the complications are those interactions that, changes in the provisions, such as the subsidies for the Affordable Care Act, interact with other provisions, the judiciary title, for example. And so those are the sorts of things that just take more time to analyze.
Right. So the essential question here is whether this bill will pay for itself. Is there anything you can tell us about whether it will or won't?
So that I can't yet. That essentially will come as people look at the entire estimate. And, we don't have it yet. So I couldn't even say, we've been doing it a title at a time. I was about to say a little at a time, but the titles are not little. So that's the wrong word, but it's a title at a time. And then people can look at the title and evaluate the pieces. But I understand there's a lot of interest in the entire estimate, and people will have to just, I have to apologize. People will just have to wait because, we're working as fast as we can, knowing the timeline that the Congress is working on.
So, Phil, I want to ask you about one provision where the CBO has published some analysis. It's this question of better IRS enforcement of people who are evading taxes or not paying taxes for whatever reason. So the Biden administration, of course, wants $80 billion from Congress over a decade to beef up the IRS. And they say that on net, after you account for the $80 billion, that will bring in about $400 billion of revenue. And CBO has a much lower estimate of the net revenue gain from that. I think it's $125 billion. That's a big disparity. So why the difference there?
Okay, so I can talk about what we've done is we have analyzed the proposal in the legislation and from the administration before that to provide more resources to the IRS. And this is a topic on which CBO staff and Treasury staff have done a lot of work, and there's people at CBO have been at Treasury and vice versa. So it's something that we're very familiar with. And have a pretty well-established methodology. Now, in the current proposal, we've also worked hard to understand where the money would go. And you can imagine providing more resources to the IRS, the service could put more money into customer service, that when people call, their questions will be answered, and better training for the people answering the phone calls, or they could go more to the audit staff, more to technology. So there's lots of different uses for the resources. We have talked to the people on the other side of this at the service, at the Treasury, to develop an understanding of the uses that they would put those resources to. Now, of course, right, this is, ultimately it's up to the executive branch to decide on the resources, but that informs our estimate. And one other key aspect of our estimate is the idea of deterrence. And my understanding is that there's other analyses that put a lot of weight on the idea of deterrence, that if people know that the IRS is doing more and auditing more, that that essentially other people then pay more of their taxes. The research literature on this is very mixed. For high net worth individuals, for large companies, right, tax bills, and so the tax filings are complicated. And there's an element of negotiation to those filings. And the research literature suggests that when a company understands that other companies similarly situated are being audited or examined, that sometimes they actually take a more aggressive position at the start of this bargain. And again, you can understand why, if ultimately this is a negotiation with the IRS, then they might start in a different place. And so the research literature on deterrence is, I'd say, very mixed. And so we end up, as we've described in a previous blog post, coming down in the middle of that literature on the effects of deterrence on additional revenues. My understanding is that others take more either optimistic or aggressive positions and really see a lot of weight on deterrence. Which again is within the possibilities, that's for sure. It's just not as we see it in the center of the research literature.
So if I'm getting that right, you're saying that more aggressive enforcement of tax evasion and tax avoidance would lead to more aggressive tax evasion and tax avoidance?
No, I guess that is a shorthand. It's certainly going to have an effect, and so we definitely see an impact. And as you said, we see about north of $200 billion gross, which nets out to north of $120 billion dollars from this. So it's not that you put more money into the service, you actually lose money. It's not that at all, but it does affect the behavior of people on the other end of the IRS.
Well, based on your first part of the answer to that question, does that suggest that your understanding of the way the IRS would deploy that money, because everybody's analyzing the same $80 billion over a decade, are you suggesting there could be a more effective or more efficient way to spend that $80 billion than your understanding of the way the IRS wants to do it?
Oh, I see. No, I don't mean to imply that at all. And so, one aspect of CBO that's important is that we provide analysis, but not our opinion. And so CBO has no normative view on what the best way to deploy these resources is. And the IRS certainly has the best is in the best position to understand its own needs. And so we try to understand what they will do, but there's no implication that they're doing the right thing or the wrong thing, or the resources could be used better.
So let's say it is 80 billion in spending, produces 120 to 125 in net return. Is that a good return, in the universe of things the government could spend money on?
Again, this is from the CBO position, we just wouldn't comment on what the right use of government resources is. We will provide Congress with the analysis it needs to make those decisions, but ultimately that's up to policymakers. And so this is, again, my view is that the Congress will get our analysis and not our opinion.
So let's talk about inflation a little bit. 6.2% was the latest annual inflation number. That's the highest in 31 years. CBO does do macroeconomic forecasting. Where do you see inflation landing in 2022 and 2023?
We're at the beginning of our cycle of updating our macro projections. And this is the first step as we do an update of the budget that we will release early in 2022, whether in January or the first half of February. And we're looking ahead based on current law. So current law, well, as of now, includes the Infrastructure Investment and Jobs Act, the so-called BIF. And then it could be that current law will, by the time we publish, will also include the Build Back Better Act. So we have to think about both of these. What's the effect? What's going on with inflation, now, and then what happens if there's additional legislation? Inflation is clearly elevated, as you said. The last monthly data indicated that very clearly. And as many people have observed, there's a confluence of factors. It's not just one thing. There's not one lever to flip to reduce inflation, and certainly not to reduce it quickly. It's a mix of very strong demand, and then a whole host of challenges on the supply side, from labor markets, transportation, particular product markets, trade barriers, and other things. And so we're trying to figure that out. We know inflation will remain elevated. I think that's kind of the consensus. That inflation will remain elevated at least through the first half of next year, and more likely throughout a large part of next year. We're trying to figure out exactly how that goes, because it feeds into the budget, and that's ultimately what we need to know.
Right. So there's this. You're aware of this debate, I'm sure. Is it temporary or transient, or transitory, or is it something you might call permanent? That's oversimplified, but the question is, will inflation basically dissipate into 22 and 23, or is it going to stay about where it is for some worrisome period of time? Can you just, as an economist, do you have a view on that?
Well, from the CBO perspective, we have to project inflation because that feeds into the budget. And so I do have to have a view about how long the elevated inflation will persist. And that's what we're trying to figure out. It's going to persist into next year. And I think we can be pretty confident of that, given the labor market dynamics, and given what's happening at the ports, and given what's happening in other aspects of the supply side of the U.S. economy. Beyond that, it's just difficult to say, right? I think we understand that as the virus recedes, that will help with the labor force. As the situation in schools continues to normalize, that will also help with the supply of labor. What's going on in the ports and other aspects of the supply chain is just hard to say. We're trying to figure it out, as we provide our budget update.
So 3 big pieces of legislation this year. There was the American Rescue Plan, which Congress passed in March, the Infrastructure Plan, which Congress just passed, and then the Build Back Better legislation, which Congress is still trying to pass. So if you go back to that first big bill, it's now, that stimulus money's been flowing into the economy. Does CBO make any connection between the American Rescue Plan and elevated inflation?
Well, certainly there is a connection. We have not done the analysis yet, so I can't tell you, X point Y percentage points. What is that connection? But we will do that analysis certainly over time. The provisions, as you said, of the American Rescue Plan Act provided a wide range of resources throughout the economy to families, to schools, to many others. We've seen very strong demand. And against the supply constraints, that strong demand has led to higher inflation. So it's not like it's just the ARPA, the American Rescue Plan Act. It's the mix of what's been happening on the demand side of the economy and what's happening on the supply side of the economy that's resulting in elevated inflation.
So the infrastructure bill that Congress just passed, what is CBO's outlook for the effect that is likely to have on the overall economy, both in terms of any impact or connection with inflation and then economic growth? Is that going to be a big boost to growth?
Okay. So, again, we're still analyzing that now. We do have a cost estimate of the IIJA, or the bipartisan infrastructure framework, that shows the sequence of the spending over time. And one aspect of infrastructure investment is that it does take time for those dollars to flow into the economy. So there will be some impact in the near term, and that will contribute to elevated demand. On the other hand, many of the dollars will flow out over time. And I think we're all familiar now that it takes time to build roads, to build bridges. It takes time to improve rural broadband, to replace lead pipes, and so on. And so the effects of that bill will tend to play out over time. And as you say, importantly, infrastructure investment will also have positive effects on productivity. And we haven't analyzed the specific aspects of the bill, but from our past work on other aspects of infrastructure, of traditional physical infrastructure, we know that there is a positive effect of infrastructure investment on productivity and therefore on GDP, and that in turn will mean a better supply side. So, so the increased demand will certainly come, but at the same time, over time, we will have a better supply side of the economy as well.
We've had a ton of deficit spending in 2020 and 2021. So we're going to have a deficit in fiscal year 21 of around $2.8 trillion, I believe is the CBO number. And we've got a national debt of $29 trillion. The bond vigilantes years ago said we were going to have economic disaster if we ever got to this point. We have not had an economic disaster. When will this heavy debt load start to matter?
The debt load matters today, and it matters in several ways. So one is just net interest payments. Now, the part of government outlays that are devoted just paying the interest on the Treasury securities on the debt. Now, low interest rates mean that flow of payments is lower than it would have been otherwise. And so that's that certainly reduces the pressure coming from deficits. On the other hand, the large debt stock means that the fiscal position is more at risk. So if interest rates were to rise, and we've seen some rise already over the last couple of months, but if interest rates were to rise further, the larger debt stock means that the U.S. is more vulnerable to higher payments resulting from that. So it's not so much there's an immediate crisis, but there's a growing vulnerability, and in my mind, that's the key risk with the rising debt profile.
Phil Swigel, there's a lot more we could ask you about, but we know you have to get back to that important work of scoring the Build Back Better legislation. Phil Swigel, Director of the Congressional Budget Office, thank you for joining us today.
Rick, thanks so much. It's a pleasure.
We're going to discuss some of this now with two economists, Diane Swank, who is Chief Economist at consulting firm Grant Thornton, and with Joe Minarak, a Senior Vice President at the Conference Board and a former Chief Economist at the Office of Management and Budget. Diane, what did you make of what Phil had to say?
You know, I thought it was really important that he noted that it's all of the above, that it's affecting inflation right now, but also that last comment on debt service burden. Interest rates are extremely low right now. When we talk about infrastructure investment, my preference would be to go ahead and take advantage of ultra low interest rates and issue much longer term debt to finance infrastructure investment. But when it comes to the other part of the plan, the Build Back Better plan, although I wish some of the infrastructure in that plan was in the infrastructure bill, but that said, that I don't get to choose that, Congress does. I think we need to have more of that financed and paid for at this particular time, given the upward pressure on inflation. And I think this is a period in time we have no roadmap for. I agree with Phil that we're going to see inflation at an elevated pace, not at the pace that we're going to see through the first 6 months of the year in the second half, but it will still be elevated. And I think the risk of the Fed reacting to that and perhaps overreacting, I think they need to react. The question is, do they panic or are they patient as they deal with this? And that's a fine line between the two. And I'm not sure I know what the right answer is because there's no precedence for where we're at. You could get a much higher interest rate scenario that make all of a sudden what Phil was talking about in terms of vulnerabilities of our debt and large outstanding debt and the debt service burden be much larger. And even though I'm very optimistic about, the productivity we get from things like infrastructure and the need for many of the programs we're talking about in order to bring people back into the labor force in the Build Back Better plan, I think those are very important. That said, those are more transfers to individuals and tend to be more inflationary in the near term. And that side of it, I think, needs to be paid for.
When we're talking about inflation, this term temporary or transitory, nobody's ever defined what that means. So the date that I have in mind that by which we need to know whether this is temporary or permanent is the midterm elections in 2022, and probably a month, 2 or 3 before then, when some voters are going to be making up their minds. So Joe Minarak, Phil Swagel said he sees elevated inflation into 2022, more or less. You agree with that? Joe, I think you're muted. Happens to the best of us.
I think I was muted by management. Okay.
I didn't do it.
That having been said, I think Diane drew an important distinction, which is, what is the Federal Reserve going to make of this circumstance and how are they going to react? But if you look at where this inflation came from, in the last couple of months, we've been saying that it has become relatively broad-based. But if you look where it started, it occurred in specific markets like automobiles, which had the problem of the shortage of computer chips, which the manufacture of which was disrupted to some extent by the pandemic. It occurred in goods that were being shipped through our supply chain, as another example. If the Federal Reserve were to try to slam on the brakes to reduce demand generally because of inflation that is arising because of sectoral problems, conceivably it could slow inflation somewhat, but it would be a very inefficient way to do it. So I think we need to be cautious in looking forward. The distinction then also between what is transitory and what is permanent has to a considerable extent to do with how the inflation affects people's expectations. Do people think that prices are going to rise? And do they therefore buy now and buy more so as to beat the price increases? And do the financial markets raise interest rates? I don't see that those expectations have been excited to this point. And I am more in the camp of transitory inflation. But for the midterm elections next year, it would take a remarkable degree of change in a lot of areas, including how many truck drivers do we have to move all of those containers out of the ports? As just one example, that's not something that is going to change in time to affect people's attitudes in the midterm elections. I think that's baked in the cake.
I want to tell the audience that if anybody would like to ask a question for Joe or Diane, they can use the live chat function on YouTube and Facebook. And if you're using Twitter, use the hashtag BPC Live. Let me go back to the question of what the Fed might do in 2022. One of my Yahoo Finance colleagues today pointed out to me that it looks like the Fed is going to be in the position of raising interest rates for the first time in an election year, and possibly close to the election, which could have a negative effect on financial markets. Who knows? Is that a problem for the Fed, Diane?
Well, the problem for the Fed is whether or not they're going to make the right decision. And I think what we're going to see, first of all, is the Fed left the door wide open to accelerate its tapering of asset purchases. That's the purchases of mortgage-backed securities and treasury bonds that it is trying to slow down the pace of right now, just easing up the foot a little bit on the gas pedal, not really hitting the brakes yet. And they left that door open in December. And I think we are going to see an acceleration of that tapering of asset purchases because they'd like to have some distance between the end of that tapering and liftoff in rates. I think we're going to see a liftoff in rates by mid-2022, part of it justified by a stronger economy and higher inflation. I also am a little bit more worried about the lingering effects of things like shelter costs and the more broadening of inflation that we're seeing out there through labor markets. We just have no precedence for understanding this. And I think it's really important to look at what has happened in terms of shelter costs. They're about a third of the CPI, mostly rents on everything from apartments to owner's equivalent rent. That's an imputed rent that you ask people, what would you rent your house for? Or would you actually rent your house for? And both of those are going up, and there's a tailwind on that. There's a lag in how we measure it, and that's going to keep underlying inflation elevated through 2022. Also talking to the energy producers out there, it looks like energy prices, although they won't go up as much as they've gone up this year, so that will slow the momentum in those prices, the levels are going to remain extremely high and could go up from where we are today. That is something also that consumers just hate, and there's not much the Fed can do about that. I agree with Joe. There's some parts of this inflation the Fed can't do anything about. The risk is the Fed is going to be sitting there in 2022 and looking at this and saying, how much of this is entrenched or not? And they're not going to know. And I think the real mistake actually is not raising rates in 2022. They will raise rates in 2022. The question is how rapidly and what do they signal about chasing inflation down? And I think that's really important because we've not had a Federal Reserve that moved to chase inflation at all since the early 1980s. They have been preempting a non-existent inflation for much of the last several decades. And so this is totally unique, this situation that we're in. And it's not that the Fed won't necessarily raise rates in an election year. It is that the Fed has to figure out what is the right policy and do they panic about where inflation is going and that they'll be wrong. And remember, the Fed is hardwired. Once we hit I think we'll hit full employment by mid part of 2022. I think momentum unemployment is very good. That's the good news. The downside is the Fed will have to decide at that point in time, is this really a different world than what they thought it was? And I think they're already getting that signal.
So let me just ask a more basic question about the economy overall. The economy is in pretty good shape by most standard metrics. And yet consumers are very gloomy. Just last week, we got, I believe, University of Michigan consumer confidence lowest in 11 years. The Conference Board's index is quite similar. Does this make sense? Is this just inflation, or is there something else going on with consumers? Joe, I'll give that one to you.
Well, I think inflation is probably the proximate cause, and it's something that affects just about everybody. There are also the folks who lost jobs in the pandemic because of restrictions on activity, because of public health. Some of them have not found a way back yet, and that is a problem. Some of them can't go back because of issues like childcare, where we've talked about public schools reopening. For those who have children who are younger than that, childcare as a business is way down, in part because people had to go out of that business because of the stress and strains that occurred because of the pandemic. So there's that. There's inflation. I think beyond that, people are also worried about the fact that the pandemic is lingering on to some extent. We talk about how we think it's going away. To some extent, in some parts of the country, it is. In other parts of the country, it's surging. And Europe, of course, is seeing now a substantial pickup in incidences of pandemic infection. So we don't really know where we're going. The weather's getting cooler. People are moving indoors, which is prime condition for the pandemic to get even worse. I think there are probably a lot of reasons for people who tend to be pessimistic right now. If you're looking for something to feed your pessimism, you don't have to look very far.
I wonder if we are, if there's any chance we are in the setup for a kind of a boom within 4, 6, 7 months. So let's look ahead to, let's say, April, May timeframe next year. We know we've got pent up demand for automobiles, for appliances, for video game consoles. People want to spend the money. In many cases, they can't. By the time it starts to warm up next year, could we be seeing the boom that many people thought was going to be happening this time without the Delta variant? Diane, go ahead.
Oh, sure. Without the Delta variant, and then I think Joe made the absolute most important point is the course of the economy is dependent on the course of the virus. The Delta variant did set us back. It added to supply chain disruptions. It hit countries that evaded earlier waves of this pandemic, and we still are in a pandemic. So as much as we want it to be behind us, it's not yet. And until it is, we won't know the course of the economy fully. That said, we're on course, even with the supply shortages and the problems we face, to easily clear 5% in growth in 2021. As we get into 2022, we're also going to have another catch-up year on an annual basis, probably exceeding growth of 4% or coming close to it. That's important. That's still very, very robust growth compared to the subpar 2% growth we had for a decade or so of the last expansion. And that is the good news. The hard part of it is understanding what will be, as Joe pointed out, will we see a surge in the virus that causes another pullback? Right now, reservations at Open Table are 5% below what they were in 2019. And that's the best they've been pretty much since the entire pandemic. So we've got people going back indoors, and that's good, but it's also bad because if it causes the spread among the unvaccinated or those whose vaccines are waning, that's a problem. And we're seeing that in some parts of the country. Minnesota, Arizona are two places that are becoming hotspots and starting to see pressure on their healthcare systems already. I think the other important part here is to look at where are we going in terms of, what's the tailwind? As Joe mentioned, the saving rate is really high, except for those who lost their jobs early on and lost support. Now, the child tax credit does help provide, we know it helped a lot of children who are hungry to get fed, which is fabulous, but that's about the only support left. We went off a cliff on unemployment insurance and supplements. Everyone thought that would bring people back into the labor force. It turned out the hurdles are much greater than that. The course of the virus still determines whether or not people can work or get the support they need to go back into the labor force, particularly for women. I think that's really important too. So I think we will be in a stronger place, but the fits and starts of the virus are really important. Also, people going to theaters surged in recent weeks. As we go into the holiday season, are we going to see some setback as we see people get sick again? And what does that mean for all the other knockoff effects? We know that it does slow the economy. The economy slowed to a crawl over the summer, a 2% rate, which would have been great before the crisis, but from above 6% in the first half of the year to nearly stalling out over the summer on consumer spending, even though we continue to create jobs. Yes, there's pent-up demand. Yes, we're going to unleash some of that. But I do think that we need to keep in mind we're still in a pandemic. And that is the biggest problem out there.
Joe, do you think we'll see?
And we are back at Yahoo Finance Live. By the way, much more from today's event will be available online at yahoofinance.com and bipartisanpolicy.org in the coming days. All right, I want to turn our attention now to infrastructure because in about 25 minutes from now, President Biden is going to be signing that $1.2 trillion infrastructure bill into law during a ceremony at the White House there at the South Lawn. And here at Yahoo Finance, we want to take a look at what the investment opportunities are now that this infrastructure bill will be signed into law. I want to welcome to the show Emily Rowland. She is co-chief investment strategist at John Hancock Investment Management. Emily, thanks so much for being with us. There's been a lot of talk about this infrastructure bill stimulating the economy, but it could take a while. What are some of the opportunities you see for investors here in the short term?
Yeah, thanks for having me today. So typically, infrastructure spending is done on a counter-cyclical basis, meaning when unemployment's very high and there aren't very many job openings. And right now, there's actually over 10 million job openings in the U.S. So this is actually a really kind of different setup or scenario than what we've seen historically. And so we've got to watch and see, how much of an impact that has. We're also comparing to a period in which we just saw a fiscal bazooka. So we saw $5 trillion sent to people via helicopter money or direct payments. That was extremely stimulative to the economy because it was done through that just very fast injection into the pocketbooks of Americans. So this is going to be a little bit different. It's going to be spread out over a long period. It's watered down from the original $4 trillion bill, and it's still got some hurdles in terms of going through the Senate. If you did want to think about opportunities in terms of, how to play infrastructure spending in the U.S., we look for cyclical parts of the market, in particular the industrial sector, moving down in market cap within industrials to mid-cap equities, mid-cap value equities is a nice, really kind of true way to play, the building, the trucking, the actual elements of the economy that are going to benefit from that increased spending here. Even though it's not going to be huge, it should have an impact on those parts of the market in an outsized way.
And wanted to ask you, Emily, so earnings season has come in. Q3 has been fairly strong. I think that's a fair way to characterize it. People have money in their pockets. There's pent-up demand. However, what do you see? We saw consumer sentiment drop to a decade low. So what's the issue there? Because there seems to be a juxtaposition.
There is definitely a disconnect there. And, what we're seeing in terms of looking at those consumer sentiment surveys is people are worried about inflation. That's the primary thing. And we all know that higher inflation, it doesn't feel good for us as consumers. As investors, it's a different story. There's really great ways to protect portfolios from inflation. Looking at just owning, frankly, equities is really the best way to do that. But at the same time, the health of the consumer is in really good shape. We all know that the consumer represents about 2/3 of GDP. So it's incredibly important as far as kind of powering the economy forward. And what we're seeing right now is that consumers are flush with cash. Their balance sheets are elevated, and they still have dry powder as far as, spending down those stimulus checks that came through in the second quarter of 2021. So the consumer's in great shape. I think retail sales this week will emphasize and highlight that. And I think the consumer should be able to move forward as the workforce of the economy into next year. The challenge is that even though this new economic cycle is unfolding and we're nowhere near a recession yet, it's hard to see this kind of explosive growth that we saw in 2021 carry over into next year. And that's got some really key cross-asset implications as far as investing goes.
So when you look at the portfolio mix, what are you doing in terms of positioning to be as defensive as possible in an environment where inflation can remain high, for the foreseeable future? We had Treasury Secretary Pete Buttigieg on earlier today talking about how these supply chain disruptions could last for quite some time. And we know they're a big reason why, or one of the big reasons why prices are so high right now.
So the best way to protect portfolios from inflation is frankly by embracing equities. In fact, in periods where inflation's range from 1% to 4%, equities have actually shown double-digit performance. And in particular, going down in the mid-cap space has tended to be a great hedge during these periods of higher inflation. Mid-caps have an abundance of companies with high operating leverage. So think about that as a company with high fixed costs, think property, plant, equipment. Doesn't cost much more to make that product, but if you have pricing power, which many of these companies do, and we've seen that throughout earnings season, you're able to pass those costs along and actually grow your margin. So periods of inflation can actually be just fine for equities, can be a little bit of a tougher story in fixed income, but a lot of that's priced in. As we head in for next year, we're looking at, really advising investors not to get too comfortable in the fast lane. So in 2021, it was hard to even take enough risk to keep up with the markets. And next year, we think that's going to get a little bit more difficult. we would advise against sort of loading up on a lot of cyclicality in a portfolio as we move away from this early cycle period in which you have, a highly accommodative monetary policy, tons of stimulus, into a more normal environment, a mid-cycle period in which, growth returns back to more moderate levels, where earnings kind of start to come back down to earth from these very elevated levels. It's not necessarily a bearish message. We don't want to get too defensive yet. We're going to save that for the next recession that's not even on our radar for 2022, but we want to rotate into more higher quality assets. We want to own stocks and sectors that have great return on equity, strong balance sheets, ability to maintain margins, great earnings growth prospects. And that brings us to sectors in the US like technology and communication services, pairing that with some higher quality cyclicals that can be found in areas like industrials and owning healthcare as well for that quality element. So it's really about pairing higher quality cyclicals and quality growth as we move into this next phase.
All right, Emily Rowland of John Hancock Investment Management, thanks for joining us today and giving us your perspective on the markets. All right, the oil markets closed just a few minutes ago. Luckily for us, Ines Ferre has been tracking all the action and joins us now. Hi, Ines. You may be muted, Ines.
Happens to the best of us. So taking a look at where we are at with WTI crude oil settling for December futures at $80.88 a barrel. Take a look at our Wi-Fi interactive board. You can see the price action throughout the session today. Earlier this morning, WTI had fallen below $80 a barrel. As my colleague Jared Blickery has been pointing out, oil has been trading sideways for the last couple of weeks. You had the IEA last week that had lowered its demand forecast. There's also been speculation about whether the Biden administration would be announcing at some point that it would release some oil from emergency reserves. Senator Charles Schumer has certainly been asking for that as gasoline prices have seen 7-year highs. On the supply side, the U.S. Permian output is projected to hit record highs in December as more rigs have been coming online in response to these high oil prices. That still, though, won't be enough to make too much of a dent on prices because demand is still outweighing supply. Alexis, Karina.
All right, Ines Ferre, thanks so much for that wrap up. And don't go anywhere because coming up next, the CEO of Blink Charging is here to talk about how that infrastructure bill can benefit the electric vehicle space.
Welcome back. Well, Blink Charging is a leading owner-operator and provider of electric vehicles, charging equipment and services. Here to discuss the impact of the infrastructure bill and on a greener auto industry for his business and for the sector is Michael Farkas, CEO of Blink Charging. Mr. Farkas, thank you so much for your time. Two questions for you here.
Thank you for having me.
Thank you. $7.5 billion has been allocated in the infrastructure bill. First of all, is that nearly enough as the president tries to make this push by 2030 to have half of all cars on the road be electric vehicles? And what is this doing for your business in particular?
It's a very good start. I don't know if it'll get us all the way there, but it's definitely a very good start. For our business in particular, it's amazing. It'll allow us to deploy more charging infrastructure that we own and operate. It will also allow those that buy equipment from us to be subsidized in their purchases, which will, without a question, add many, many more charging stations than there would be without the Biden administration's programs.
So, Michael, I know that you were already awarded nearly $25 million in grant funding this year to help build out these charging stations. Can you give us an idea of now what this influx of, I guess, new money is going to mean for where in particular are we going to see these charging stations pop up? Because I'm here in New York City, and unless they're, I'm missing them, I don't see a lot of them.
You are missing them. They're in garages that are subterranean garages throughout the city. We have relationships with a lot of parking garage operators, and you just don't see them. In valet-operated parking facilities, you have to let your valet operator know that you need to fuel your car. And in most locations, or a lot of locations, there are. You can use our mobile application that you can download on the app stores, both Google and iOS, and it'll show you all of our different charging stations. And we do have quite a lot of them in Manhattan. But without a question, this will add a lot more charging stations in all areas. In areas that may have not been really impacted by EVs today, this will allow those to invest money in those locations where we might not have without these government subsidies. Typically in the past, as you mentioned, the $25 million grants that we received just this year alone that we were awarded, those are typically grants where we receive approximately 80% in reimbursements. So it's an amazing thing where you're literally taking 2 dimes and buying $1 with it, but it really allows us to use our capital and expand that capital to get into more locations than we normally would have without the government funding. And with that, it's so impactful. I mean, there are no words to describe it. We're in a majorly growing business, and to have the government help us with $7.5 billion, it's going to impact not only us, but every single charging station company and infrastructure company and EV company. It's going to allow us to put more charging stations in the ground. Will alleviate range anxiety that people feel, hey, can these electric cars go these distances? And will spark more buying. And then again, additional investment in infrastructure. We're very excited about the programs. And these programs impact us in 2 different ways. It allows us to sell more hardware to others and to deploy charging stations that we own and operate. And that's our main business at Blink, is owning the charging stations, not just selling the hardware. We prefer to make our money in the long term over the sale of the fuel through those charging stations.
And that's part of your growth model that makes you different from any of your competitors. I do want to talk specifically about a little bit about Blink's growth. Quarterly results, revenue was up 607% year over year at 6.4 million. Sales and contracts were also up by about 350% year over year. Can you give me an idea of the breakdown versus commercial use and then residential use?
Okay, we are, another thing that really separates us from all of our competitors is we're the only truly vertically integrated EV charging infrastructure company. We have charging stations that you could buy on Amazon for dedicated parking spaces or in your home or in a carport. And then we have DC fast chargers that are along highway routes that allow you to charge in 10, 15, 20 minutes, depending on the state of your battery and the quickness of the charge of your car. And we have everything in between. It's very important for us to be able to have an offering for all of our different property owner types and different types of EV drivers. We're seeing a lot of uptake on the residential side, but what we're really seeing tremendous amount of growth is in our commercial charging market, both those that we own ourselves and those that we sell to others.
Well, and Michael, just from where you sit, what are some of the biggest obstacles to mass adoption? I would imagine that getting more of these charging stations into more cities is going to be huge for people to feel comfortable buying an EV. But to your mind, what are some of the biggest obstacles at this point?
There are none. I would say it's more range anxiety, which is not a reality, is what's once that's alleviated, I think more consumers will buy EVs. Once you see more charging stations in the ground, you'll feel more comfortable to drive EVs. The fact of the matter is the average driver in the U.S. drives less than 40 miles a day. We have EVs out there now with 2, 3, 4, and even 500 miles in range. It's very rare that someone sits in a car and goes 400 or 500 miles on a single charge. And with the infrastructure that's out there today, DC superchargers, the Tesla network, our charging stations, there's no reason today why one wouldn't buy an EV. It's just an anxiety. That's not real.
Well, the president definitely agrees with you there. He hopes people agree as well. We'll have to leave it there. Michael Farkas, CEO of Blink Charging, thank you so much for joining us today and for your perspective. And we are just moments away from the president signing into law that historic bill. After a quick break, we discuss exactly what is in it. Stay with us.
We are just minutes away from President Biden signing the $1.2 trillion bipartisan infrastructure bill. You are looking at a live picture right now of the South Lawn at the White House, where the president will be joined by special guests, including government leaders and business leaders. Our Washington correspondent, Jessica Smith, here now with more. So, Jess, what will the president's message be in just a few minutes?
Well, President Biden plans to say that this soon-to-be law is truly consequential. We got to look at some of his prepared remarks, and he will go on to say, today we are finally getting it done, and my message to the American people is America is moving again, and your life is going to change for the better. He goes on to say, too often in Washington, the reason we don't get things done is because we insist on getting everything we want. with this law, we focused on getting things done. Now, the president is inviting lawmakers from both sides of the aisle to this ceremony. We are expecting some Republicans and Democrats who were key in getting this bill across the finish line to take part in the ceremony. There will also be governors, mayors, business leaders there. The president wanted to have this signing ceremony once lawmakers got back to Washington, wanted to have this celebration and take a bit of a victory lap here. The White House did announce earlier today that it's establishing a new task force to work on the implementation of this infrastructure bill. They are also nominating one person. They're tapping one person, the former New Orleans mayor, Mitch Landrieu, to head up the implementation. He will be in charge of that, working with local and state leaders to get these projects off the ground, to get them going. The White House said some provisions will get started quickly. Others will take more time. It could take a couple of months to see these projects really get started. And as they are celebrating this bipartisan infrastructure bill, they are also working to pass the second part of President Biden's economic agenda, the Build Back Better plan, the social spending plan. The House could vote on that bill as soon as this week. We know House moderate Democrats were waiting for that CBO score before they were ready to vote for that bill. We did hear from the CBO earlier today, a short time ago, saying that they expect that report to be ready on Friday. So we'll see how that affects the timing. But at least for today, the White House is celebrating this bipartisan victory. We know that the president will hit the road tomorrow and then later on in the week to travel across the country and highlight the impact of this legislation and try to show the American people, the White House says, how it is going to directly impact their lives. But the ceremony should be getting started here in just a few minutes, guys.
All right. Thanks so much, Jessica Smith. We will be watching. Want to get a quick check of the markets as we about to enter the final hour of trading here on this Monday. A mixed picture, quite a change from where we were earlier when this morning all three major indexes were on the upside. The Dow has now turned red by just about a point. The S&P 500 hanging near the flat line. The Nasdaq Composite down about 15. Inflation continuing to be top of mind for investors. That's going to do it for myself, Alexis Christoforous, and Karina Mitchell. Stay with us. Much more Yahoo Finance Live to come right after this.
President Biden will sign the $1.2 trillion infrastructure bill into law this hour, but markets send signals that question if it's too early for a victory lap. We will get insight from Sanders Morris Harris Chairman George Ball, who has more than 30 years experience navigating events like this and helping people like us build wealth. Then in our 4 p.m. hour, Yahoo Finance Federal Reserve correspondent Brian Chung speaks with Tom Barkin, the president and CEO of the Federal Reserve Bank of Richmond. Barkin is a voting member of the FOMC. The FOMC has one more meeting this year, just as inflation appears to be more than what the Fed calls transitory. The Fed and some economists blame rising inflation on supply chain choke points, just as the holiday shopping season prepares for actual liftoff. DHL Express U.S. CEO Greg Hewitt will help us understand the shifts underway in global delivery that rely more on air cargo than traditional ocean-bound ships. We're an hour away from the closing bell. I'm Adam Shapiro.
And I'm Shauna Smith. Adam, let's take a look at where things stand because we haven't moved too far from the flat line today. Dow and Nasdaq still under a bit of pressure, although, again, not too far. The S&P up just around, I guess, just almost 1 point here. Yields are moving higher, though. Investors looking ahead to some of those big earnings report that we have later this week, and that could potentially move markets, a lot of those within the retail sector. But taking a look at today's sector action, energy and utilities are leading the way. The laggards, the sectors that are keeping the gains in check today, consumer discretionary, materials, and healthcare. Let's kick things off with the big story of the day. President Biden, he's set to sign that bipartisan infrastructure deal into law later this hour. The ceremony is expected to get underway any minute now. Jessica Smith is standing by for the latest on that in D.C. Jess.
Yeah, Shauna, the message from President Biden is going to be America is moving again. The president is going to tell the American people your life is going to change for the better. According to the White House, the president will go on to say too often in Washington, the reason we don't get things done is because we insist on getting everything we want. With this law, we focus on getting things done. And the president does plan to have lawmakers who helped him get this done alongside him at the White House today. We are going to see Republicans and Democrats join him to sign this bill to celebrate the bipartisan victory that they have there. You'll remember that 19 Republican senators and 13 Republican House members voted for this legislation, though not all of them will be there at the White House. Notably, Minority Leader Mitch McConnell is not planning on attending, but there will be other governors, mayors, business leaders, union leaders there with the president as he takes this victory lap. Today, the White House did announce a new task force to head up the implementation of the infrastructure bill. It will be led by former New Orleans Mayor Mitch Landrieu. He is going to be in charge of the implementation of working with state and local officials to get these projects going, to try and avoid waste, create jobs, make the U.S. more competitive. Those are some of the priorities the White House says the task force will have. The White House has said that some provisions will move quickly after this bill is signed. Others will take some time to get going. Administration officials over the past couple of weeks have said that it could take a few months for these projects to really get started, for people to really see the impact in their community. The president is going to be hitting the road tomorrow and then again later the week to try and highlight the benefits of this package. This comes as a new poll over the weekend showed the president's approval rating hit a new low. So the president will be hitting the road trying to highlight the ways that he thinks this infrastructure bill will benefit the American people. But again, we do expect this ceremony to start any minute now, guys.
And Jessica, we're going to be carrying that live here on Yahoo Finance. We want to get an update, though, right now on the markets. Jared Blickery is keeping an eye on what's moving them. And it's not just this so-called victory lap. There's more at play here. What have you got for us, Jared?
That's right. Not a lot of movement in the averages, but we have a lot of movement under the hood. So let's get to the Wi-Fi Interactive, where we can see one of our top trending tickers. In fact, number one in that slot is Tesla. We're going to be talking about it a lot as we have all day, but I just want to take a quick picture of the market action over the last 2 months. It's been a volatile ride as of late, but you can see back above $1,000 per share. Guess what? That also means a market cap north of $1 trillion once again. Threatening to take places, switch places with Facebook once again, but Didn't happen. Gotta check out Dollar Tree here. We're seeing that company up about 14% after Mantle Ridge, an activist investor, may be interested in the project, in the company. And if that happens, it would be putting a greater focus on pricing and product mix, as well as increased penetration of private label products. So you can see Dollar Tree on a tear here, up 45% over the last 2 months. And also checking out Boeing. Now, Boeing is saying that they have their MAX 10, so the Boeing 737 MAX 10 slated for delivery in 2023. And guess what? China might be on board once again, China back in place. So there's excitement that they may be able to sell their Boeing 737 MAXs there for the first time in several years. You can see over the last 3 years, here's what Boeing stock has done. You can see in the grand scheme of things, still kind of consolidating here, but nice to see that pump to the north here for Boeing. Also checking out Oatly. Now, this is a big stock, lots of attention on this. I believe this is a record low here, so not the best news for Oatly investors, down 53%. But Citi is saying, and by the way, they maintain the stock with a price target of 21, recommendation of buy. Citi is saying these were somewhat weaker results than we were expecting, although the long-term story remains intact. Guys?
Jared, we appreciate that. We're going to keep checking markets, but you know that expression, not the first time at the rodeo? Well, our next guest has ridden so many bulls in his 30-plus year career that he's helped build wealth, at least at his firm, to more than $1 billion plus. Let's bring in George Ball, chairman of Sanders Morris Harris, to help us figure out what happens next. It's good to see you again, George. And your first impressions, we're waiting for the president to sign this infrastructure bill. A lot of people trying to surmise what that means for investments. What advice, with 3+ decades of doing this, would you tell the rest of us?
I've been in many rodeos before, often ended up in the dust, and that may make me a more cautionary observer than not. The infrastructure bill itself is priced into the market. It is not going to do a great deal, signed or unsigned, to change the mood of investors. It's fascinating, I think, Adam, that the market's like a coiled spring right now. And this happens at pivotal points in the market quite often. The averages don't change, as you said just prior to this. There are lots of sector and stock rotation, major movements undergoing, but the indexes right at the moment are very tightly wound like a coil. It's sort of like the Indianapolis 500 when you see all the cars revving their motors at the start, but they haven't begun to go anyplace yet. When it goes, it's going to go in one direction or the other in a very major way, I think.
So, George, and how are you advising your clients then to be positioned? Because it seems like there's still a lot of uncertainty out there. We don't know what's going to come over the next couple of months. So what makes the most sense when some of these investors are trying to hedge their bets?
For the time being, Shauna, I think the thing to do is to participate actively in the market. The trend bias is still upward, and it would be a mistake to bet against that changing prematurely. So for now, we're telling clients, and I think the prudent thing to do is to be fully engaged on the equity side of the market. However, there is a strong argument for changing the composition of a portfolio so that either a market downturn or really the now prevailing trends will do more for you than being invested in, for example, the FANG or the FANG Plus stocks. They're getting to be very tired, very erratic, and probably are no longer the most lucrative places for an investor to concentrate their holdings.
George, how would you interpret for the rest of us the fact that, as you've pointed out, we've seen $27 billion recently flow into the options market, a lot of that going into calls? Wouldn't that be a bullish signal?
Adam, I think it's one of the most bearish signals that we could possibly see. And I will point out, as you know, the last time we saw this flood of money into single stock options and the predominance of calls over puts was in the 2008 beginning of the bear market cycle. There is a great deal of speculative fervor in the market, some of it retail, or some of it Reddit, some of it mem stocks, but including the institutions. So the fervor that's causing $27 billion to go into single stock options in 1 week is a very speculative blow-off bubble sign. Doesn't mean the bubble's going to get burst right now, but it does mean at some point there is too much of the animal spirits in the market. It's a cautionary sign.
Hey, George, when you take a look at the fact that there's additional stimulus now pumping into the economy on the heels of the highest inflation report that we have gotten in just over 30 years, any worry that this new infrastructure spending, that it's going to make inflation even worse than we're currently seeing?
Inflation is the greatest economic concern in the market and actually in the economy today. People are afraid of inflation, and they should be. Inflation is running too hot. The specific outcomes of the bill being signed today are a infrastructure renewal, which we need and will be helpful over the longer term. But the job sectors, the economic sectors, the employment sectors on which it's focusing are already in a very full employment mode, and therefore I think could create yet higher wages, wage demands, and that might spark a further acceleration of inflation, which would be very ruinous, both short-term to the market, more importantly, ruinous to the economy over the intermediate to longer term.
One of the things you share with your clients is to consider the iShares U.S. oil and gas exploration and production ETF. A lot of people are saying that shale production will come back online. You're not worried about the Biden administration maybe doing some regulations that, environmental regulations that would prohibit that?
Worry, yes, but Adam, there is a need for hydrocarbons now. The Biden administration and Americans don't want $4 at the pump gasoline. And right now, we're either there in some states or headed close to it. There is a important predominance of viewpoint that the shale producers won't be able to get the bank loans they need to produce, and that having been burned in the recent past, they won't bring new rigs, new drilling online. That's rubbish. That's nonsense. The shale drillers, as long as there are oil prices over $60 a barrel, and that's going to be the case for a long time, can mint money, banks will lend to them, their production will go up, their cash flow and earnings will go up. The stocks have increased in price, but not by nearly as much as the likely earnings that are ahead of them. I think that the shale sector has a big future over the next 1 to 3 years.
George, I am no expert. You should trademark hydrocarbons now before API gets a hold of it. We appreciate your experience and insight. George Ball is chairman, Sanders Morris Harris, and we appreciate, again, your joining us today. We are still waiting for President Biden to sign the infrastructure bill, but joining us right after the break, DHL Express U.S. CEO Greg Hewitt on a lot of what's coming, not only for holiday shopping, but the way infrastructure and delivery of goods, we're not talking ocean-going shipping, are changing going into the future.
We are awaiting President Biden to sign that bipartisan infrastructure deal into law. The ceremony is expected to get underway any minute. So as we await for that, let's talk about what's included in this new package, because one issue the Biden administration has been looking to address is the crisis that we're seeing in the supply chain. So here with a look at what's happening as we head into the holiday season, Greg Hewitt, he's DHL Express's U.S. CEO. And Greg, it's good to see you again. We know that the supply chains have been stretched very thin. Part of it, I guess you can blame, is on the outdated infrastructure system. But first, just give us your thoughts on the infrastructure bill that we are getting from Congress today, what President Biden is expected to sign into law any minute, and whether or not you think it's going to help resolve some of those challenges that we're seeing.
I don't know if it'll resolve anything immediately. I think investment in infrastructure is good for the country and good for all of us long term. But a lot of the challenges that we're facing right now are a product of, we'll say, COVID, the environment around commercial airspace, and then, of course, the challenges in the Suez Canal and outbreaks in ports in China for COVID. I don't think this bill addresses those, and that's what I think got us to where we are today.
Greg, we're hearing a lot of news, for instance, Boeing talking about using 737s as freighter jets and coming out with the 777X as a freighter jet. Is a day coming where aviation will command a much larger portion of international shipping, or is it still going to be within continents? What does the picture look like?
I think we believe we benefited. We're a fixed cargo network, as you know, on the express side, usually smaller weight, lighter product. But of course, with the crisis in air cargo and ocean, we've seen a steep increase in our weight per shipment, and we're building out our facilities on the ground and here in the United States to be able to handle that. And we think a large portion of that product will remain with us because people are a little bit worried about that fear of missing out and not having product close enough. And you can't change production lines and build out infrastructure quickly closer to home. So we do think express and air will play a big part in the supply chain over the next few years.
Greg, how quickly do you see some of these bottlenecks beginning to ease? Or I guess the flip way of asking that is, how long could this problem potentially persist?
Well, originally we thought we'd be out of it by now, and that didn't happen. And I think some of the challenges on the port side and on the ocean side compounded what was already a capacity crunch in the air that came from commercial space in the air being down for COVID. I don't think you're going to see a speedy recovery early in 2022. We're thinking maybe the back half of next year, there might be some increased capacity, both from hopefully commercial flights coming back. And then, as you mentioned, something Boeing talked about, this idea of maybe offering more commercial freight lining experiences that have been in the market historically. What we need is capacity. And once that capacity comes back, that takes some of the burden off the supply chain.
You've talked about the fact that business to consumer at your end continues to drive your growth, 58% of volume. What does the next couple of quarters look like? Can you sustain that kind of growth?
Yeah, I think it's going to continue to grow. I mean, we're planning. I think one thing we've done well is we've only taken on what we can handle. And so we added about 12% in aviation lift, 18% in terms of infrastructure capacity capability and facilities in the US, and we're adding about 2,000 employees. All of that's designed to handle about 15% growth, which is what we expect to see for our peak season and as we head into next year. I think the thing you might be hearing is, I think there are a lot of people who'd like us to take more, but you can't add aircraft, facilities, and people at an exponential rate. So we're handling what we can handle. We're managing that well, and we expect that to continue well into next year.
Greg, what about the shipping rates that are being paid right now? They surged since the start of the pandemic. They obviously remain extremely elevated today. But as we do see some easing potentially in the supply chain crisis, are they going to eventually return to 2019 levels, or is it going to be, I guess, just higher prices from here on out?
I'm not the expert in that area because on the express side, we've actually held our pricing. We've been able to blend the extra space and investments we've made into our pricing. So it's gone up, but more in line with inflation. I think what you've seen in the air and ocean side is as the capacity is crunched and the market has changed, you've heard of things like 4 and 5x pricing. I think when capacity comes back, they adapt to the market and the market price will come back down. But it really comes to be, when does that capacity come back and how much?
Greg Hewitt, always great to have you here on the show. U.S. CEO of DHL Express. We look forward to having you back on Yahoo Finance soon. Coming up next, again, we are awaiting President Biden to sign the bipartisan infrastructure deal into law this afternoon. You can see on your screen right now, the ceremony is getting underway. We, of course, will bring you President Biden's remarks as soon as they begin. We'll be right back.
Right, as we watch these markets and head towards the closing bell, we're waiting for President Biden, the signing ceremony at the White House on the $1.2 trillion infrastructure bill. The woman you see speaking right now is Donetta Williams. She is president of United Steelworkers Local 1025. We're awaiting President Biden. We're going to go to his remarks when he comes out to the podium. But right now, we want to get to Brian Chung, because there's a lot of questions about, do you call him Jay? There's the old ad, you can call me Jay, you can call me Ray, whatever. But what I'm getting at here very poorly is that the Fed chair's reappointment isn't, a home run just yet, is it?
No, for what's worth, Jerome Powell does tell everyone to call him Jay. That is his preferred name. But yeah, a lot of questions looming around whether or not he will remain at the helm of the central bank beyond February of next year. That's when his term as Fed chair expires. And consider that really we are wading into the late innings to get any sort of indication from the White House on who they'll pick. If you rewind to 2005, the Bush administration had picked Ben Bernanke at the end of October. Actually, in 2009, the Obama administration announced that Bernanke would be getting a second term as early as the end of August. Now, it is the norm to have this announcement happen in the fall, though. So October 2013 was when Obama had picked Yellen, and then the Trump administration announced in the first week of November that he was going with Jay Powell. Now, of course, what's interesting is that when you rewind to the Trump administration, at least they had some sort of heads up, of course, via the president's Twitter account of some sort of announcement in the days leading up to that announcement. In fact, it was actually a video trailer that he posted on his Twitter account. But as far as the Biden administration, we really have nothing to work on in terms of timing beyond some commentary from Treasury Secretary Janet Yellen over the weekend. She told CBS that they are looking at a, quote, range of candidates for the Federal Reserve positions, which includes not just the chair, but the other governor spots that are vacant as well. But you look at the calendar, guys, there's not much room to work with. There's obviously a recess for Congress in the Thanksgiving and December and Christmas, New Year's time. So not many legislative days to push a candidate through the Senate if once they do finally announce something, which means hopefully we'll get something from the Biden administration relatively soon.
Brian, what can we expect just in terms of policy continuity? Because I think that that's one thing that investors are very focused on, just in terms of if Jay Powell is not reappointed, what that could mean here for the markets going forward. Are we expecting to see some continuity if Lael Brainerd is appointed the next Fed president?
Yeah, well, that's certainly the question here. Is it really depends on who is it going to be. Now, obviously, if we talk about continuity, there's no disruption at all if you renominate the incumbent Jay Powell. But if it is indeed the case that the only other horse in the race, essentially, for Fed chair ultimately does end up being Lael Brainerd, the current Fed governor, that would kind of present an interesting scenario here, because on one hand, she's a current Fed governor who's supported all of the monetary policies that we've seen thus far. There's some discussion about whether or not she's more, quote unquote, dovish than Powell in terms of maybe wanting to let the accommodative policy run longer to pull more people back into the labor market, even despite the concerns about inflationary pressures. But it's not so clear if Brainerd is that much more aggressive than the incumbent in terms of wanting to keep that policy easy. The Fed, for what it's worth, is already in the process of trying to slow its tapering, or rather slow its asset purchase program through that taper of its quantitative easing program. Brainerd supported that and didn't recommend any other sort of modifications to that. So it seems like she might not be a full pedal to the metal in terms of keeping zero rates and aggressively buying assets through this whole recovery. But of course, the real differences here is in policy matters when it comes to regulation. She's a bit more aggressive when it comes to wanting to crack down on the big banks on capital and liquidity requirements. And also, she has spearheaded within the central bank efforts on climate change and scenario analysis to see if banks are well hedged against possible extreme weather events. So that could be something that would definitely be in focus if she does ultimately face a confirmation vote, again, if she is the White House's pick.
Brian, you have the joy of reading through those FOMC statements. You also get to speak to the different bank presidents to decipher what they really mean with terms like transitory. You've got a big interview coming up in the next hour. Tell us what you hope to learn from Tom, from the Federal Reserve Bank president from Richmond.
Yeah, well, Tom Barkin, thank you for the plug there, Adam, coming on our show live at 4:30 p.m. And we'll be talking a lot about just the inflationary pressures. That's the main thing that a lot of people are focused on. The Richmond Fed president, which, by the way, one of the more newly minted members of the Federal Open Market Committee, he obviously has been in line with a lot of other Fed officials in talking about some of these inflationary pressures as using the T word transitory, and that they'll eventually fade. But you look at that consumer price index print, which we got just last week, 6.2% on a year-over-year basis, the fastest we've seen since the end of 1990. That is putting a lot of these Fed officials to the test when it comes to not only their policy response to all of this, but just the messaging. It's not quite satisfactory for a lot of Americans to see some of these top policymakers saying, don't worry about it. Inflation will fade in time, when they're watching the prices go up seemingly on a daily basis at the store. So that's going to very much be an interesting conversation, which of course you can catch live here on Yahoo Finance at 4:30 this afternoon.
All right, Brian Chung is going to have that interview with the Federal Reserve Bank president from Richmond, Mr. Barkin, coming up in the 4 o'clock hour. We're going to take a quick break. As we go to break, who do you see there? That is Senator Kristen Sinema from Arizona. The administration has given her the podium right now. Interesting, because, there's been kerfuffle between progressives and centrists like Sinema. We're waiting for the president to come out and sign the infrastructure bill. We're going to take a break, and we're going to go right back to this afterward.
We got about 30 minutes here until the closing bell, and you're looking at a market that's under a bit of pressure, although the major averages aren't straying too far from the flat line. You can see the Dow off just around 20 points, S&P barely in negative territory, as well as the Nasdaq. Well, it's time for our 2 and 2, two stocks that I'm watching, two stocks that Adam has for you in the final half hour of trading. First up, let's take a look at Tesla, because this stock has been under pressure now for quite a few trading days. You can see the stock today falling below $1 trillion in market cap, continuing that drop that we talked about last week. It's actually coming off a decline of 15% last week. It's worst 1 week performance for Tesla in about 20 months. So the move lower comes after news that CEO Elon Musk sold about $6.9 billion worth of Tesla stock over the past week. Shares today, again, under pressure once again. Let's flip over to Dollar Tree. Now, shares are jumping. Their activist investor Mantle Ridge is taking a more than 5% stake in the company. You can see investors are excited about this move. Deutsche Bank upgrading the stock to a buy following this, raising its price target to $148 a share. Now, Deutsche Bank is more positive on Dollar Tree, saying that Ridge could unlock value for shareholders and prove to be exactly what a Dollar Tree needs at this time. Again, shares moving to the upside today with the stock up nearly 15%. Adam?
Take a look at some of the airlines. We got a 5-board prepared for you because airline stocks right now, they've been mixed today, but at this moment they're trading a little bit higher. Here's what's going on. TSA throughput on Sunday, that's the number of passengers who went through security, 2.1 million. The same day 2 years ago, 2019, before the pandemic, just 400,000 below that number of roughly 2.39 million. So the recovery is underway. Holiday travel season, essentially Friday is the beginning of the Thanksgiving holiday travel season. We just heard from United Airlines that they expect to fly 4.5 million people between November 19 and November 30, and that would be roughly 88% of the capacity they had 2 years ago. So we're keeping an eye on that. Just one last thing, fares are going up. According to Helene Becker over at Cowen, they do a weekly fare tracker. Average fare for the 278 different fare categories that they monitor, $378. Fares are up roughly 28.1% week over week, 26.1% year over year. Take a look at Boeing. Boeing coming out of the Dubai Air Show. Airbus got more orders, but the big news for Boeing, and the reason you see shares going up today, has to do with news that they've told CNBC as well as Bloomberg. First, they told Bloomberg that they expect to resume flying the 737 in China, which is obviously the world's most populous country. So that'll be a plus for Boeing, the 737 MAX going back to China. And then the other issue is Boeing delivering more freighters. We asked DHL's U.S. CEO about this, but the 737, they're getting orders for an 737-800 as a freighter, as well as the program to build the 777X as a freighter. So that's possibly good news for Boeing. Shauna?
All right, Adam, well, we are awaiting President Biden to sign that bipartisan infrastructure package into law. Now, the ceremony is currently underway. You can see Senator Rob Portman there from Ohio at the podium. Now, this marks a major milestone for the Biden administration. So for more on this, we want to bring in Tom Smith. He's executive director at American Society of Civil Engineers, representing more than 150,000 members. Tom, it's good to see you. I know you've been a huge advocate for this bill now for quite some time. Just tell us, I guess, how big of an impact you see this having in addressing our infrastructure needs.
Yeah, thank you. I think it's going to have tremendous impact. This is something we have desperately needed for many, many years. In fact, decades now. We've been advocating for this for a while. We've been doing a report card on America's infrastructure since 1998. We have made some progress. Our report card this year in 2021 went from a D+ up to a C- cumulative GPA, looking at 17 categories of infrastructure. We know that when you invest, we can make a difference. And we did see 5 categories, increase our grades. So we're optimistic that we're going to have sustainable, safe, resilient infrastructure. And this is forward-looking legislation that covers really 16 of the 17 categories of infrastructure that we grade in that report card.
There are these phrases that will help those of us who like to invest, perhaps invest more wisely. Shovel ready versus shovel worthy. What's the difference?
I think there's a lot of focus we've heard in the past about shovel ready, wanting to make sure that we can create jobs, immediately and put boots on the ground and shovels in the earth. And there will be a fair amount of that because there have a lot of existing programs that are going to get funding that are desperately needed. But there's also $500 billion of new money in addition to reauthorizing the surface transportation bill with a 34% increase over current levels. So we're also looking at shovel-worthy projects, which is making sure that we're doing things the right way, the right projects, and doing them the right way, making sure that they're sustainable, they're resilient. We're looking at social, environmental, economic considerations. We're preparing for hundreds, 100 years out. We're looking at infrastructure that we're designing that's going to last for 75 or 100 years. So we have to account for sea level rise. We have to account for climate change. We want to make sure we're engaging the community. And so that's what this is, making sure that it is truly worthy of being shovel worthy in addition to being shovel ready.
And Tom, when you talk about prioritizing projects around the U.S., you mentioned that report card that you have. You look at 17 different categories. I guess if you were to give President Biden some advice, or the administration some advice, where should they start? What should be the top few projects that the administration needs to focus on first?
Well, as we looked, we identified a $2.6 trillion funding gap over the next 7 years, looking at all the different categories of infrastructure. And nearly half of that, $1.2 trillion, was in the surface transportation area. So certainly that's an important consideration. But there's really impossible to pick one area. I mean, the lowest grade in our report card was transit at a D-. But we also know how important and how interconnected all these different systems are. And I think the Texas, ice storms that we had earlier this year, where we saw, impact on the energy sector and the impact on the water sector and the transportation sector, and it's all connected. So when there's a weak link in that chain, it can bring the entire system down. So that's what I think is the good thing about this bill, is it's comprehensive. It looks at all these different categories of infrastructure, recognizing how important all of this is to our supply chain and to our quality of life, and that we need to invest in each of them together.
So if we were to fast forward 1 year from today and you come back on the program, what's the headline going to be? Is this going to be an emphasis first on bridges? Is it going to be first on grid? What would the headline be a year from today?
I think the headline will be that you see, we have a national partner, we have a federal partner, and a national vision for our infrastructure. I think that's the key. And that's what's going to mobilize the state and local governments and the private sector to all start investing. This is going to be about job creation. This is going to be about being more globally competitive. We're no longer in the even top 10 with the World Economic Forum rankings on infrastructure of countries. So this is about mobilizing a country and unifying a country with a bipartisan infrastructure bill that has mobilized the business sector, big labor sector, all the different disciplines. We've been in large coalitions advocating for this. We know that the public wants this. So it's great to see it come across the finish line with a bipartisan approach. And now, of course, that's the finish line is just the beginning. That's the starting line, because we have an enormous amount of work to do as a country. And I think that the citizens are, and certainly the business community and the local and state governments are really excited about it and energized and ready to go.
Tom, is there anything missing from this package that you were hoping to see included?
Well, this is a start. This is a down payment. I mean, honestly, we have a $2.6 trillion gap. Here we're talking about $550 billion of new money over the next 5 years. There's going to be we need to have more. It's going to require additional investment from the state and local governments, of course, and the private sector. So I think this is a step in the right direction. And again, I think there's a very good focus on resiliency and sustainability, which are critical as we look at the challenges that we face with more extreme weather events, and to be more proactive and less reactive. So this is definitely a step in the right direction, and it's a start and not a finish.
All right, Tom, well, it's great to see you. Thanks so much for taking the time to join us. Tom Smith, Executive Director at American Society of Civil Engineers. Once again, we are waiting to hear from President Biden, who is expected to sign that bipartisan infrastructure package into law. You can see Senator Chuck Schumer is at the podium right now. We're expecting to hear from Biden any minute. We will bring you his remarks as soon as they get underway. We'll be right back.
Okay, we are waiting for President Biden to take the podium after Senator Charles Schumer from New York to sign the infrastructure bill. Let's bring in Rick Newman to talk about, last week we were talking about some of the things the Biden administration has done correctly, and we saw the Republican senator from Ohio. This was a bipartisan bill, so is this the victory lap? Is it deserved?
I think it is. I don't think he's going to get a lot of credit for it, though, because voters and consumers are worried about other things, mostly inflation at this point, also COVID, obviously. But just to put this in perspective, President Trump tried to get an infrastructure bill of around $1 trillion. He couldn't get it, even when Republicans controlled both houses of Congress for the first 2 years of the Trump presidency. President Obama, before him, also tried to get an infrastructure bill. He couldn't get it either. So Biden campaigned in 2020 as a Democrat who could work with Republicans. That was part of his appeal to moderates. And he actually can now claim that he did that. It's very difficult to do anything on a bipartisan basis anymore. And I think this is or should be a legitimate win for Biden. It does come, however, as his approval ratings are at the lowest point they've been in his presidency. That's inflation, that's COVID, that's some other things voters are dyspeptic about. So I'm not sure he's going to get as much credit for this if he would, as he would if things were more normal throughout the country.
Hey, Rick, what do you think Biden is going to focus on next, his next big thing? We know, obviously, the Build Back Better plan and one of his priorities here within the administration. But you mentioned that approval rating being at the lowest level of his presidency. He has to be pretty concerned about that.
Right. And I think the odds that the Build Back Better bill will actually pass Congress by the end of the year are declining. I've been talking with people saying, a month ago, 2 months ago, let's say it was maybe a 75% chance Biden would get the scaled back bill. That's the $2 trillion bill or so rather than the $3.5 trillion. But now maybe it's only 50-50 odds he'll get that or less. And that's why the approval rating matters. It erodes Biden's political capital. It gives him less ability to twist arms to get those extra 2 or 3 votes or 4 votes that he needs in the House, let's say. It just makes him less persuasive because the public is not behind him. And I think the problem with this legislation is the public is not really demanding this legislation. I mean, we've seen a lot of polling that shows they like infrastructure by a pretty solid majority, but they do not, voters do not get behind the Build Back Better provisions, the social welfare spending, most particularly by a majority. It's a minority of about 42-43% that say they really think those programs are important. So this is a problem for Biden, and I think he needs to have a backup plan for what he's going to do in case this whole thing flames out by the end of the year, because it could happen.
Rick, is there anything to be read in the fact that Kristen Sinema, the senator from Arizona, was allowed to speak, that she was one of the people designated to speak just moments ago at this ceremony?
Well, I mean, they would do anything to get her vote on the Build Back Better legislation. I mean, there are 2 senators. They need every single Democrat, and the 2 holdouts, of course, are Kirsten Sinema from Arizona and Joe Manchin from West Virginia, who have a variety of reservations or problems with the program. We don't know what they'll vote for. So the White House, the Biden White House, will do whatever it takes to cajole those 2 senators. But does that mean they're going to vote for the legislation? I would not take that for granted. And when you look at let's also remember, there's not a single Republican in the Senate who's going to vote for this legislation. So you need literally every Democrat, which gives every Democrat veto power. And there are a few things that, I mean, Kirsten Sinema has been so powerful at this point that she seemingly single-handedly got the corporate tax hikes taken out of the bill. She said she was just not going to vote for a tax hike of that magnitude, which the public generally supports, by the way. So those 2 senators, by virtue of the super thin majority, 1 vote that Democrats have in the Senate, they are basically kingmakers at this point. And for the time being, they're going to get whatever they want.
Rick Newman, we appreciate your being here. We are waiting for President Biden. He's going to sign that bill momentarily. There you see Speaker of the House, Nancy Pelosi. So we are close to the Commander-in-Chief putting his signature on the legislation. We'll be right back after this.
We are awaiting President Biden to sign the bipartisan infrastructure package into law. You can see he's standing right beside Vice President Kamala Harris, who has taken the podium right now. We, of course, will bring you President Biden's remarks as soon as they get underway. We've got about 8 minutes to go until the closing bell. You're still looking at losses across the board, although we are not under a tremendous amount of pressure today. Let's get to Jared Blickery for a closer look at some of these movers in the final minutes. Jared.
Yeah, a little bit of weakness in the final minutes of the first trading day of the week, but I'm looking at the VIX. VIX picking up a little bit, but still trading with a 16 handle. Nothing big there. What's on my radar is the yield curve. The entire yield curve still marching higher and also flattening at the same time. So certain parts are flattening, however, not all are. You look at the 530, that's definitely been compressing as of late, but the 210 can be a different story. Nevertheless, we're seeing value stocks outperform, some of the value stocks, some of them outperform today. Mixed picture here and turning a little bit more red as we head into the final minutes. Tesla down about 2%, Facebook up 2%, but I want to get to our travel stocks. That has been a source of green throughout the day. Wynn Resorts, that's up over 4.5%. Avis Budget Group looking at gains of 2% heading into the close. And United and Southwest Airlines each up about 1.3%. We've also been tracking the shares of Chinese companies, and those are taking a downdraft today. We're seeing Pinduoduo off more than 4%, NIO down nearly 5%, Didi over 5%, so we'll keep an eye on that. As President Biden set to meet with President Xi Jinping virtually this evening, could be an interesting meeting there. And let's take a look at the sector action. We're seeing utilities, energy, real estate staples. Those are some of the outperformers. Utilities really outperforming, which is interesting given the interest rate situation. XLU has to compete with yield for bonds. So interesting to see that as the greatest performing sector. To the downside, healthcare, materials, discretionary, those are the three underperformers. Healthcare and materials each down about 0.6%. And we got to get a check on Bitcoin here over the trailing 24 hours. Not moving that much, down about 13 basis points. Take a look at what's happened over the trailing 7 days, including the weekend action. You can see kind of forming a base here around 63, 64,000. Have to see if anything can come of it, guys.
All right, Jared Blickery, thank you so much. Let's take a look at how the ceremony down in D.C. is shaping up. Vice President Kamala Harris is still speaking at the podium. We're expected to hear from President Biden any minute. We will bring you those comments as soon as he begins. We'll be right back. The signing ceremony is underway at the White House for that $1 trillion infrastructure bill. We are awaiting remarks from President Biden. He is expected to speak here any minute. But in the meantime, let's take a look at where we stand in the markets with just around 2 minutes to go until the closing bell. You're looking at losses across the board. Dow, S&P, and Nasdaq all under pressure. We have Rob Hayworth, U.S. Bank Wealth Management Senior Investment Strategist, and Tom Essay, Sevens Report Research founder and president. Rob, let me start with you because markets actually seem to be in a wait-and-see mode today. We aren't seeing too much action when you take a look at the three major averages. The developments down in D.C., something that investors are keeping an eye on. I guess from your perspective, what is this infrastructure deal? What does this mean for the market?
Well, I think it's fairly constructive in that you're now seeing progress on the legislative agenda, right? This is something in our mind that the market has kind of been waiting for, not because it's going to be a huge driver of growth and earnings, but rather it starts to set expectations for what we're going to get as we head into December 3rd, when the budget deal and the debt ceiling deal expire, and we need to have kind of that next phase, the reconciliation bill in place. So I think the market's looking forward to progress, but we are wait and see because we've got a number of issues ahead of us, including not just debt ceiling, but also inflation.
Tom, you like to talk about Treasury yields as being what's behind what we're witnessing, and that people pay too much attention to inflation while ignoring what's going on with those yields. What's the lesson that you think a lot of us might be missing?
Well, I think that the bond market especially, isn't nearly as concerned about inflation as the rest of us are, perhaps. And the reason I say that is because if the market were worried about inflation, then the 10-year yield would be much higher than the 1.61% it is right now. I mean, we're posting inflation statistics that are multi-decade highs, yet the 10-year yield isn't anywhere close to where it was pre-pandemic, right? So those two things don't add up. And I think what it is essentially that the bond market is looking past this transitory spike in inflation, and clearly it's saying it does think it's transitory. It's agreeing with the Fed. And I think that's part of the reason that stocks sort of continue to grind higher too, is that it's just not quite as dangerous an inflation spike as it appears to be.
All right, we have a closing bell. There you see it, and this is where the markets are going to end up on a day when we are expecting the president to sign the $1.2 trillion infrastructure bill any minute now. Dow's going to close down roughly 12 points, but look at that, the S&P 500 essentially flat. It seesawed between positive and negative territory. We'll see if it can hold on to that as things settle. And then the Nasdaq's going to be down just about 7 points. Take a look at sector action today. It was a mixed picture. You had consumer staples and energy in the green. You had materials and healthcare in the red. Let's go back to the panel until we get President Biden. And when we talk about this infrastructure bill and all that is coming our way, what's the most important thing, Tom, that you think would be the impact? You just talked about the mistakes some of us make with inflation, but won't this infrastructure bill have an impact on treasuries as well?
Well, yes. I mean, I think that the infrastructure bill, it is going to increase stimulus, right? And I think to a point, it's good for the market, and here's why. If we didn't get the infrastructure bill, there sort of would have been a very large fiscal cliff the market would have had to negotiate. And what I mean by that is, we've just spent the last 2 years spending unbelievable amounts of federal money, right, to help the economy and to keep the economy in. And really, without this infrastructure bill, essentially it was
Sorry,
all
Tom, I have to jump
normal.
in here. We have President Biden taking the podium right now. Let's take a listen to what he has to say.
Thank you, thank you, thank you. Oh, thank you. Heather, you thought you're surprised you're standing here. Jill is very surprised I'm standing here. Well, Heather, thank you for the introduction. And I can't look over here because the sun's shining in my eyes, but all this other crowd over here, thank you, thank you, thank you, thank you for all you've done. Look, thanks for sharing this day with us. Why this day matters to you and your fellow iron workers and your families, and you explained it well. For all the folks at home, I know this day matters to you as well. I know you're tired of the bickering in Washington, frustrated by the negativity, and you just want us to use and focus on your needs, your concerns, and the conversations that are taking place at your kitchen table. Conversation as profound as they are ordinary. How do I find work? And how do I get there? How can our small business thrive and our child succeed in school? Or how do we emerge from this pandemic, not just with a little bit of breathing room, but with real fighting chance to get ahead? When we ran for president, I thought maybe I could help answer some of those questions for you and the needs you have. Because every time I'd ride home on Amtrak, I'd go through just north of just south of Baltimore. I'd look out, go through a suburban neighborhood. I'd look in all those lights are on in the windows, Nance, and I look and I wonder, what are they talking about? I'm serious, swear to God. What are they talking about sitting at that table? What are they talking about? They're talking about the things that I talked about at our kitchen table, Jill at hers, and all of you as well. And that's about how can we come together to be president for all Americans, to make sure our democracy delivers for you, for all of you. And I promised that we couldn't just build back to what it was before. We literally had to build back better. You couldn't build back. We're the only country that's always come out of great crises stronger than we went in. And the world has changed, and we have to be ready. My fellow Americans today, I want you to know we hear you and we see you. The bill I'm about to sign along is proof that despite the cynics, Democrats and Republicans can come together and deliver results. We can do this. We can deliver real results for real people. We see in ways that really matter each and every day to each person out there. And we're taking a monumental step forward to build back better as a nation. I want to thank everyone who helped make this happen. Vice President Harris, my cabinet members, my White House team, Jill, Doug, our first lady, and our first lady and our second husband. No, I'm joking. These guys travel all over the country together. I'm getting worried, you know. And Doug's one hell of a lawyer besides. And everybody from the United States Senate, Majority Leader Schumer, and a group of Senate Democrats and Republicans who established this bipartisan framework, including representatives and all the folks you heard from. Senator Rob Portman is a really hell of a good guy. I'm not hurting you, Rob, because I know you're not running again. That's the only reason I say it. But you are a hell of a good guy. And the most determined woman I know, Senator Kristen Sinema. Congratulations, Kristen. Look, Committee Chair Tom Carper, Ranking Member Shelley Moore Capito. I also want to thank Minority Leader Mitch McConnell for voting for this bill and talking about how useful and important it is. And from the House of Representatives, Speaker Pelosi, Steny Hoyer, Jim Clyburn, and Committee Chair Pete DeFazio, Democrats and Republicans, progressives and moderates. I'd like to pause and ask all the committee chairs and ranking members of the United States Senate and House that are here today, please stand. Will all of you stand? Come on. All right. Thank you, thank you, thank you. To state the obvious, none of this would have happened without all of you. I really mean it. And also to the governors. Where are the governors? Governors, stand up. Come on, I want you to stand up. Red states, blue states, you all contacted me. You all said you were for this. You all stepped up. And more than 375 mayors, Democrats and Republicans, from every state and District of Columbia, wrote me asking to get this done. You got it, kid. And nearly 50 of whom are here today, including Republican Mayor Fontana, who from Fontana, California, Mayor Warren, who spoke earlier, and county and state and tribal leaders as well, civil rights leaders, faith leaders, law. You know, this law was supported by business groups, the U.S. Chamber of Commerce, the National Association of Manufacturers, the Business Roundtable, representing 200 of the largest corporations in America, and other top business. I want to especially thank, and I'm sure you'll all, as we used to say in the Senate, I say in point of personal privilege, I want to thank organized labor who understands this about jobs. You all stood up. Jobs, 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 jobs. Special thanks to the AFL-CIO, the United Auto Workers, electrical workers, the IBW, the iron workers. It goes on, plumbers, pipe fitters, and the building trades, steel workers. Who would I leave out? Pardon me? And my wife is a member of the union, the NEA. I'm going to get in trouble. Machinists, so many more. Look, folks, for too long, we've talked about having the best economy in the world. We've talked about asserting American leadership around the world with the best and the safest roads, railroads, ports, airports. Here in Washington, we've heard countless speeches and promises and white papers from experts. But today, we're finally getting this done. So my message to the American people is this: America's moving again, and your life is going to change for the better. If you live in one of the 10 million homes, or you're a child who attends one of the 400,000 schools or child care centers that still has lead pipes in them, you face a clear and present danger to your child's health and your health now. This law is going to start to replace 100% of the nation's lead pipes and service lines. So every American, every child can turn on the faucet and drink clean water. And tens of thousands of plumbers and pipe fitters are going to get work done in good paying jobs. Folks, as we saw with remote learning, remote working during the pandemic, access to high-speed internet is essential. And access to water as essential as access to water and electricity. This law is going to make high-speed internet affordable and available everywhere in America, urban, suburban, rural, and create jobs laying down those broadband lines. No parent, excuse me, no parent should have to sit in a parking lot at a fast food restaurant again, just so their child can use the internet to do their homework. That's over. And folks, if I visited your town, I'm sure you'd be able to tell me and where you hold your breath as you cross the particular bridge, or where the most dangerous intersection in your town is. This law makes us the most significant investment in roads and bridges in the past 70 years. It makes the most significant investment in passenger rail in the past 50 years and in public transit ever. So what that means is you're going to be safer and you're going to get there faster, and we're going to have a whole hell of a lot less pollution in the air. The bipartisan law will modernize our ports, our airports, our freight rail to make it easier for companies to get goods to market, reduce supply chain bottlenecks as we're experiencing now, and lower cost for you and your family. The law also builds on our resilience so that the next storm, superstorm, drought, wildfire, hurricane can be dealt with. Last year alone, the United States, as a consequence of these kind of extreme weather events, lost $99 billion in the United States alone in damage. After Hurricane Ida, I see the distinguished governor from Louisiana is over there. I saw him stand up. I went down to see him. We went through and saw all the damage there. They had 179-mile-an-hour winds at top speed in Louisiana. But then I headed on up to New York. Chuck, we're up in your area, in the Queens, in New Jersey. More people died there than in the hurricane. More people died with the flooding. Record wildfires raged, and I went to Idaho and California and saw it. More land is burned to the ground than the entire state of New Jersey out west. Folks, walk the neighborhoods and look the people in the eye in these circumstances, as many of you have, and you'll see the despair and the heartache. So many of you understand. You're living through it. This law builds back our bridges, our water systems, our power lines, our levees, better and stronger, so few Americans be flooded out of their homes or lose power in those days and weeks as a consequence of the storms that hit. Folks, this bipartisan law, for the first time ever, creates a true national network of charging stations for electric vehicles, over 500,000 of them, so you can charge your car here and drive all the way to California, not worrying about having to find places to charge, creating thousands of jobs, thousands. It was also going to make it possible for Americans to get off the sidelines and into the game of manufacturing, solar panels, wind turbines, batteries to store energy and power for electric vehicles, including electric school buses, which will mean millions of children will no longer inhale the dangerous diesel fumes that come out of the buses. For real, it's a big deal. And it'll reward companies for paying good wages and for buying American, sourcing their products here in America right now. It's going to help the United States export clean energy technologies to the world, creating tens of thousands of more jobs. There's so much more in the law, but most of all, it does something truly historic. I ran for president believing it was time to rebuild the backbone of this nation, which I characterize as working people in the middle class. They're the ones who built the country. And to rebuild the economy from the bottom up and the middle out. This law delivers on that long overdue promise, in my view. It creates better jobs for millions of Americans. And no one earning less than $400,000 a year will pay a single penny in federal taxes because of it. And it does not include, as we did the bipartisan infrastructure bill, it does not include a single penny in gas tax, which I rejected because people under $400,000 would be paying it. This law is a blue-collar blueprint to rebuild America. It leaves no one behind, and it marks an inflection point that we face as a nation. For most of the 20th century, we led the world by significant margin because we invested in ourselves. But somewhere along the way, we stopped investing in ourselves. We risked losing our edge as a nation, and China and the rest of the world are catching up. Our infrastructure used to be rated the best in the world. Now, according to the World Economic Forum, we rank 13th in the world. Well, that's about to change. Things are going to turn around in a big way. For example, because of this law, next year will be the first year in 20 years American infrastructure investment will grow faster than China's. We'll once again have the best roads, bridges, ports, and airports over the next decade. And we'll lead the world into the 21st century with modern cars and trucks and transit systems. We're going to do this by building again and moving again. Folks, too often in Washington, the reason we didn't get things done is because we insist on getting everything we want, everything. With this law, we focus on getting things done. I ran for president because the only way to move this country forward, in my view, was through compromise and consensus. That's how the system works. That's American democracy. And I'm going to be signing a law that is truly consequential because we made our democracy deliver for the American people. We compromised. We reached a consensus. That's necessary. And now our focus moves to implementing an infrastructure law that's going to, with speed and with discipline. I have a lot of experience in doing that. When I was vice president, I was given responsibility for overseeing and implementing the Recovery Act for nearly $900 billion emergency package. I'm proud to say that when we finished implementing that Recovery Act, it was determined that there had been less than 0.2% waste, fraud, or abuse. And it was how I learned and earned the nickname Sheriff Joe from President Obama, because I made it a point every single day for well over a year to stay on top of how the money was being used. I spoke with over 160 mayors, 2-3 times sometimes. And I spoke with county executives and every governor save one. Well, I won't mention that. And save one. She could see Alaska from reports, but monitor what we're doing. That was just how it was being done. And it was one of the most efficient implementations of a major program in American history. And now we owe it to the American people to do the same thing again. And to make sure every penny is spent where it's supposed to go in a timely fashion, I've asked the former mayor of New Orleans and former lieutenant governor of Louisiana, Mitch Landrieu, to oversee this responsibility. He'll have full access to every tool the federal government has to get it done. And we have the high obligation and responsibility to make sure this money is used wisely and used well. Folks, I've been looking forward to this day for a long time, like all of my colleagues here have. Tomorrow, I'll be traveling to New Hampshire to visit a bridge that is structurally not safe, like thousands of bridges across America. That's what this law is all about, keeping communities safer and more efficient. On Wednesday, I'll be in Detroit to meet with the UAW workers who are building the next generation of electric vehicles. And that's just the beginning. We're also seeing me and you'll be seeing me and Vice President Harris, Jill and Doug, cabinet officials, hitting the road to help you understand how this is going to transform your lives for the better. And folks, when you see those projects starting in your hometowns, I want you to feel what I feel. Pride. Pride in what we can do together as the United States of America. Folks, you know, the same goes for my plan to build back better for the people. Getting folks back to work and reducing cost of things like child care, elder care, housing, health care, prescription drugs, and meeting the moment on climate change. I'm confident that the House will pass this bill, and then we're going to have to pass it in the Senate. And it's fully paid for. It will reduce the deficit over long term, according to the leading economists in the world. And again, no one earning less than $400,000 will pay a single penny more in federal taxes. And together with the infrastructure bill, millions of lives will be changed for the better. Folks, let me close with this. Throughout our history, we've emerged from crises by investing in ourselves. During and after the Civil War has been referenced, we built the Transcontinental Railroad, uniting East and West and uniting America. During the Cold War, we built the interstate highway system, transforming how America lived their lives. And now we're emerging from COVID-19 pandemic and we'll build an economy for the 21st century. When I met with President of China, who I'm going to be speaking with tonight, several years ago, he asked me, we were in China, he said, could I define America? And I said, absolutely. It's the God's truth. I said, absolutely. I can define it in one word. Possibilities. Possibilities. There is no limit to what our people think we can do. And there is no limit to what our nation can do. And there is no one thing that I know more than this. It's never, ever been a good bet to bet against the American people. Never, never, never. Given half a chance, the American people have never, ever, ever let this nation down. And it's our job to give our people that chance. It's our job to come together and make sure we remain a nation of possibilities. As I look out in this crowd today, I see Democrats and Republicans, national leaders, local leaders, all elected officials, labor leaders, business leaders, and most of all, I see fellow Americans. I see America. Let's remember this day. Let's remember we can come together. And most of all, let's remember what we've got done for the American people when we do come together. I truly believe that 50 years from now, historians are going to look back at this moment and say, that's the moment America began to win the competition of the 21st century. So with confidence, optimism, with vision and faith in each other, let's believe in possibilities. Let's believe in one another. And let's believe in America. God bless you all, and may God protect our troops. Now let me sign this bipartisan bill.
Take the Vice President's attention out of your way, sir. Good man. There you go. Yes, sir.
Oh, my mask.
President Biden there signing the infrastructure package into law right now as he wrapped up some comments from the podium in front of the White House, really taking a victory lap on the passage of that $1.2 trillion infrastructure deal. But let's get to Jessica Smith, our DC reporter, for the latest on what we just heard from the president and her reaction. Jess?
Yeah, Shauna, the president was sending a message to Americans. He said, your life is going to change for the better as a result of this bill. He touted the measures in the infrastructure bill. He said they will lead to better roads, bridges, electric vehicle infrastructure. It will create jobs and make the U.S. more competitive globally. He said that this legislation is proof that Democrats and Republicans are capable of working together. He said it was a monumental step forward. About 800 people, according to the White House, were there at the White House for this signing ceremony. That includes members of Congress, governors, mayors, business leaders, union leaders. They were all there to take a victory lap on this bipartisan piece of legislation. Earlier today, the White House did announce a new task force for implementing this infrastructure bill. So that is the next step here, actually getting these projects off the ground, getting them going. A former New Orleans mayor, Mitch Landrieu, is going to be leading that effort, making sure to, according to the administration, to avoid waste, to work with local and state officials to get these projects going. So that is kind of the next step here, working to get all of these projects going. And the White House is going to be traveling around the country. President Biden just this week will be heading to Michigan and New Hampshire to continue to sell this plan, to tout the benefits of it, and to try and build support for the next piece of his economic agenda, the Build Back Better plan. Of course, that plan still working its way through Congress. But again, today, the president celebrating what he calls a monumental step forward for the country. Guys.
All right, Jess, thanks so much. We want to bring back in our markets panel who have been patiently standing by. We have Rob Hayworth, U.S. Bank Wealth Management Senior Investment Strategist, and Tom Essay, Sevens Report Research Founder and President. Tom, let me just go to you first. Just your initial thoughts on what we just heard from the president now that we do see, or we have an example of Democrats and Republicans working together. How do investors, or how are investors looking at this just in terms of what we could expect going forward?
It's certainly a nice moment. I know everybody wants sort of more of this, right? More of coming together and working to get something done. But I wouldn't read too much into it, frankly. I mean, at the end of the day, all they were really trying to do was figuring out how to spend, $1.2 trillion of taxpayer money, and it took them quite a while to do it. So I don't think that this is any sort of a great revelation that Washington is going to start providing, tons of bills. But at the end of the day, it is a positive in so much as it prevents a fiscal cliff in 2022, whereby the government was spending a whole pile of money on the economy, and then it was going to be spending substantially less. Now, at least this infrastructure bill helps kind of create that bridge. I don't think it's a reason to buy stocks here, but generally speaking, it is a positive.
Rob, thank you again for sticking around. When average investors take a look at what happened today in the market, essentially flat on the S&P 500, and you're trying to figure out where we're going next, there are competing arguments as to whether this market is expensive or not expensive. Now we're going to get $1.2 trillion over the next 10 years in spending. What should the average investor, what should we consider from this bill, or is it in the rearview mirror?
Well, yeah, I think the bill is getting into the rearview mirror and is very much about spending spread out over the next few years, right? So it's not a lot there, but there's other fundamental underpinnings to this market that I think we have to look at. And yes, valuations are on the high side of fair, but it's earnings growth that's really going to drive this market. And I think we look at a couple of things that are really beneficial for this market. One, there's ample room for labor force growth. Two, wages have been rising, so consumer the ability for consumers to spend is positive. Three, we have high savings and ample savings for consumers, so they have more room to spend. And then four, we're still seeing ample accommodation, whether it's fiscal policy, as was pointed out by Thomas, right? There's ample fiscal policy there to support the economy. And while the Fed is starting to taper, they're still adding to that, adding to their balance sheet well into June. So there's a lot of stimulus here to help this economy still as we look forward over to the next 6 months that should benefit corporate earnings.
So Rob, then just give us some names or some sectors. I guess, what are you favoring now in this environment?
We'd love to favor the cyclical growth companies or the secular growth companies, but right now we're really taking a more balanced approach because there are still a wide range of outcomes that can happen, right? We've seen some surprises on inflation. We hate for those to continue. If we don't get consumer spending on board, right, that could be a bit of a downside. But we'd stick into that. We'd have a more balanced approach at this point, which would involve, yes, energy and financials, but also technology and communications, because we think all those sectors are actually going to benefit a little bit. The one segment that's, other than today, not doing very well that we're probably a little more cautious on would be defensives. And again, we think we see rising rates as well. So that tends to be a challenge for those defensive sectors.
Tom, in your most recent report to clients, you mentioned that you're neutral on commodities. Wouldn't all this money that's about to push whatever's about to happen with all this building and spending, wouldn't commodities be something you'd want to be perhaps other than neutral, more active?
Over the longer term, we certainly think that the commodity bull market is still in place, but we have to remember we've seen quite a run, right, over the past couple of months. And also we have the dollar kind of moving higher, right? So the dollar is at essentially 2021 highs and the highest level since July of last year. So we think there could be a temporary headwind on that space. Now, as long as the recovery continues apace and as long as we have generally higher than expected inflation, yes, over time, commodities should continue to do well. In the near term, however, that stronger dollar and just the run just creates a little bit of caution in our mind.
Rob, over the next several days, we're going to be hearing from a number of retailers. They'll be reporting their earnings results. We've been talking about how the consumer has been so resilient. Time and time again, we're seeing the consumer absorb those higher costs. How long do you expect that trend to be able to continue?
Well, we think it eventually ends. For now, I think the constructive piece is wages continue to grow, and so the consumer should be able to replace or maintain their spending level with that wage growth. So as long as we've got this improvement in the labor market, and hopefully we'll see that continue to unlock once we get to the November jobs report after such a solid October jobs report, wages continue to grow. I think it could last well into next year.
Rob Hayworth, always great to speak with you, U.S. Bank Wealth Management Senior Investment Strategist, and our thanks to Tom Essay, Sevens Report Research Founder and President. We are going to take a quick break, but when we come back, it's an interview that you don't want to miss. Brian Chung is speaking exclusively. It's a one-on-one with Richmond Fed President Tom Barkin. That gets underway in just a few minutes. We'll be right back.
A little bit of earnings news, especially when it comes to electric vehicles. Jared Blickery is watching what's going on with Lucid Motors, and they closed up today. What more can you share with us?
Well, they're up another 4% in after-hours trading, and that's on the back of their results. This is a company, by the way, also, they won the 2022 Motor Trend Car of the Year. It's got to be a nice day for CEO Peter Rawlinson, because he was chief engineer when he actually engineered the Tesla Model S sedan, and they won that very same award in 2013. So here are some of the numbers from the report. They only started production on this on their vehicles in the quarter, so a lot of the top and bottom line numbers not going to be that relevant. But customer reservations rose to 13,000 in Q3. They currently stand at 17,000. Also looking at their balance sheet, at the close of the third quarter, they had $4.8 billion in cash. That's a nice stash to be able to produce some more cars and also ramp up their manufacturing capacity. And that manufacturing capacity actually happened at their advanced manufacturing plant, AMP1 in Casa Grande, Arizona. They also broke ground on the second phase of construction, adding 2.85 million square feet. And just want to go down here, one more little nugget here. As of Monday's close, the company had a market cap of about $73 billion. And this is another company that barely has any revenue. So pretty impressive for this company, Lucid, these earnings results, guys.
Jared Blickery, thank you very much. We told you that Brian Chung was going to be interviewing the Richmond Federal Reserve Bank president in this hour, and we want to get to that now. Brian Chung is joining us with a special guest. Brian?
Thanks, Adam. Well, joining us here in an exclusive interview on Yahoo Finance Live is the Federal Reserve Bank of Richmond President Tom Barkin. President Barkin, it's great to have you on the show this afternoon. Just kind of actually wanted to start it off with the breaking news that we had gotten about that infrastructure bill with regards to where we are in this economic recovery. Just kind of wondering if the passage of that infrastructure bill moves the needle on where you expect economic growth to go.
Well, most of this bill is going to be spent over multiple years. And so I don't think this is a near-term stimulant on the economy. I do think this is going to increase pressure on infrastructure workers. And so I am going to want to see how we're going to keep building out the infrastructure workforce. That's a workforce that's, as you know, already quite tight.
So President Barkin, a lot of this is kind of obviously coming at the time where a lot of Americans are worried about inflation. And some people are wondering, well, if this type of fiscal spending is happening, is that going to further inflation? Now, when we talk about the prints that we've gotten so far, obviously that hot CPI print showing the fastest pace on a year-over-year basis since 1990, is what we're seeing right now transitory in your view?
Well, the last CPI report, as you know, was pretty significant and pretty broad. And so we'll see how long this lasts. But I do anticipate these supply chain issues are going to last well into next year. And I'm watching very closely the labor side. There's a lot of pressure right now on jobs, as you know, participation, wages, and that's the kind of thing that makes inflation more longer term. And so that's really what I'm watching is the labor market.
And I want to get back onto the labor market in a little bit, but I want to stay on the theme of inflation because it's also weighing on consumer sentiment. We saw that from the University of Michigan's release last week. Do you feel like there's a risk of an unanchoring of inflation expectations from the perspective of the U.S. consumer? Because it's clear that people are talking about this at the dinner table now. They're noticing it at the stores. When you talk to people in your district in Richmond or small businesses, how important is that discussion as you try to think about whether or not there is the risk of an unmooring of inflation expectations?
Well, there's always that risk, but I've taken some comfort out of the combination of what you hear from those consumer surveys that seem to suggest medium to long-term inflation is still within most norms. I've taken some comfort from the markets, which seem to have medium to long-term expectations still pretty stable. And I've taken some comfort from when I talk to businesses, because even today, as they see higher costs that they're pushing into prices, they're not talking about this being something that's going to last year over year over year, which is really what persistent inflation is.
Well, and that's interesting you bring up businesses, and you have experience kind of consulting for businesses as well. Margins right now, right, are kind of the big driver when it comes to price increases. These are the executives who have the ability to put into place passing on of costs if they're facing higher material costs or higher labor costs. So when you talk about the idea of transitory, this obviously appears to be lasting longer than many policymakers thought. Do you see what we're seeing in earnings this quarter as supportive of the transitory or supportive of the persistent argument on inflation?
Well, I just don't think what you're seeing this quarter has all that much relevance for what you're going to see a year from now. You have supply chain outages, which means that manufacturers, businesses are more interested in getting availability than they are in squeezing on costs. So they're more receptive to price increases. You have consumers that have a lot of money in their pocket and are free to spend by combination of the vaccine and opening of the economy. And so they're probably less willing to walk away for a price increase than otherwise seen. We've got to get to the other side of this before you really know whether these things are persistent or not.
Well, and I guess that kind of gets at the question of whether or not the inflationary pressures that we're seeing right now are coming from demand or coming from supply. And we know the anecdotes about the supply side of things with the bottlenecks and also labor shortages and whatnot. But what are you seeing on the demand side of things? Because there's a question about whether or not the fiscal stimulus that had been put in place during the depths of the pandemic may have changed the behavior for the propensity of Americans to spend. Is that something that you're seeing in the data, or are things still really noisy and difficult to figure out right now?
Well, there's no doubt in my mind that demand is quite strong today. On the consumer side, and the business investment side, on the government spending side, demand is quite strong. And everyone I talk to says that. You still have about $2.5 trillion in excess savings in people's pockets that hasn't been spent. Now, what you're not seeing is people in total, you're not seeing the economy spend into that savings. So the savings rate isn't below where it was before. And so you still got this 2.7 trillion in excess that I think is supporting consumer spending.
And so kind of to bridge back to Fed policy here, you're in the midst of tapering your program right now. That was announced at the beginning of this month. It's going to start this month. I guess the idea is that the pacing would allow you to wrap up all asset purchases by the middle of next year. How do you think about the optionality on raising rates if inflation does prove to be a bit more sticky than policymakers are seeing right now?
Well, I like what Jay said at his last press conference, which is, we'll be patient, but we're not going to hesitate. And so if the need is there, we'll do what we have to do. But I personally think it's very helpful for us to have a few more months to evaluate, is inflation going to come back to more normal levels? Is the labor market going to open up as people spend through some of this savings, perhaps after Christmas, come back in the workforce as COVID declines? And so I think it's helpful to have some time to see where reality is in this economy. And if the need to act is there, we'll do what we need to do.
So let's go back to the labor market, because that's a big part of this equation as well, right? The Federal Reserve has been very clear that substantial further progress is not the test for raising rates. It would have to be really kind of closing the shortfalls from maximum employment. What is maximum employment in the dynamic of this labor market? Has there been any sort of permanent change to it that would imply you can't get to the same levels or numbers as you had pre-pandemic? Or is there some good faith that you can get everyone who is currently out of the labor market back into the labor force?
I think that's the core question. I mean, what we've seen, we know that underlying what's happening in the labor force is a declining trend in labor because of demographics. Fertility is down, people are aging, immigration is down. And so you've just got a smaller base. If you go back to the last upturn, what you saw was a significant excess of workforce participation above that trend. We've now come back down to the trend. And the question for me is the aberration today and people will get back to work, or was the aberration the end of the last upturn, or somewhere in between? And that's what we're going to get a lot more news on. Importantly, as we get COVID fully behind us, because I'm certainly one of those people who thought in September we would, schools would be open, childcare would be open, COVID would be down, unemployment insurance would have expired. We'd have gotten more people in the workforce, and we just didn't see that. And so now you'll give it a few more months. If we can get COVID behind us, then we'll see.
Now, at the same time, there's been some discussion, though, that those particularly over 55 have retired for good. They're not coming back. There's also just kind of lingering questions about whether or not some women and those that have been disproportionately affected by the pandemic will be on the sidelines forever. So how helpful looking at other types of data sources when I talk about, for example, labor turnover from the JOLTS survey, which showed last week a record amount of quits in the month of September. Are you gleaning anything from those type of data releases and those pulses about where maximum employment might be?
Well, I think of the labor market as having three different pieces to it. There's a piece to it which is the skilled trades. Think carpentry, manufacturing, even nursing. They were short before the downturn. Demand has spiked in all of those sectors, and they're short today. And the issue there isn't demand. The issue there is getting more people interested in those trades and getting trained and certified and licensed into that. So that's one whole set of issues. There's a second issue in the frontline labor, and that's really where the quits is elevated. And you can imagine why. If you were working for $10 or $11 or $12 at a fast food place and you could get a job for $15 at Amazon, why wouldn't you go there? And a lot of people have left those sectors, perhaps because they got laid off and found other jobs, perhaps because they don't want to work in a mask, perhaps because they're still nervous about COVID. Who knows why? But there's a lot fewer workers interested in those segments. And that's why you're seeing strong quits in those sectors. The sector we haven't really seen as much quits on yet, but I still think there's more to come, is in the professional class, where you're starting to see some turnover. And of course, people are very busy working hard. Maybe they're reassessing their lives. And so I think you will see more turnover to come in those sectors.
Now, you've talked a lot about this idea of the Great Resignation, and you kind of just touched on the wages aspect of that. When you look at the BLS reports on a monthly basis, how important are wages? Because a lot of people are reading that within the context of this is us trying to draw based on where labor costs are, whether or not those inflationary pressures will be persistent. Because if you keep them on payroll, that's going to be likely more of a persistent increase than a temporary increase. But at the same time, the Federal Reserve has also made it clear that it's not just wages that are important for getting people back to work. It's making sure that you actually get the people who don't have a job back into a job. So how important is the wage number when those reports come out?
Well, I'm looking at wages as a sign of how tight it is. And again, I look at it across those three sectors. So I try to look hard at the leisure and hospitality jobs as an example for one sector, or the manufacturing jobs as an example for the other, and see what's happening. And then I think importantly, participation is absolutely critical. And I think you can just make the case that right now, if you're not getting more people in the workforce, businesses are trading one another's workers, and they're bidding in an auction for each other's workers. I was with a hospital talking about traveling nurses the other day. And it just sounds like the industry has moved toward everyone's traveling, even if they're traveling within a metro area, because they're all just bidding for one another's nurses. And I think until you get more participation in the workforce, that's the dynamic we're going to have.
Yeah, and the nursing field is one place where we've heard so many anecdotes of people feeling burnt out and then quitting and actually leaving the industry entirely. We'll save that for another time. But want to ask about, you talk about just kind of different industries. What about different types of demographics when you talk about rural versus urban? Your district covers the entirety of North and South Carolina. Are you seeing any sort of difference in the economic recovery in those regions?
Well, it all depends on where you sit. But I'd say there's real opportunity for smaller towns that have trouble getting workers. Think of a two-career couple. Now one of them can work remote. You might actually be able to get them to move to that town. Now, not every town's going to benefit from that. The ones that are going to benefit are ones that have amenities, ones that have broadband, ones that have manufacturing towns are benefiting because of what's happening in those markets. And I think all of the stimulus money has a real opportunity for small towns. There's $65 billion allocated to broadband in this infrastructure bill. If that can get deployed into these small towns, you really can set them up with a much better, more attractive offer for workers. I think the opportunity is there, but it's a competition, and it's a competition among these small towns. And those that seem to have the best amenities, the best product, I think, are advantaged in that competition.
A bigger picture question here. A lot of discussion about stagflation. Some people thinking that we're in a stagflationary environment, which would imply kind of a 1970s era period of low growth but high inflation. Is that something that you're seeing from your vantage point of the Richmond Fed?
Not at all. In fact, as I said, I think demand is extremely strong. So we don't have a situation of slow growth. We have a situation of very strong growth, frankly, growth that is overwhelming the capacity, both labor and supplies, of the economy to handle it.
But is that something that you're hearing from people in your district and the workers and the hiring managers in your district about these type of economic concerns? Because it just feels like over the past few months, there's been kind of this heightened sensitivity to the macro picture at hand here, that maybe it's overheating at a rate that is not sustainable.
Well, I think it's fair to say there's a lot more attention. And you mentioned the sentiment survey, the Michigan survey earlier. There's a funny situation. You'll talk to a small company and they'll say, gosh, my costs are up and I can't find any workers. And we had the best year ever. And I think there's a lot of that going on now, which is they're having their best year ever, but they're just nervous, concerned about some of these things and, the inflationary pressures that they're seeing. It's a dichotomy, but it's very real.
Right. And lastly here, I want to ask about obviously the big headlines that have been swirling around the Federal Reserve over the past few weeks. There's an ethics review that was done by the Fed. The chairman, Jay Powell, did announce some changes that happened after two of your colleagues in Boston and Dallas stepped down after some of the trading that was done over the course of 2020. I'm just wondering how you have personally approached your financial interests over the course of this pandemic, but also through the recovery. And do you feel like these tightened ethics guidelines are really doing enough to make sure that you can maintain the credibility of the central bank?
Well, we had a set of policies that I'm told served us well for decades. I think in the context of all the new stuff that we did during the pandemic, it's entirely appropriate to take a fresh look at it. And I think what the chair's put forward is very reasonable, and I certainly plan to follow every bit of it.
All right, Federal Reserve Bank of Richmond, Tom Barkin, in a wide-ranging conversation here on Yahoo Finance. Thanks so much for joining us on this Monday. Have a great week.
Thanks, Brian.
And I'll toss it back over to you, Shauna.
Thank you very much. We're going to break this down right after the commercial break. We're going to hear from Andrew Levin, a former Federal Reserve Board Special Advisor and now a Dartmouth College economics professor, about the interview we just heard with President Barkin.
Richmond Fed President Tom Barkin just telling Yahoo Finance a couple of things. One, he was weighing in on inflation. Two, he weighed in on the $1 trillion infrastructure deal that President Biden signed into law earlier this afternoon, earlier in the show, saying that he doesn't think it's going to stimulate the economy in the short term. He also told us what he expects to see in terms of the supply chain crisis. But we want to bring in Andrew Levin. He's the former Fed Board Special Advisor and also professor of economics at Dartmouth, with his reaction to what we just heard from President Barkin. And Andrew, it's good to see you. Thanks so much for jumping on here. So President Barkin, let's start off, I guess, with his infrastructure comment, saying that the deal is not going to boost, he doesn't expect it to boost the economy in the short term. He also expects to see some of these supply chain issues lasting into next year. What do you make of his comments?
Well, I think the good news is the real economy is holding up well. We'll get a new retail sales report tomorrow. It's expected to be pretty strong. President Barkin referred to the fact that people were able to, many American households were able to put aside a lot of savings during the worst part of the pandemic, and now they're drawing into that to some extent. But I think what's really clear is that the Fed's going to have to recalibrate its policy strategy soon. It could be as early as next month at the December FOMC meeting, or it could be at the end of January. But the markets now, I just checked the CME FedWatch tool, the markets are expecting 3 or 4 hikes next year. The Fed's up until now has said that they would not start raising interest rates until we've reached full employment. I think it's very clear we're not going to be at full employment, certainly not on a broad-based inclusive basis. We're not going to be at full employment by the middle of next year. But because inflation's running hot, the Federal Reserve needs to respond. It has to take a balanced approach to maximum employment and price stability. And again, that's going to require a pretty substantial recalibration.
And Andrew, didn't he allude to the difficult balancing act they're going to have when they try to do what you just talked about, recalibrating, because the stimulus bill, or the infrastructure bill rather, he alluded to the fact there's not enough people out there in the infrastructure trades to hire right now to do everything we want to do. So that's going to put pressure on wages as companies try to fulfill the spending that's coming that way. How do they reconcile all of that?
Well, so some of these things are going to take place over months and quarters and years. We used to talk about shovel-ready projects. I think a lot of this is going to, evolve over time. But what's clear, and I just want to disagree strongly with something that several Federal Reserve officials have been saying lately, the cost of living is rising at 5 or 6%. It's very reasonable for workers to expect to get a cost of living increase of 4 or 5 or 6%. Some of them can't get it. The business they're working for can't afford to give them any cost of living increase. Many of those people are the ones who are quitting. The ones who are getting a raise of 6%, it's not that the workers are not greedy. That's just keeping up with the cost of living. And so I think what we're starting to see here is a dynamic where businesses that are able to give their workers a 6% cost of living increase then have to pass that through into prices. We used to call this a wage price spiral. The word spiral is a little bit alarming, but I think what is certainly true here is that we have a dynamic now where wages are rising in line with the cost of living. Then that creates a persistence in the increases in the cost of living. And this is going to go on, not just for a few more months, but probably for several more years. So again, the Fed needs to recalibrate.
Yeah, and Andrew, going off of that, I guess, how would you characterize the strength of the consumer right now? Because we've seen the consumer be extremely resilient. We have been able to absorb some of those higher prices. But if some of these companies, like you're saying, don't come out and give those 5 to 6% raises, are we going to see a pullback or a potentially significant pullback in spending?
Well, I think that, again, the retail sales we'll see tomorrow, but the expectation is it should be pretty strong. So fortunately, many consumers do have some savings, but a lot of consumers are worried. They're having to tighten their belts. Workers who haven't quit their jobs so far have only gotten about a 3% increase in their pay over the past year. Okay, they're not keeping up with the cost of living. You can understand why those people are not happy. So again, we're probably facing a world where inflation's going to be running well above the Fed's target over the next several years. That's what consumers are expecting now. They expect inflation to run in the neighborhood of 4, 5, 6% over the next several years. And I think those consumers are probably right. So that calls for the Fed to readjust its stance.
Well, why are the inflation expectations perhaps more important and also more burdensome than the actual real data?
Well, again, the real data is we had CPI reading of 0.9% for a month. Now, if you just multiply that by 12, you can see we're in double-digit territory for inflation. People have talked about this is the first time we've seen some of those kinds of numbers in many decades. So it's no wonder that households are very concerned about how they're going to meet their budget, how they're going to make ends meet. And those families are asking for pay increases from their business, which is reasonable for them to ask so that they can meet their budget. Then those businesses have to pass on those pay increases to their customers. And this is how we get a very persistent, elevated level of inflation. Again, it's going to call for the Federal Reserve to recalibrate its strategy.
And you're just talking about what we heard from President Biden earlier today, the signing the $1.2 trillion infrastructure deal into law. There's some questions out there whether or not more spending, if it's going to make inflation worse. Do you see this package having a substantial impact on inflation?
Well, as I understand it, the actual new spending in the package is not really $1.2 trillion. Some of that was already scheduled to take place. And so when you take the actual amount of new spending, it might be half of that. Again, we can quibble about details here, but that's spread out over a number of years. The total size of the U.S. economy now is more than 20 trillion. So we're talking about a pretty small sliver. Those infrastructure projects are important. That's why it was a bipartisan agreement to adopt that legislation. But I think the problems with inflation that we're facing are much more related to the pandemic and to the supply chain issues and to other factors that we hoped would be quickly unwound, and they're not. And so the Federal Reserve needs to respond. It needs to change its policy guidance, because up until now, the Federal Reserve has been repeating over and over again that it would hold off on starting to lift interest rates until we reach full employment. The Fed has to take a balanced approach in fostering both maximum employment and price stability.
Andrew Levin, we have to leave it there. Thanks so much for jumping on with us. Former Fed Board Special Advisor, Professor of Economics at Dartmouth. That does it for us today on Yahoo Finance. Thanks so much for sticking with us. See you right back here again tomorrow. Have a good night.